Hello champions, so with this I'm starting the revision sessions for your CA Inter direct tax paper. Whether you're writing your exams in May 26, September 26 or Jan 27, these revision sessions will be applicable for you. Before you straight away, go to the chapters, just hear me out for 2 minutes and then you can start your main learning. See, if you notice in this video, I am covering 4 things: basic concepts, residential status, agricultural income and salary side of income. The thing that I've done in these revision sessions itself is that I'm taking my time. When I'm taking my time, what I mean is that I'm not trying to rush just because it's supposed to be a marathon. I'm not treating it like a marathon. I'm treating it like a concept revision session, wherein if I know a particular concept will require a little more time for you to grasp, I'm giving that time. I'm repeating it multiple times during the revision session itself so that you are able to learn with me itself. This will not only help you revise concepts, I believe it will also help you learn concepts. I'm very sure by now you know the difference between learning and revising, right? So this video will not only help you revise, it will also help you learn. So and one more thing, I'm using the Checkmate book as the base for this entire video. So until now I used to tell students that if you have not learned DT from me, then the Checkmate book may not be of much use for you. So with these marathon sessions, that notion will change. Now even if you have not studied DT from me, with the help of this marathon video, with the help of this concept revision video, you can use the Checkmate book for your preparation for DT. And trust me when I say this, that's going to be a big huge game changer, because in the 1.5 days before the examination, it's so comfortably you will be able to revise your whole of DT paper with those 150 pages of the Checkmate book. And let's say while revising through the Checkmate book, you get stuck in a particular place, you can always come back to this concept revision video and you can see what exactly that particular box means or what exactly that particular paragraph means by chance you get stuck. Alright, the reason why I said the Checkmate book will be a big game changer for you, listen to me, hear me out, okay? See, I always say this to you, right, that you should not only be thorough with your preparation for DT, but you should also sort your 1.5 days. If you have sorted your 1.5 days, even that is going to make a big huge difference to how exactly you perform in those 3 hours in the exam. So this concept revision video, the DT Checkmate book, both of these put together will actually help you sort the 1.5 days. So in 1.5 days, you will not feel stuck. You will not feel like your preparation is endless. You will know that, okay, I just have to flip through the pages of my concept book, my Checkmate book, and in case I get stuck, I can come to this concept revision video and I'm sorted. So your preparation in those 1.5 days, your revision in those 1.5 days will look achievable, it will look attainable, and that itself will make a big huge difference to how you perform in those 3 hours in the examination. So I'll keep uploading these concept revision sessions in parts, guys. First part over here is basic concepts, residential status, agricultural income and salaries. So as I'm recording, I'll upload them in parts for you so that even you can start off your revisions and your preparation. All right, let's start with a discussion of the basic concepts. Now, even over here, we have some really crucial concepts from your exam point of view. Let's start with section number 4, your charging section, the section which talks about levy of income tax. Very easy section, guys. We can understand this section simply by asking us 3 to 4 questions. Question number 1, income tax is levied on what? It's levied on total income. Total income, when have you earned? When do you earn the income, guys? You earn the income in the previous year. And who are you? You can be any person, guys. You can be an individual, HUF, company, firm, LLP, AOP, Association of Persons, BOI, Body of Individuals, LA, Local Authority, or AJP, Artificial Juridical Person. You can come under any category, doesn't matter. So income tax is levied on what? On total income. When have you earned this income? In the previous year. Who are you? You can be any person. Now income tax is levied on this income, but at what rate? At what rate will you ask me to pay income tax? At the rate which is mentioned in the Finance Act. Which Finance Act? Every year we have Finance Act. You have to pay income tax at that rate which is mentioned in the Finance Act, which is applicable to the relevant assessment year. Easy, guys. Yes. So when what does section 4 say? Income tax is levied on what? On income. When have you earned this income? In the previous year. Who are you? You can be any person. At what rate is income tax levied on you? At the rate which is specified in the Finance Act. Which Finance Act? There are so many Finance Acts. That Finance Act which is relevant to the relevant, which is applicable to the relevant assessment year. Understanding, guys. Keep in mind, when do you earn the income? You earn the income in the previous year, and on that income, when do you pay tax, guys? You pay tax in the assessment year, right? So we have have a combination of previous year assessment year. So you earn income in the previous year, you pay tax in the assessment year. You pay tax at what rate? At the rate which is specified in the Finance Act, which is applicable to the relevant assessment year. Okay guys, and you can be any person, individual, HUF, company, firm, AOP, BOY, AJP, local authority, doesn't matter. Here I want to talk to you about two to three persons. AOP, Association of Persons, BOI, Body of Individuals. Remember, any person can be a member of AOP. Company, firm, individual, HUF, any person can be a member of AOP. That's why Association of Persons. But in Body of Individuals, only individuals can be members. That is why BOI, Body of Individuals, only individuals can be members. Remember this small tiny point. Artificial juridical person is that category of persons which is not fitting under any other category. Like for example, if a person is not an individual, not a HUF, not a company, not a firm, doesn't fit under any of the other categories, then all other persons we put under AJP. AJP is like etc. Getting it? If a person doesn't fall under any of these other entities, then it will come under AJP. 3 examples I will give you for AJP guys. One is your bar council. Second example will be your universities, and your third example will be deities in the temple. The same 3 examples are given in your ICAI study material as well. So be careful. Bar council, universities and deities, they don't come under any of these other categories. See, they are not natural persons, okay, but they are considered as separate persons in the eyes of law. But these persons don't fit under any other category. So therefore we'll put them under AJP. And remember, AJP is artificial juridical person, not artificial judicial person. Be careful about that. Okay guys, this was our first discussion. Then comes the second point. Just now we discussed that when do we earn the income? We earn the income in the previous year, but when do we pay tax? We pay tax only in the assessment year. But however, there are 5 exceptional cases where we earn income in the previous year and we also pay tax in the same previous year. What are the 5 exceptional cases? Point number 1, assessee is a non-resident. This non-resident has a ship. This ship has come to the Indian port. At the Indian port guys, passengers, mail, cargo, livestock enters into the ship. So of course your non-resident is now going to earn freight from India guys. So non-resident, you have earned income from India. You have to pay tax in India. No postponing this tax till the assessment year. Will give you 2 options. Either you pay tax now itself and only then leave, or you make satisfactory arrangements and then leave. That is, you appoint an agent and then leave. Okay. Option number 1, either you pay tax now itself and then leave, or option number 2, you make satisfactory arrangements and then leave. Now a question will arise that how will you compute the taxable income of this non-resident? Because you just know how much freight he has earned. We haven't computed his net profit till now. We haven't considered what are all his expenses till now. See, we all know that revenue minus expenses, this is going to be your net profit number guys. We always pay tax on the net profit number. We never pay tax on the revenue number guys. We always pay tax on the net profit number. So a question will arise now that how will this non-resident's total income be calculated? How will his net profit be calculated? See, we know what is his revenue. We know what is the freight earned. But we haven't done proper accounting of the expenses and all till now. So we don't know what is the net profit and all till now. This is where presumptive taxation comes into the picture. Presumptive taxation means we will assume the income of the assessee. Assessee, listen, whatever freight you have earned, whatever revenue you have earned, that freight into 7.5%, we will assume that to be your income. Your real net profit may be less than that. Your real net profit may be more than that. I don't care. Simple guys. So we are going to apply presumptive taxation concept over here. Presumptive taxation means I don't care about your real income. Say whatever freight you have earned, no, 7.5% of that freight is deemed to be your income. You pay tax on that. Okay guys, this is the first point. So in the first point, non-resident has a ship. That ship has come to the Indian port. This non-resident is earning freight from India. So you are having 2 options now. Either you pay tax now and then leave, no postponing tax till the assessment year, or you make satisfactory arrangements, like for example, you appoint an agent. And also remember, don't forget the 7.5% number. In this case, we apply the presumptive taxation concept. Whatever freight this non-resident has earned, that freight into 7.5% is deemed to be the taxable income of this non-resident. On this income, whatever tax rate is applicable, you pay tax on the applicable rate and then you leave. Like for example guys, if this non-resident happens to be a foreign company, for example, foreign company tax rate will be 35%. So whatever is your income, whatever income you have computed in this manner, that into 35% you pay tax and then you leave. Okay guys, this was your first exception. Then comes the second exception. In the second exception, there's a person. This person is leaving India without any intention of returning. Like for example, see, I'm not talking about every person who's leaving India over here. I'm talking only about those persons who are leaving India with no intention of returning. In simple words guys, we're talking about those persons who are permanently leaving India. So when they're permanently leaving India, before they leave India, whatever income they have earned in the current year, we will ask them to pay tax on that income now itself before leaving. No postponing till the assessment year. Easy, guys. Then comes my third point. In the third point, assessee is AOP or BOI. Okay, Association of Persons or Body of Individuals. It was formed for a specific purpose, and the purpose got accomplished in the previous year, which means the AOP or the BOI is going to dissolve in the previous year, guys. So in the previous year, before dissolving, whatever income they have earned, on that income, whatever tax is due, no postponing till the assessment year, pay tax now itself in the previous year. Easy. This was your third point. Then comes a fourth point is a person. This person is likely to dispose property to avoid payment of tax. I'll give you one simple example over here to help you understand. Listen to this, guys. Let's say there's a person, Mr. Red, okay? He has to pay tax of 5 lakh rupees. He has no cash balance. He has no money in his bank. But he does have a piece of land. That piece of land is worth 10 lakh rupees. So with this asset, he can meet his tax obligation, guys. He easily can meet. Now what Mr. Red is planning is, see, Mr. Red has no intention of paying tax, okay? So what Mr. Red is planning, he is planning that I have a sister. I will dispose of this land to my sister. That is, I will gift off this land to my sister, for example. Then later when the income tax department will come and they will ask me to pay tax, I will say no money, bank balance also is zero, no cash also in my hands, no asset also is in my hands, it's gone to my sister, so I can't pay tax. Tell me, has Mr. Red already done this? Or is he going to do all this? Is he planning to do all this? He hasn't done all this, guys. He is planning to do all this. So he is planning. He is likely to dispose property. He has not already disposed property. He is likely to dispose property, but with an intention. What intention? He has an intention of evading this tax. He has an intention of avoiding the payment of tax. Intention is important over here. Now, if the AO has a reason to believe that Mr. Red has this intention, then the AO can come tell Mr. Red, listen, you have to pay 5 lakh rupees tax. No postponing till the assessment year. Pay tax now itself in the previous year itself. We know what you're capable of doing. We know you're capable of disposing the property like this to your sister. So you pay tax now itself. Simple, guys. So there's a person, he is going to dispose property. He is likely to dispose property with an intention to avoid the payment of tax. He has not already disposed property. He is planning to do this with an intention to evade tax. If the AO has a reason to believe that something like this is possible, then the AO does have the power to tell Mr. Red to pay tax now itself in the previous year itself. Okay, guys, then comes my last situation, fifth situation, discontinued business. Let's say I was having a textile business and I discontinued the business in previous year 25-26. I discontinued the business. So 25-26 becomes the last year of my business, guys. Now in this last year, whatever income I have earned, ideally I will pay tax on that income in assessment year in 26-27 only. But if it's a discontinued business, the AO can ask me to pay tax on whatever income I have earned in this last year, in the discontinued year, whatever income I have earned, on that they can ask me to pay tax in the previous year itself. But please notice, guys, there's a small catch over here. If any of the first 4 situations exist, it is mandatory that the assessee has to pay tax in the previous year itself. Like for example, if a person is leaving India with no intention of returning, if a person is leaving India, let's say he wants to settle down in Dubai, so he's permanently leaving India. Now whatever income he has earned in the previous year before leaving, in that year whatever income he has earned, on that income he has to pay tax before leaving. There's no option of postponing till the assessment year. It is mandatory. So in the first 4 cases, if the first 4 cases are applicable, payment of tax in the previous year itself is mandatory. But in the last case, in discontinued business case, guys, it is at the discretion of the AO. AO will decide on case to case basis that in which case in the previous year itself tax is required. Getting my point? That's why we always say, just because you discontinued your business in 25-26, it is not mandatory that you will have to pay tax on whatever income you have earned in this year. It is not mandatory you will have to pay tax in 25-26 itself. It is not mandatory. It is at the discretion of the AO. Only if the AO tells you, hey, listen, your business is discontinued in 25-26, you pay tax also in 25-26 only. Only if the AO tells you like this, you will have to pay like this. Otherwise, you will pay tax in the assessment year as usual, that is in 26-27. Okay, guys, so remember, in the first 4 cases, the payment of tax in the previous year itself is mandatory. But in the last case, payment of tax in the previous year is at the discretion of the AO. It fully depends on the AO. Okay, now come on, let's move on to the next point. By the way, all the 5 points are in your memory. Generally, we earn income in the previous year and we pay tax in the assessment year. But there are 5 exceptions. Non-resident, ship, Indian port, freight. Freight into 7.5% is equal to income. Either pay tax now itself and then leave, or make satisfactory arrangements, like for example, appoint an agent. Second exception, there's a person who's leaving India permanently with no intention of coming back to India. Point number 3, AOP BOI formed for a specific purpose and the purpose is accomplished. Point number 4, a person he is going to dispose property with an intention to evade tax. And point number 5, discontinued business. Okay, guys, now come to our next discussion, previous year and financial year. See, this is going to be a very interesting discussion. Okay, through this through this discussion, your income tax concept and your Companies Act concept both will get revised. So in income tax, we have the concept of previous year in assessment year, guys. We don't have the concept of financial year in Income Tax Act. Now in Income Tax Act, assessment year will always be 12 months. No change about that. Assessment year will always be 12 months. But previous year can change. Like for example, let's say there's a company and this company was incorporated on 30th of December 2025. Okay. And by the way, in our examination, that is whether you're writing in May 26 or September 26 or Jan 27. You may be writing in any of these three exams. Your Finance Act applicable for you will be Finance Act 2025, guys. The previous year applicable to you will be previous year 25-26 and assessment year applicable to you will be 26-27. Okay, so this assessment at 26-27, this will never change. This will always be 12 months only. But your previous year 25-26 might change in some cases. Look at this. Now, if the company is incorporated on 30th December 25, the first previous year will start on 30th December 2025. And when will it end? Previous year will always end on the coming 31st March, guys. What's the coming 31st March? 31st March 2026. So therefore, are you noticing previous year can be less than 12 months also? Okay, similarly, let's say a company is incorporated on the 30th of March 2026. So the first previous year of the company will start on 30th March 2026 and it will end when? On the coming 31st March. What's the coming 31st March now? The coming 31st March will be next day, 31st March 2026. So it's only 2 days long. It's less than 12 months. Even this is allowed. So in Income Tax Act, assessment year in our examination, for example, the assessment year will always be 26-27. It will always be 12 months long. But the previous year 25-26 need not necessarily be 12 months long. It can be less than 12 months also. But can previous year ever be more than 12 months? Impossible, guys. It can't be more than 12 months. Okay, I'll give you one more example. What if the company was incorporated on the 31st of March 26, 31st of March? Then the previous year will start on 31st March 2026. And when will it end? On the coming 31st March, that is same day, 31st March 2026 itself, it will end. It will be only 1 day long. Even this is allowed. You're getting my point, guys. But however, on the other hand, if you look at the Companies Act, in Companies Act, we have the financial year concept. Financial year, you must have learned, it can be less than 12 months. It can be equal to 12 months. It can also be more than 12 months. Do you remember, in Companies Act, you must have learned that if the company is incorporated in Jan, Feb, March, then the first financial year will end not on the coming 31st March, but on the next 31st March. Remember, guys, that point. Like, same example if we take, if the company is incorporated on 30th December 25, then the first financial year will be from 30th December 25 till 31st March 2026. So here, if you see, my first financial year is less than 12 months, which is fine. In my second example, however, if the company is incorporated on 30th March 2026, that is, if the company is incorporated in Jan, Feb, March, then the first financial year will end not on the coming 31st March, but on the next 31st March. So in my second example, the first financial year will be from 30th March 2026 to 31st March, not 2026, but 2027, guys. In my third example, again, the company was incorporated on 31st March 2026. Company is again incorporated in Jan, Feb, March. In Jan, Feb, March, if the company is incorporated, the first financial year will be from the date of incorporation till not the coming 31st March, but the next 31st March, which means 31st March 2027. So in these examples, if you see, the first financial year is more than 12 months long, guys. That is allowed. So that is why I've mentioned over here, in income tax, the previous year can be less than 12 months or it can be equal to 12 months. But it can never be more than 12 months. But in Companies Act, if you see, the financial year can be less than 12 months, can be equal to 12 months. But if the company is incorporated in Jan, Feb, March, then the first financial year can also be more than 12 months, but max to max 15 months. Because Jan, Feb, March, 3 months only, no. So 12 plus 3, 15 only is maximum possible. All this you must have learned in Companies Act, just giving you one revision. Getting my point, guys? So giving you one final closure of this concept. In income tax, we don't have a financial year concept. In income tax, we only have a previous year and assessment year concept. Assessment year will always be 12 months long only, no change in that. But previous year can be less than 12 months, it can be equal to 12 months, but it can never be more than 12 months. Previous income tax life is simple, guys. My previous year will start whenever you incorporate the company, and my previous previous year will end on the coming 31st March. My previous year can also be 1 day long, no problem. It can be 1 month long, no problem. It can be 2 months long, no problem. It can be equal to 12 months, it can be less than 12 months, but it cannot be more than 12 months. What? The previous year. But in Companies Act, if you see, we have the financial year concept. The financial year can be less than 12 months, it can be equal to 12 months, it can also be more than 12 months. When will it be more than 12 months, guys? It will be more than 12 months only in those cases where the company is incorporated in Jan, Feb, March. In those cases, the financial year will have to end on the next 31st March, no? So in those cases, it can be more than 12 months also. Okay, guys, got it? So we've done a revision of the revision. Now come on, let's go to our next concept. Let's close the previous year financial year assessment year concept and let's come to HUF. It's an untested area, guys. They've never tested this in the examination, and I also know many of you are not even aware of this concept. So I'm going to put in my 200% over here. I really hope even you listen to me carefully. Come on, sit up straight. No background music in your mind and listen to me carefully. Hindu undivided family. 2 schools of thought. That is nothing but 2 points of view. Simple. 2 schools of Hindu law. One is the Dayabhaga school and the other is the Mitakshara school. Let's talk about Dayabhaga school first. It's very easy. In Dayabhaga school, it is applicable only to 2 states, West Bengal and Assam. Here there's a concept of succession, which means till the head of the family, till the father is alive, only he will have right in the property. Only when the father dies, only then the children will get a right in the property. Understanding? Like for example, let's say there's Mr. A and this Mr. A has 2 children. Let's say he has a son and he has a daughter. Okay, let's give them names. Let's say son is B and daughter is C. Okay, so now till Mr. A is alive, only Mr. A will have a right in the family property, guys. The son and the daughter B and C will have no right only in the family property. But when Mr. A dies, then only the son and the daughter will get a right in the family property. Now let's say the son also is having 2 children, okay, X and Y. The son is having 2 children. Now let's say Mr. A has died, so the son and the daughter, only these 2 people are having right in the family property. X and Y will have no right in the family property. Only when the son B, only when the son dies, only then X and Y will get a share in the property, in the family property. Daughter is anyways having a right. So if the son dies, the daughter is anyways having a right. X and Y will also get a right because their father has died. You're getting my point? So only when the father dies, only then the children will get a share in the property. So till Mr. A was alive, only Mr. A will have a right in the property. Nobody else will get a right in the property. But when Mr. A dies, then his children will get a right in the property. Okay. When the son dies, then his children will get a right in the property. So only upon death of the father, the children will get a share in the property. This is Dayabhaga school. That's all, guys. Story over. Remember, West Bengal and Assam, only 2 states. Now, coming to the important part, the most important part from our examination point of view, that is the Mitakshara school, guys. In Mitakshara school, this is applicable to all other states. West Bengal and Assam, Dayabhaga school. All other states, the Mitakshara school. Now, here we have the concept of birth. In Dayabhaga school, the whole focus was on succession. But in Mitakshara school, the whole focus is on birth. So, here what happens is, there are 2 things, okay. There are 2 rights. One is right to partition, that is right to ask for partition of the HUF, and second is the right to get a share in the property. If the HUF is getting partitioned, then who will get a share in the property? So there are 2 rights, alright. And there are 3 categories of persons in the HUF. One is the Karta, the head of the family. Then all the children all the persons who are born in the family, they become co-parceners, and everybody else becomes members. So like for example, let's take a situation. Let's say we have a HUF where we have A, we have his wife Mrs. A, and let's say they have 2 children B and C. Let's say B is the son and C is the daughter, okay, and B has 2 children, let's say X and Y. Okay, now and let's say B is married, so we also have Mrs. B, and you would be aware that when it comes to the daughter's husband does not enter into the father's HUF. For the daughter, we will stop with the daughter itself. Daughter's spouse, daughter's children and all will not enter into the HUF. So let's say now let's identify the persons. First of all, who is a Karta? Head of the family, guys. Who's the head of the family? Mr. A. A will become the Karta of the family. Then who is a co-parcener? That is, who is born in the family. See, Mrs. A, she was not born in the family. She got married and that's how she entered into the family. But B, the son is born in the family. So son will become the co-parcener, guys. Even the daughter C, even she is born in the family. So even she will become the co-parcener. Are you noticing? Male and female members, any member who is born in the family will become the co-parcener of the co-partner in the HUF. Okay, then X and Y, even they are born in the family, so X and Y will also become co-partners. You're getting my point? Everybody who is getting married married, everybody who's being born in the family will become a co-partner. Okay, guys. Then who is a member now? Who got married and entered into the family? Like Mrs. A, then Mrs. B. Both of them are members of the family, but they were not born in the family, so they are not co-partners, but they will become members. Okay. Now, always remember, it is a karta and the co-partners. It is these people only who can ask for partition of the HUF. The members cannot ask for partition of the HUF. So, who can ask for partition? Only the karta and the co-partners. Now, if the HUF is getting partitioned, then who will get a share in the HUF property? HUF will have a lot of assets. HUF will have a lot of properties. If the HUF is getting partitioned, partition means what? Partition means HUF, whatever assets they are having, that assets will get distributed amongst everybody. So, when the HUF is getting partitioned, the assets of the HUF will be distributed between whom? Who will get a share in the HUF's assets? Everybody. Everybody means what? Karta also, co-partner also, member also, everybody. So, who can ask for partition? Only karta and co-partners. But if the HUF is getting partitioned, then who will get a share in the HUF properties? Everybody. Karta, co-partners and members. Point to be noted is, members cannot ask for partition, but if the HUF is getting partitioned, members will also get a share in the HUF property. Got it, everybody? Now, one small thing, understand that you're not trying to learn Hindu law right now. You're trying to understand a HUF concept from the point of view of Income Tax Act. We're not learning the whole of Hindu law. So, please don't start overthinking and all in this HUF concept. The only thing that you need to know is the Dayabhaga school and the Mitakshara school. There are two schools. Dayabhaga school is applicable only in two states, West Bengal and Assam. In Dayabhaga school, till the father is alive, only he will have right in the HUF property. Only when the father dies, only then the children will get a right in the HUF property. Then we have the Mitakshara school, which is applicable to all other states. Here we have the concept of birth, which means as soon as a child is born in the family, the child will become a co-partner and he will get right in the family property. So there are three categories of persons in the HUF in Mitakshara school. The karta, the head of the family. Then every person who is born in the family will become the co-partner. Then every other person who is not born in the family, like for example the wife, the spouse and all, will become the members. Then remember, who can ask for partition of the HUF? Only the co-partners and the karta. But if the HUF is getting partitioned, then who and all will get a share in the HUF property? Everybody. The karta also, the co-partners also, the member also. That's all. Easy, guys. So don't do overthinking in the HUF concept. This much only we are required to be aware of. Okay. Then listen, coming to our next discussion, senior citizen and super senior citizen. Guys, senior citizen does not just mean 60 years. Super senior citizen does not just mean 80 years. There are conditions, guys. Only when all the conditions are fulfilled, only then you can call that person as a senior citizen. Only when all the conditions are fulfilled, only then you can call the person as a super senior citizen. Getting my point? So senior citizen means a person who is an individual. Condition 1. Condition 2, he is a resident. And condition number 3, he is at least 60 years in the previous year. Once again, he is an individual, he is a resident, and he is at least 60 years. At least 60 years when? In the assessment year. No. He is at least 60 years in the previous year. Okay. Only when all the three conditions are fulfilled, he will become a senior citizen. Super senior citizen means he is an individual, he is a resident, and he is at least 80 years in the previous year. Okay. Now let's take one small example. Listen to me very carefully. Okay. Let's say a person is born on the 1st of January 2025. He is born on 1st Jan 2025. Now, when will you celebrate this person's first birthday? When will you celebrate first birthday? On the 1st of Jan 2026, guys. But don't you think this person, when you're celebrating the first birthday, you're actually celebrating the start of second year? Is it making sense to you? Because don't you think the first year got already completed on the previous day, on 31st December 2025 itself, the first year got completed? Come on, guys. If you're born on 1st Jan, 1 year will get completed when? 1 year will get completed on 31st December. So, but your birthday will be celebrated on 1st of Jan 26. On your birthday, we actually celebrate the start of your next year. We celebrate the start of your second year. Your first year is already completed on the previous day, that is on 31st December 2025. Exactly in the same manner, let's say a person is born on the 1st of April 1947. Okay, so when will you celebrate this person's 60th birthday? You will celebrate his 60th birthday on the 1st of April 2007. Now, when you're celebrating this person's 60th birthday, you're actually celebrating the start of the 61st year. Same logic, guys. When the person is born on 1st Jan, you will be celebrating his first birthday on 1st Jan 2026, but you're actually celebrating the start of the second year. The first year already got completed on the previous day. Same logic, when you're actually celebrating a person's 60th birthday, you're actually celebrating the start of the 61st year. His 60 years already got completed on the previous day. That is, 60 years got completed on 31st March 2007, the previous day, guys. Now, this previous day is falling in which year? It's falling in previous year 2006-7. That is assessment year 2007-8. So, for 6-7, 2007-8, for this year, this person will be senior citizen for the first time. Getting my point? So the logic is, on your birthday, you're actually celebrating the start of the next year. Okay, like in our example, 60 years got completed actually on the previous day itself. On 31st March 2007 itself, you have completed 60 years. On your birthday, we're actually celebrating the start of the 61st year. So the previous day when you completed 60 years, that is falling in which previous year? Previous year 6-7, assessment is 7-8. So for this year, you will be considered as a senior citizen. Okay, same way if I ask you, if a person is born on the 1st of April 1947, for which year you will consider him as a super senior citizen? Same way, guys, when will he complete his 80 years? He will complete when will you celebrate his 80th birthday? You will celebrate his 80th birthday on 1st April 2027, you will celebrate his 80th birthday. But same thing, on his 80th birthday, you will actually be celebrating the start of 81st year. So when has he completed 80 years already? On the previous day, on 31st March 2027 itself, he would have completed 80 years. So 31st March 2027 will be which previous year, guys? This will be previous year 26-27, assessment year 27-28. So in this year itself, you will consider this person as a super senior citizen. Okay, so you will always see the preceding day, that when are you celebrating this person's 60th birthday? When are you celebrating this person's 80th birthday? You will not see that day. You will see the previous day. That previous day is falling in which year? In that year, first time that person will become senior citizen or super senior citizen. Okay, guys, and please remember very carefully, as soon as you see 60 years, don't conclude senior citizen. First, check the conditions. Only if all the conditions are fulfilled, only then that person becomes senior citizen or a super senior citizen. Okay, just because you're 60 years, you will not become senior citizen. You should also be a resident. And you know, guys, in some questions, they will say, assessee is an individual, assessee is an Indian citizen, assessee is 60 years. Will that person become senior citizen? No, guys, your citizenship is irrelevant in this discussion. You must be a resident. Whether you're Indian citizen or foreign citizen, I don't care. You must be a resident. So be careful. Citizenship is irrelevant in senior citizen, super senior citizen discussion. You must be a resident. Okay, so this was another discussion. Then coming to the slab rates. Now we will start discussing the tax rates and all, the slab rates and all. Listen carefully. First, let's talk about individual HUF, AOP, BOY, AJP. Let's talk about these 5 assessees. For these 5 assessees, there are 2 regimes possible, the normal regime and the default regime. Let's talk about the normal regime first. The normal regime is also called as the old regime, guys. It is also called as the optional regime, guys. It's also called as the regular provisions of the Income Tax Act, guys. So if it is a normal regime, the basic exemption limit is generally 2,50,000. So if your income is up to 2,50,000, then no tax. Then if income is more than 2,50,000 but within 5 lakhs, then 5% slab rate will apply. If the income happens to be more than 5 lakhs but within 10 lakhs, then 20% slab rate will apply. If income is more than 10 lakhs, then 30% slab will apply. Okay, up to 2,50,000, no tax. 2,50,000 to 5 lakh, 5% tax. 5 lakh to 10 lakh, 20% tax. More than 10 lakh, 30% tax. Okay, then listen, if assessee happens to be a senior citizen, okay, then the basic exemption limit will not be 2,50,000, it will become 3 lakhs. Similarly, if assessee happens to be a super senior citizen, then basic exemption limit will not be 2,50,000, it will become 5 lakhs. So generally the BEL is 2,50,000, but if assessee is a senior citizen, the BEL will become 3 lakhs, and if assessee is a super senior citizen, then the BEL will become 5 lakhs. Okay, normal regime, guys, simple, story over. Then if the assessee is following the default regime, that is 115 BSE, which is also called as the new provisions. If assessee is following the default regime or 115 BSE or new regime, whatever you want to call it, then if here the basic exemption limit will be 4 lakhs. Here, even if assessee is a senior citizen or super senior citizen, doesn't matter. For everybody, the BEL will be 4 lakh only. Okay, and very simple. Okay, over here the slab will keep changing by 4 lakh, 4 lakh, 4 lakh. The slab will keep changing, and the tax rate will keep increasing by 5%. The tax rate will keep increasing. So up to 4 lakh, no tax. Then 4 lakh to 8 lakh, 5% tax. 8 lakh to 12 lakh, 10% tax. 12 lakh to 16 lakh, 15% tax. 16 lakh to 20 lakh, 20% tax. 20 lakh to 24 lakhs, 25% tax. And if the income is more than 24 lakh, then 30% tax. Understanding? So the slab will keep increasing by 4 lakh, 4 lakh. The income will keep increasing by 4 lakh, 4 lakh. The tax rate will keep increasing by 5%, 5%. Highest tax rate 30%. If income is more than 24 lakhs, highest tax rate 30%. Okay, remember, even if assessee is a senior citizen or a super senior citizen, here the BEL will not change. For everybody, BEL is the same only. It is 4 lakh rupees. Okay, amended provision, guys. Amended provision amended by Finance Act 2025, which is applicable for your exam. Okay, so this was about the slab rate applicable for individual HUF, AOP, BOY, AJP. What if assessee is a firm? What if assessee is an LLP? Or what if assessee is a local authority? Understand, in our income tax syllabus, whatever provisions are applicable to partnership firm, those provisions are also applicable to LLP. Okay, so same provisions only applicable to both in most of the places. So if assessee is a partnership firm or an LLP or a local authority, then 30% tax rate will apply. Basically, no slab rate concept. Whatever is the income, flat 30% tax. No basic exemption limit, nothing. Flat 30% tax. Okay. Then if assessee happens to be a company, this is where it gets interesting. First, you will check whether the company is a foreign company or is it a domestic company. If the company happens to be a foreign company, nothing more to think. Straight away 35% tax, story over. But if the company happens to be a domestic company, then there are 4 situations possible, guys. You will follow the same sequence. First, you will check whether 115 BAB is applicable. If 115 BAB is applicable, then assessee will have to pay 15% tax plus 10% surcharge. If 115 BAB is not applicable, then only you will come to 115 BAA. If this section is applicable, company will have to pay 22% tax plus 10% surcharge. If 115 BAB is not applicable, 115 BAA is also not applicable, then you will see 2 years back turnover. Like in our examination, our previous year is going to be 25-26, guys. So 2 years back will be what? 2 years back will be 23-24. So 23-24 turnover, you will see, is it within 400 crores? If 2 years back turnover is within 400 crores, then in that case 25% tax will apply for the company. If none of these buckets, if the company doesn't fall under any of these buckets, then general tax rate for domestic companies is 30% tax. Now you will wonder that, ma'am, we don't know what is 115 BAB. Ma'am, we don't know what is 115 BAA. Chill, relax. These sections, what is the content of these sections is not in your syllabus. You just have to know that these sections exist, and if these sections apply, then this is the tax rate. That's all what you need to know. So don't get unnecessarily worried over here. You will be learning these sections in detail as a part of your CA final syllabus only. In CA Intermediate, you just need to know that these sections exist, and if these sections apply, this is the tax rate. Okay, guys, so if 115 BAB applies, then 15% tax plus 10% surcharge. If 115 BAA applies, then 22% tax plus 10% surcharge. If none of these 2 sections are applicable, then you will see 2 years back turnover. If it is within 400 crores, then 25% tax. And if none of these is applicable, then general tax rate is 30%. Easy, guys, simple. That's it. So this is it with the tax rates, with the basic tax computation of all assessees. For individual HUF, AOP, BOY, AJP, you have slab rate basis. 2 regimes you have. For firms, LLP, company and all, straight away I will compute tax. Now, what if the assessee happens to be a cooperative society? Let me talk to you about that first. See, if assessee is a cooperative society, here also we have slab rate, okay? But there's no basic exemption limit. So, whatever be the income, assessee will have to pay tax, just that there is no basic exemption limit. Simple point. There are 3 slabs, that's all. First slab, if the income is up to 10,000, then assessee will have to pay 10% tax. Then second slab, if the income is more than 10,000, but if it is within 20,000, then in that case, assessee will have to pay 20% tax. So 10%, 20% and 30%. If the income is up to 10,000, 10% tax. If income is more than 10,000, but within 20,000, 20% tax. And if income is more than 20,000, then 30% tax. Simple, guys. 10,000, 20,000, 30,000. 10%, 20%, 30%. That's all. Now you will wonder, ma'am, what are these numbers then? Listen to me. For example, let's say income of the assessee is more than 10,000. Let's say income of the assessee is 11,000. Okay, guys. Now, for this 11,000, I can break this into 2 parts. The first 10,000 and the excess 1,000, guys. Now, on the first 10,000, you have to pay 10% tax. That's going to be 1,000 rupees. Okay. And whatever is the income in excess of 10,000, above 10,000 but up to 20,000. In this slab, we're having only 1,000 rupees. So on this 1,000, 20% tax. So 20% tax is going to be 200 rupees. So don't you think I can write this as 1,000 rupees plus this 1,000 rupees plus this 20%. 20% of what? 1000. What is 1000? 1000 is nothing but my assessee's income, which is 11,000 in excess of 10,000. Getting it? That is why I've written the 1000 number over here. So if the assessee is a cooperative society, then if the income of the assessee is more than 10,000, but if it is within 20,000, then I will, like for example, if it's 11,000 in my case, then I will split this 11,000 into two parts. The first 10,000 on which the tax will be 1,000. How 1,000? First 10,000 guys, tax is 10%. So 1,000 rupees. On the excess above 10,000 up to 20,000, on the excess of 1,000, 20% tax, which will be 200 rupees. So total tax will now be 1,200 rupees. This 1,200 I can also write it as 1,000 rupees plus 20% of 1,000. What is 1,000? 1,000 is nothing but my assessee's income in excess of 10,000. Okay guys, same way, let's say assessee's income is 21,000 this time. Okay, let's say it is more than 20,000, third slab. Let's derive the 3,000 number now. If the assessee's income happens to be more than 20,000, then this income also I will split into two parts guys. Income in excess of 20,000. So for the first 20,000 I'll calculate separately, and to the excess of 20,000 we have 1,000. On this I'll calculate separately. On 20,000 income, 20,000 means I'm falling in this slab guys, more than 10,000 but within 20,000. In this slab, what's my tax? In this slab my tax is 1,000 rupees plus 20% of my assessee's income in excess of 10,000. How much will this be? This will be 1,000 rupees plus 20% of 10,000, which will be 2,000. So here your total will be 3,000. And on this 1,000 your tax will be, this 1,000 is income above 20,000. So on the income in excess of 20,000, tax rate is 30%. That will be 300. So my total tax will now be 3,300. So this 3,300, if I have to write as a formula, I can write it as 3,000 plus 30% of 1,000. What is 1,000? 1,000 is nothing but the income of the assessee in excess of 20,000. That's what I've written over here. Getting my point? So if it is a cooperative society, even over here we have slab rate, but there is no basic exemption limit. So even small amount of income we have to pay tax. So on the first 10,000, 10% tax. Then if income is more than 10,000 but within 20,000, then 1,000 plus 20% of the income in excess of 10,000. Then if the income is more than 20,000, then 3,000 plus 30% of the income in excess of 20,000. That's all guys. So with this you've understood the basic tax calculation of all the assessees. For individual HUF, AOP, BOY, AJP, you had slab rate. For firm and LLP and local authority, straight away 30%. For companies, you'll apply the flowchart. And for cooperative society, again we have the slab rate. Okay. Now comes our 87A rebate. Now rebate is not applicable for every assessee. It's applicable only for individuals who are residents, not for HUF, not for any other assessee, not for non-residents also. Only for individuals who are residents. Now in normal regime, life is simple guys. In the normal regime, if assessee is an individual, resident and total income is within 5 lakhs, then assessee will get 87A rebate. That to maximum how much? Maximum 12,500 rupees rebate assessee will get. Be careful guys. I hope you're listening with utmost attention. Solid silly mistakes are possible over here. So in the normal regime, 3 conditions. See, in both the regimes, first 2 conditions are the same. Assessee has to be an individual resident. That part remains the same. Only the income number keeps changing. So if the income in the normal regime, if the income is within 5 lakhs, only then you will get rebate. If income is more than 5 lakhs, then forget about rebate. If income is within 5 lakhs, then maximum how much rebate you will get? Maximum 12,500 rebate you will get. Is there any income against which you cannot enjoy 87A rebate? Yes. Which income? Against 112A LTCG. Against this income, you cannot enjoy rebate under the normal regime. Okay guys, other special rate incomes and all, you can enjoy rebate. Lot 3 income also, yes, you can enjoy rebate. Okay. But if it comes to the default regime, in the default regime, here look at the conditions. First 2 conditions will remain the same guys. Assessee has to be an individual and resident. But in the normal regime, income had to be within 5 lakhs. No, here income has to be within 12 lakhs. Okay. So if assessee is an individual, resident and total income is within 12 lakhs, assessee will get rebate maximum how much? Maximum 60,000 rupees. Now, is there any income against which you cannot enjoy rebate in the default regime? Yes, any special special rate income. Basically guys, in the default regime, you can enjoy 87A rebate only against those incomes on which the slab rate tax is applicable. So in special rate incomes, the slab rate will not apply. So if for the SSC, the slab rate is not applicable, if for the income special rate is applicable, then on that special rate income, any special rate income in the default regime, 87A rebate cannot be availed. Did you notice this big point of difference? Amendment guys, amendment for your examination. Okay, so in the normal regime, only against 112A LTCG, I can't enjoy rebate. Other special rate incomes, I can enjoy rebate. But in the default regime, against any special rate income, I cannot enjoy rebate. Not just 112A, any special rate income, like for example 111A STCG, your lottery income, then you have 112 LTCG, any special rate income you cannot enjoy rebate in the default regime. Okay, then in default regime, one more special point you have, even if my income happens, see, generally if my income has to be within 12 lakhs, only then rebate. But even if the income is more than 12 lakhs, you will still get rebate. Like for example, let's say my income happens to be 12 lakh 10,000. Okay, so in that case, my assessee is an individual, assessee is a resident, and total income is more than 12 lakhs. But you will still have rebate provided you do these 3 steps. What's your first step? Step 1 will be total income minus 12 lakhs. Total income is 12 lakh 10,000. 12 lakh 10,000 minus 12 lakhs will be how much? It will be 10,000 guys. So step 1 is total income minus 12 lakhs. Then comes step 2. On this total income of 12 lakh 10,000, what's your basic tax? Let's compute basic tax guys. Just now I taught you. How will you compute basic tax? What's the basic exemption limit? 4 lakhs. On the first 4 lakhs, no tax. Then 4 lakhs to 8 lakhs, in between you have 4 lakhs income. On that 5% tax, that will be 20,000 rupees. Then 8 lakh to 12 lakh, in between you have 4 lakh income. On that 10% tax, that will be 40,000 guys. Then you have above 12 lakh up to 16 lakh. We are in the 12 lakh to 16 lakh slab. So in that slab, we are having only 10,000 income. On that 15% tax, that will be 1,500 rupees. So my total tax is going to be 61,500. So step 2 is your basic tax, which is 61,500 in our case. Then comes step 3. Be careful over here. Step 3 is always step 2 minus step 1, not step 1 minus step 2. Step 2 minus step 1. So step 2 minus step 1 is how much? 61,500 minus 10,000 is how much? 51,500. So this 51,500 will become your 87A rebate. See, two things, be careful. Thing number 1, if 2 minus 1 happens to be a negative number, then no rebate. Thing number 2, it always has to be 2 minus 1 and not 1 minus 2. Don't straight away give me the difference. Always do 2 minus 1. If 2 minus 1, by chance if it's a negative number, then you will conclude no rebate. Only if this difference happens to be a positive number, only then you will get a rebate. So whatever is the difference will become your 87A rebate. This is called as relief relating to 87A rebate. But do you have something like this in the normal regime? No guys. In normal regime, that's what I was telling you. In the normal regime, life is simple. Straight away 3 conditions. If income is within 5 lakhs, you will get rebate maximum 12,500. If income is more than 5 lakhs, forget about rebate. But in 115 BAC, in the default regime, even if income is more than the limit, even if income is more than 12 lakhs, still we will do this calculation and see. So in the calculation, what are the conditions? Condition number 1, step number 1, total income minus 12 lakhs. Step number 2, whatever is the basic tax. Step number 3 will be 2 minus 1, not 1 minus 2. If 2 minus 1 happens to be a negative number, then no rebate. If 2 minus 1 happens to be a positive number, that positive number will become your 87A rebate. Thorough guys. Then this I've already told you, in the normal regime, you cannot enjoy 87A rebate only against one income. Which income? Against 112A LTCG. Other special rate incomes, you can enjoy rebate. But in 115 BAC, any special rate income, you cannot enjoy rebate. Okay. Now comes one small differentiation table between 87A rebate as per normal regime and as per default regime. In normal regime, your income has to be within 5 lakhs. In default regime, income has to be within 12 lakhs. In normal regime, maximum rebate is 12,500. In default regime, maximum rebate is 60,000. In the normal regime, if income is more than the limit, if income is more than 5 lakhs, then there is no concept of relief and all. In default regime, even if income is more than the limit, even if income is more than 12 lakhs, still you can have rebate provided you follow the 3 steps. Step 2 minus step 1. If it's a positive number, the positive number will become rebate. If it's a negative number, then no rebate. Then lastly, in the normal regime, you cannot enjoy 87A rebate only against 112A LTCG. Other special rate incomes, you can enjoy rebate, but in the default regime, against any special rate income, you cannot enjoy rebate. Thorough guys. So this was our discussion on 87A rebate. Now comes the surcharge. See, same sequence I'm following. What's the sequence? We first do basic tax, then from that we subtract 87A rebate, then we add surcharge. So we're in the surcharge step now. Now surcharge is nothing but the rich man's tax. Basically, if your assessee's income is way high, if assessee's income is very very high, if he's a rich man, it will not affect him if I ask him to pay little extra tax. But every little extra tax which government gets is revenue for the government. So government is now putting burden on these rich people, asking them to pay little extra tax. Now that little extra tax is surcharge. Always remember, surcharge is a percentage of income tax. Okay. Now if assessee happens to be an individual HUF, AOP, BOY, AJP, then if the income happens to be within 50 lakhs, then no surcharge. So which means guys, I can say if assessee happens to be an individual HUF, AOP, BOY, AJP, then surcharge will apply only if the income is more than 50 lakhs. Okay. So if income is more than 50 lakhs, but if it is within 1 crore, then surcharge will apply 10% surcharge. 10% of what? 10% of income? No, be careful, silly mistake area. Surcharge is always a percentage of tax. It's not a percentage of income, it's a percentage of tax. Okay. So if my income happens to be more than 50 lakhs but within 1 crore, 10% surcharge. If income happens to be more than 1 crore but within 2 crore, 15% surcharge. Then the fourth situation, be careful. From the total income, I will subtract 3 incomes: dividend income, 111A STCG and all LTCG. I will look at the balance income. If the balance income is more than 2 crore but within 5 crore, then 25% surcharge will apply. But however, be careful, slow down over here. Two silly mistakes are possible over here. Am I subtracting all special rate incomes? Can I use a shortcut? Can I say total income minus special rate incomes? No guys. Even lottery is a special rate income. Do I subtract that over here? No. Dividend is not a special rate income, but I subtract dividend income over here. So don't make one unnecessary shortcut in your mind. Don't tell yourself subtract all special rate incomes. Don't tell yourself like that. It will become wrong. We are not subtracting all special rate incomes. We are subtracting 3 incomes: dividend, 111A STCG and all LTCG. Okay. If assessee comes under this bucket, then 25% surcharge will apply. But on these 3 incomes, 15% surcharge only will apply. Now here, don't conclude for yourself, oh, these 3 incomes always surcharge 15%. No guys, what if I'm falling in the second situation? Then 10% surcharge only now will apply for me. So therefore don't unnecessarily make conclusions for yourself. Simply follow the sequence. I have given a sequence over here. Same sequence you will think. First, if the income is within 50 lakhs, no surcharge. More than 50 lakh within 1 crore, 10% surcharge. More than 1 crore within 2 crore, 15% surcharge. Then if income minus dividend, 111A STCG and all LTCG, if the balance is more than 2 crore within 5 crore, 25% surcharge. But on these 3 incomes, 15% surcharge only. Then if the total income minus same 3 incomes, if the balance happens to be more than 5 crores, then 37% surcharge guys. But on these 3 incomes, same thing, 15% surcharge only. Then if I don't come under any of these situations, then 15% surcharge will apply straight away. Okay, this is in the normal regime. But if assessee is falling in the default regime, everything will remain the same. Only thing is, we don't have the 37% surcharge. In the normal regime, the highest surcharge rate is 37%. But in the default regime, highest surcharge rate is 25%. We don't have 37% surcharge in the default regime. Okay. Even in default regime, if income is within 50 lakhs, no surcharge, which means surcharge will come into the picture only if income is more than 50 lakhs. So more than 50 lakhs within 1 crore, a 10% surcharge will apply. More than 1 crore within 2 crores income, 15% surcharge will apply. Then total income minus same 3 incomes, if the balance happens to be more than 2 crore, 25% surcharge will apply. But same thing, on these 3 incomes, maximum surcharge will be 15% only. Then if assessee is not coming under any of the other buckets, then straight away 15% surcharge. Simple story guys. So points to be remembered. I'll tell you what are the silly mistake areas. Point number 1, you don't subtract all special rate incomes. Dividend is not a special rate income. We still subtract. Lottery income is a special rate income. We don't subtract. So don't think that we will subtract all special rate incomes over here. No. Then silly mistake area number 2, don't think that for these 3 incomes always 15% surcharge. No, because what if I fall in this slab? Then for me 10% surcharge only. So don't make that second conclusion. Then third silly mistake area, in the normal regime, maximum surcharge rate is 37%, but in default regime, maximum surcharge rate is 25% only. Okay guys, this was surcharge for individual HUF, AOP, BOY, AGP. Then, what if my assessee happens to be a firm, LLP or a local authority? Very simple guys, if income is up to 1 crore, no surcharge. Only if income is more than 1 crore, surcharge will apply. And if surcharge applies, it will be 12%. And obviously, 12% of what? Not 12% of income, 12% of tax. Okay. Then what if assessee happens to be a company or a cooperative society? Then it depends. If it's a domestic company or cooperative society, same surcharge rates. If it's a foreign company, it's different. If it's a domestic company or a cooperative society, then on the first 1 crore, no surcharge. If income is more than 1 crore but up to 10 crore, 7% surcharge. More than 10 crore, 12% surcharge. If it's a foreign company, slabs are the same, only the rates will change. Up to 1 crore, no surcharge. More than 1 crore within 10 crore, 2% only. And more than 10 crore, 5% only. Okay. So domestic companies and cooperative societies, 7% and 12% you have. Foreign companies, slabs are the same, only the rates change to 2% and 5%. Okay, then coming to my next point, my rounding off concept. See, what do you round off? You round off two things. Number one, you round off total income and tax, and both you round off to the nearest multiple of 10. You don't round off each head of income. You don't round off GTI. You round off only total income and tax. And there's one more rounding off concept in your syllabus. It will come in 234 ABC. So I'll discuss that with you in advanced tax chapter. For now, only two places of rounding off, total income and tax, and both are rounded off to the nearest multiple of 10. Okay guys, that's it. So this is it with our entire discussion of the basic concepts. Agricultural income, don't worry, I always take agricultural income as a separate chapter altogether. Okay, so here we spoke about the HUF concept, that was important. Then when does SSE pay tax in the previous year itself? 5 situations we had. Don't forget, in the last situation, it is at the discretion of AO. Other situations, it is mandatory. Then we spoke about the basic tax rates, we spoke about rebate, we spoke about surcharge, and we also discussed about cooperative society. Next, we're going to start discussing about residential status and scope of total income. This will be our next chapter for revision. So starting off with our residential status chapter, guys, it's a very, very important chapter, but a very simple chapter. So these kind of chapters have to be your strength, right guys? Where you don't have a lot to study, but you will definitely have a question from here. These kind of chapters have to be your strongest chapters. So with that in my mind, I'm going to give in my best over here. I hope even you sit up straight and try to grasp it as nicely as you can. Come on everybody, let's do this. So first of all, residential status is something you find for each assessee each year. Why each year? Because my residential status can change from year to year. I may be a non-resident in the last year, but I may be a resident in the current year. So it is something which you find for each year, for each assessee. Okay, now first let's talk about individuals. This is the main part of our discussion, guys. If assessee happens to be an individual, I've taught you one sequence of thinking. You always check special provision first. Only if special provision is not applicable, only then you come to the regular provision, guys. Now see, when it comes to residential status of individual, each faculty has their own way of discussing this concept, okay? I'm just putting in front of you what is my method. It's up to you. You can follow whatever is convenient for you. So we generally have a sequence, right? We always try the special provision first, but you can't blindly apply the special provision. You can apply the special provision only if assessee is fulfilling 3 conditions. What are the 3 conditions? Condition number 1, assessee must be an Indian citizen or a person of Indian origin. Condition number 2, assessee must be visiting India in the previous year. And condition number 3, total income minus income from foreign sources, the balance has to be more than 15 lakhs. 3 conditions, tell me again. Assessee has to be an Indian citizen or a person of Indian origin. Then condition number 2, assessee must be visiting India in the previous year. And condition number 3, total income minus income from foreign sources, the balance income has to be more than 15 lakhs. Only if all these conditions are fulfilled, we can enter into the special provision. Even if one condition is not fulfilled, get out, go to the regular provision. Right guys, now if these 3 conditions are fulfilled, if you have entered into the special provision, 2 basic conditions you have. Life is simple. Basic condition number 1, you will check how many days assessee has stayed in India in the previous year. In the previous year, assessee must have stayed in India for at least 182 days. That is your basic condition 1. Then comes basic condition 2. In basic condition 2, in the previous year, assessee must have stayed in India for at least 120 days, and in 4 preceding previous years put together, assessee must have stayed in India for at least 365 days. Now listen to me carefully. How many basic conditions we have? 2. How many have to be fulfilled? We have the word or in between. So how many have to be fulfilled? Any one. Not necessary to fulfill both. Fulfill any one. So I'll be a little smart, guys, in the examination. If the first basic condition is fulfilled, I won't even put in the effort to check the second one, because we have the word or in between, which means fulfill any one basic condition. That is enough. Okay. Then in basic condition 1, you have how many conditions? Only 1 point. What is it 1 point? In the previous year, assessee, you must have stayed in India for at least 182 days. That's all. Simple. But in second basic condition, inside the second basic condition, you have 2 points. In the previous year, assessee must have stayed in India for at least 120 days. And in 4 preceding previous years, we must have stayed in India for at least 365 days. So only if both these points are fulfilled, only then you will say basic condition 2 is fulfilled. Okay guys, so out of the 2 basic conditions, if even one basic condition is fulfilled, then you will say assessee is a resident. If assessee is a resident, then you will apply additional conditions, and you will check whether your resident assessee is ROR or RNOR. In the special provision, we have 3 additional conditions. Additional condition 1 is that basic condition 1 has to be fulfilled. This is additional condition 1. Additional condition 2 is that in 7 preceding previous years, assessee must have stayed in India for at least 730 days. And the third additional condition is that in at least 2 out of 10 preceding previous years, assessee must be a resident. So how many additional conditions do I have? 3. How many should be fulfilled? All 3. Only if all 3 are fulfilled, assessee will become an ROR, which means if even one additional condition is not fulfilled, gone, assessee will become RNOR. Now, please don't attack me in the comment section. See, in your study material, if you notice, you will find 729 days. So don't come at me that, ma'am, you're saying 730 days. Study material is 729 days. In the study material, they have given explanation of who is RNOR. Ulta provision. What I am teaching you is who is ROR. Okay, so same thing only. They are going right to left. I am taking you left to right. That's all. So chill. Okay. So you have which provision are we learning, by the way? Special provision. Inside special provision, how many basic conditions? 2 basic conditions. How many you should fulfill? Any one. If you fulfill any one basic condition, what will you become? Resident. If you become resident, story is over. No. If you become a resident, then you will apply additional conditions. How many additional conditions? 3. How many should be fulfilled? All 3. If all 3 are fulfilled, only then your assessee will become ROR. If even one is not fulfilled, assessee will become RNOR. Okay guys, 3 additional conditions. Tell me one last time. Additional condition 1 is that basic condition 1 has to be fulfilled. Additional condition 2 is that in 7 preceding previous years put together, assessee must have stayed in India for at least 730 days. And the third additional condition is that in at least 2 out of 10 preceding previous years, assessee must be a resident. So with this guys, you're done with your special provision. Now moving on to regular provision. First of all, when do you even come to regular provision? See, you apply special provision only if these 3 conditions are fulfilled. Even if one condition is not fulfilled, then you will come to regular provision. Once you enter into regular provision, basic condition 1 is the same guys. In the previous year, assessee must have stayed in India for at least 182 days. Basic condition 1 remains the same. The second basic condition, in the previous year, assessee must have stayed in India for at least 60 days. This changes. In the special provision, if you see, in the second basic condition, you have 120 days criteria, right? Instead of that, in regular provision, we have 60 days criteria. So in the previous year, assessee must have stayed in India for at least 60 days. And same thing for preceding previous years, 365 days. So 365 days is the same point. Okay, 4 preceding previous years, 365 days, that is same. 182 days is also same. The only thing that changes is in the special provision, we have 120 days, whereas in regular provision, we have 60 days. Okay. And see, the main point remains the same. Out of the 2 basic conditions, if any one basic condition is fulfilled, you will conclude assessee is a resident. Only when both are not fulfilled, then only you will say assessee is a non-resident. Okay. Then if assessee is a resident, what do you do guys? You apply additional conditions and you check whether assessee is ROR or RNOR. In special provision, we had how many additional conditions? We had 3 additional conditions. But in regular provision, we have only 2 additional conditions. Additional condition 1, in the 7 preceding previous years, assessee must have stayed in India for at least 730 days. In at least 2 out of 10 preceding previous years, assessee must be a resident. So are you noticing the 2 additional conditions are common? There is one more additional condition in the special provision, which is basic condition 1 has to be fulfilled. That additional condition you don't have in the regular provision. In special provision, we have 3 additional conditions. In regular provision, we have 2 additional conditions. But the main point remains the same. All the additional conditions have to be fulfilled. Only then assessee is a ROR. If even one additional condition is not fulfilled, assessee becomes RNOR. Okay guys, so this was our entire discussion with respect to residential status of individuals. It's not over yet, but one part of our discussion, the main part of our discussion is over. So special provision, regular provision, 2 provisions we have. Even in special provision, we have 2 basic conditions. Even in regular provision, we have 2 basic conditions. However, in special provision, we have 3 additional conditions. In regular provision, we have only 2 additional conditions. Okay, now listen, there's something very interesting about the second basic condition, guys. So if special provision is applicable for you, in special provision, basic condition 2, you will always check. But in regular provision, whenever you come to basic condition 2, you will pause, check, think. There are 3 situations. If any of these 3 situations are applicable, then basic condition 2 itself gone. It will not apply. I'll repeat again. I have 3 situations. If any of the 3 situations apply, basic condition 2 itself will not apply. But in which provision? Only in the regular provision. In special provision, you will not check all this. In special provision, basic condition 2 will always apply, guys. Only in regular provision, when you come to basic condition 2, you will pause. you will check if any of these three situations are applicable, then basic condition 2 itself will not apply. So only one basic condition will be there in those cases. Okay, what are these three cases? Number one, assessee is an Indian citizen and assessee is leaving India in the previous year. Why is he leaving India? Because he's a crew member of an Indian ship. Second situation, assessee is an Indian citizen. He is leaving India in the previous year. Why? For the purpose of employment outside India. Third situation, assessee is an Indian citizen or a person of Indian origin who is visiting India in the previous year. In the first two situations, Indian citizen, not person of Indian origin. In the third one, Indian citizen or person of Indian origin. In the first two situations, assessee is leaving India in the previous year. But in the third situation, assessee is visiting India in the previous year. So any of these three situations, if applicable, basic condition 2 will not apply. Only basic condition 1 will apply in the regular provision. But you will not check all this in the special provision. Okay guys, till here you are clear. Can we do a nice revision till here? A revision of the revision. Okay, come on. Let's do the main chart first. So if assessee is an individual, you will first try special provision. But you can apply special provision only if three conditions are fulfilled. Assessee must be an Indian citizen or a person of Indian origin. He must be visiting India in the previous year. And total income minus income from foreign sources, that is income from Indian sources, has to be more than 15 lakhs. All the three conditions should be fulfilled. Then only special provision will apply. If even one condition is not fulfilled, get out. Go to regular provision. Okay. Let's say all conditions are fulfilled, which means you will enter into special provision. So once you enter into special provision, basic condition 1 is that in the previous year, assessee must stay in India for how many days? At least 182 days. Second basic condition, in the previous year, assessee must stay in India for at least 120 days, and 4 preceding previous years put together, assessee must stay in India for at least 365 days. Okay. Out of the two basic conditions, even if one of them is fulfilled, assessee will become a resident. Once assessee becomes a resident, you will apply 3 additional conditions. Additional condition 1 is that basic condition 1 has to be fulfilled. Additional condition 2 is that in 7 preceding previous years put together, assessee must have stayed in India for at least 730 days. Third additional condition is in at least 2 out of 10 preceding previous years, assessee must be a resident. If all the 3 additional conditions are fulfilled, then assessee becomes ROR. If even one additional condition is not fulfilled, assessee becomes RNOR. Easy guys, very simple. Then if special provision is not applicable, we will come to regular provision. In regular provision, basic condition 1 stays the same. Previous year, assessee must stay in India for at least 182 days. But when you come to basic condition 2, you will pause, check and think in the regular provision. What are the 3 situations? Situation number 1. Assessee is an Indian citizen who left India in the previous year as a crew member of an Indian ship. Second situation. Assessee is an Indian citizen who left India in the previous year for employment outside India. Third situation. Assessee is an Indian citizen or a person of Indian origin who is visiting India in the previous year. Out of these 3 situations, if even one situation applies, then basic condition 2 will not apply. Only if none of the 3 situations apply, only then basic condition 2 will apply. If basic condition 2 is applicable, then in the previous year, assessee must stay in India for at least 60 days, and 4 preceding previous years put together, assessee must stay in India for at least 365 days. Same thing even over here. If any one basic condition is fulfilled, then assessee becomes a resident. If assessee becomes a resident, you will apply 2 additional conditions. The second and the third one. 7 preceding previous years, at least 730 days. At least 2 out of 10 preceding previous years, resident. If both the additional conditions are fulfilled, assessee will become ROR. Even if one of them is not fulfilled, assessee will become RNOR. Thorough till here guys. Now listen to me. What do you mean by person of Indian origin? In 2 places we have seen person of Indian origin. Here in the pause, check, think, in the 3 situations, there we saw person of Indian origin. Even in special provision, main conditions, even here we saw person of Indian origin. Now person of Indian origin means either I myself or my parents or my grandparents. Total 7 people guys. How 7 people? Individual 1 person. Parents 2, mother and father. Grandparents you will have 4, 2 on mother side, 2 on father side. So total 7 people. Out of the 7 people, minimum one has to be born in India. But if that person is born before independence, can be born in undivided India. Undivided India means India, Pakistan, Bangladesh. Okay, I'll repeat again. 7 people. Who are the 7 people? I myself, my parents, my grandparents. Out of the 7 people, even at least one of them, at least minimum one of them, if they are born after independence, should be born in India. If they are born before independence, they should be born in undivided India. Undivided India means what? Simple. India, Pakistan, Bangladesh. That's all. Okay. So this becomes a person of Indian origin. Okay. Now some extra points here and there. Some small silly mistake areas. Listen to me. You remember in our basic concepts discussion, we spoke about senior citizen. We said he should be an individual, resident and at least 60 years. Then in debate, we said assessee must be an individual, assessee must be a resident. Now in all these places, resident means what? Does resident mean ROR or does resident mean RNOR? Guys, both. Resident is a resident. Resident can be ROR or RNOR. So whenever we talk about resident, like in senior citizen, then in rebate, interest, royalty, FTs, you don't know right now, we haven't discussed. So wherever we have resident condition, in all these places, resident includes both ROR and RNOR. Only thing is, resident does not include non-resident, that's all. But resident will include both ROR and RNOR. This is one point. Then one more point, when we say you should stay in India, at least 182 days you must stay in India. Stay in India means where in India? Does it have to be on land? Not necessary. It can also be in the territorial waters. Territorial waters is also considered as stay in India. But what are these territorial waters? From the coastline up to 12 nautical miles. From the coastline up to 12 nautical miles is called as territorial waters. So if assessee is staying in land, or if assessee is staying within these 12 nautical miles, within these territorial waters, it will be considered as if it is stay in India. Easy guys, okay? Till here thorough. Now listen, come to my next part. When you're counting stay in India, when you're counting how many days assessee has stayed in India, the day on which assessee comes to India, the date of arrival, date of departure, both you will consider as if assessee is in India. So the date on which he comes to India and the date on which he leaves India, both the days you count as if he is in India. But there's a small exception over here. Exception is relating to this CDC concept, guys, continuous discharge certificate. Very simple concept, listen to me. First of all, when does the certificate come into the picture and what is written in the certificate? See, this comes into the picture when your assessee is joining the ship as a crew member of that particular ship. So when he joins the ship, the date of joining is mentioned in the certificate. Also when he exits from the ship, the date of signing off, when is he exiting from the ship, even that date is mentioned in the CDC. So 2 dates, guys. Date when he's joining the ship, date when he's exiting the ship. Now both the dates you will treat as if he's outside India. The ship is going from India to Singapore, let's say. The ship is it's a foreign bound ship. It's going to a foreign country. So now this person is going to be traveling outside India. Generally, the date on which you come to India and the date on which you leave India, both they count as if you're in India. But whatever date is mentioned in CDC, when you join the ship, also when you exit from the ship, whatever date is mentioned in the CDC, I will treat as if those dates you are outside India. Getting my point, guys? So in CDC cases, date of arrival and date of departure, where will I find these dates? In the CDC. Those dates I treat as if you're outside India only. I don't count them as stay in India. But all other cases, arrival and departure date, both I treat as if you're in India only. This was one point. Then listen to my next point. When we say that assessee should have stayed in India for 182 days, it is not necessary you should stay continuously for 182 days. You can stay in bits and pieces, even that is fine. Totally in the entire year put together, you must have stayed in India for at least 182 days. Okay. Then another point. Sometimes in questions, they'll be a little smart, okay. They will say assessee has stayed in US from 5th. Look at this. Assessee has stayed in US from 25th August to 10th November. So if the question says like this, the question is giving you this period as stay in US. So even 25th August you're outside India, even 10th November you're outside India. Now listen to me, confusion will arise over here because we learned that date of arrival and date of departure we will treat as if you're in India. But if the question itself says that this is the period for stay in US, it means 25th August also you're in US, 10th November also you're in US. So both the dates we will treat as if you're outside India. Okay, this is just a interpretation point, interpretation of questions. Not a concept, just a question interpretation point. Then listen to one more thing. In multiple places we have seen the word visit, right? Assessee is visiting India. Visit means what? See, visit means he is coming to India not to settle down. He is coming in and he will go back. He's coming to India only to meet his parents, or he's come to India on a vacation, or he's come to India just to visit some temples, or he's come to India for a marriage function, but he's going to go back. He's not coming to India permanently. He's not coming to India forever. He's coming to India temporarily. That is visit. If the question says assessee is returning to India, then that is not visit. If the question is saying assessee is going to settle down in India, that is not visit. Visit means temporary, vacation, marriage function, coming, attending, going, coming with a return ticket. That is visit. Okay, keep that also in mind. Alright, so returned is not equal to visited. All these are small points, guys, which we see in questions. So I've picked those points from there. Alright, so till here everything is clear for everybody. So individuals we are learning. We will first try special provision. If 3 conditions are fulfilled, we will apply special provision. If special provision is not applicable, we will come to regular provision. So if assessee is a resident, then we will come to additional conditions and all. Accordingly, we will find the residential status of the assessee. Then we learned what is the meaning of person of Indian origin. Then we learned that in a special provision, basic condition 2 will always apply. But in regular provision, when you come to basic condition 2, you pause, check, think. You think whether any of the 3 situations are applicable applicable? If yes, basic condition 2, you will not apply in the regular provision. Then we learned that generally date of coming to India and leaving India both we count as if you're in India. But exception is CDC case. Whatever date is mentioned in CDC, you're outside India. Okay, now listen guys, coming to my next point, extremely important point, the deemed resident concept. See, if assessee is not fulfilling even one basic condition, you will say assessee is a non-resident. If assessee is a non-resident, the story will not end over there. Whenever assessee is a non-resident, you have to make a rule for yourself. Whenever assessee is a non-resident, you will now check if assessee is a deemed resident or not. If assessee happens to be a deemed resident, that is, if assessee is fulfilling these 4 conditions, assessee will become a deemed resident. If assessee is a deemed resident, he will be deemed to be RNOR. Are you listening, everybody? So if assessee is fulfilling even one basic condition, then assessee will become a resident. If assessee becomes a resident, then you will check the additional conditions and all. That whole flow chart, that whole process you will follow. But neither of the basic conditions assessee is fulfilling. Then in that case, assessee will become a non-resident, guys. But if assessee becomes a non-resident, story will not end there. You will come to deemed resident concept. Here you have 4 conditions. If all the 4 conditions are fulfilled, then assessee will become a deemed resident. If he becomes a deemed resident, you will assume he is RNOR. Okay guys, what are the 4 conditions? Condition number 1, assessee should be an Indian citizen. Please notice, we are not talking about person of Indian origin over here, only Indian citizen. Assessee should be Indian citizen, condition 1. Condition number 2, assessee is a non-resident. He's a non-resident, that's why only we are coming to these 4 conditions. Condition number 3, total income, less income from foreign sources, that is income from Indian sources has to be more than 15 lakhs. And condition number 4, assessee is not liable to pay tax in any other country. Like for example, apart from India, assessee is having income only in Dubai. And in Dubai, there is no tax. Understanding? So, apart from India, if you leave India, whichever other country assessee is earning income, in none of those countries assessee has to pay tax. Assessee is not liable to pay tax in any other country. So, if all these 4 conditions are fulfilled, then assessee becomes deemed resident. If he becomes a deemed resident, then he will become RNOR. Okay, so remember, if assessee is a non-resident, you will not close your answer over there. You will come to deemed resident. What are the 4 conditions, guys? Assessee should be an Indian citizen. Condition number 2, assessee must be a non-resident. Condition number 3, assessee must be assessee's total income, less income from foreign sources. The balance, that is income from Indian sources, has to be more than 15 lakhs. And lastly, assessee is not liable to pay tax in any other country. If all these 4 conditions are fulfilled, assessee becomes a deemed resident. And if he becomes a deemed resident, he becomes RNOR. Okay, guys. Now listen, this total income, less income from foreign sources. This point we have seen in 2 places now. Even in special provision, checking whether special provision is applicable or not. Here also we have this condition, guys. The total income, less income from foreign sources should be more than 15 lakhs. Even in deemed resident, here also we have the same 15 lakh condition, same condition. Now let's talk about this discussion, this calculation, that how do you do this 15 lakhs calculation? We are saying that total income minus income from foreign sources has to be more than 15 lakhs. Now imagine, total income bucket. From that, if you are removing income from foreign sources, what will you be left with? You will be left with income from Indian sources. Don't you dare say Indian income. It is not Indian income. See, total income, one bucket of total income I am having. This total income will have income from Indian source also. It will have income from foreign source also. So from this total income, if I remove income from foreign source, what will I be left with? I will be left with income from Indian source. It is not the same as Indian income. So please start correcting your way of answering. It is not Indian income. It is income from Indian source. Okay. Now income from Indian source means what? See, listen to me. If you are wondering that ma'am, why all this overacting? Ma'am, what is the difference? Why can't we call it Indian income? Listen to me. Indian income means what? Indian income means either the income is earned in India or the income is received in India. Now, earned in India is also called as accruing in India, also called as arising in India, also called as source in India. So, when I say income from Indian source, I am only talking about income which is having source in India. So, are you noticing Indian income means 2 things? But income from Indian source means only one thing. Which thing? Income which is earned in India, accruing in India, arising in India, or having a source in India. So basically, guys, income which is received in India, even that is called as an Indian income, but received in India is not called as income from Indian source. Income from Indian source means income which is earned in India. Like for example, you're earning rental income from a house in India. So that rental income will be an income from Indian source. You're earning dividend income from shares of an Indian company. The dividend income will become income from Indian source. So Indian income means either the income is earned in India or the income is received in India. Income from Indian source means income is earned in in India. Okay guys, so income from Indian source generally means how many things? It means only one thing. But however, for the purpose of this 15 lakh calculation alone, income from Indian source will mean three things. Are you listening to me, everybody? See, total income less income from foreign sources, that is nothing but income from Indian source. This has to be more than 15 lakhs. Income from Indian source generally means only one thing. But for the purpose of this 15 lakhs calculation alone, for this purpose alone, income from Indian source will mean three things. Number one, of course, this first point, income which is earned in India, accruing in India, arising in India, source in India. Then we will also take business incomes from businesses which are controlled in India and professional incomes from professions which are set up in India. Okay, so incomes which are received in India, I don't take in income from Indian source, neither in my general discussion nor in this 15 lakh calculation. Income which is received in India we don't consider. Income from Indian source is generally one thing, which is income earned in India. But in this 15 lakh calculation alone, income from Indian source will be three things. Now, number one, of course, income which is earned in India. Then apart from that, business incomes from businesses controlled in India and professional incomes from professions set up in India. Okay, now as soon as you see this, something will come to your mind. R and OR will come to your mind, but please keep that as a separate discussion altogether. R and OR, what incomes are taxable, that is separate. This 15 lakh calculation is separate. Okay, and one more thing, remember guys, when you're doing this 15 lakhs calculation, it is not just income from Indian source, it is total income from Indian source. So which means if any chapter 6A is possible, please subtract chapter 6A also. If assessee is having losses, please adjust the losses also. Okay, so we're doing this 15 lakhs calculation, it is not just income from Indian source, it is total income from Indian source, total income, which means you have to subtract chapter 6A, you also have to adjust losses if possible. Okay guys, so till here are we clear? This last part of the discussion, two things we learned. We learned if assessee is a non-resident, we will not close our answer over there, we will go ahead and apply 4 conditions and we will check if assessee is a deemed resident. If all the 4 conditions are fulfilled, assessee will become a deemed resident. If he becomes a deemed resident, we will treat him as if he is R and OR. Okay, this is the first big thing we learned in the second part now. Then one more thing we learned, whenever we do this 15 lakhs calculation, we say total income less income from foreign sources has to be more than 15 lakhs. That is, in simple words, we are looking at income from Indian sources. Income from Indian sources has to be more than 15 lakhs. Now, income from Indian sources generally means only one thing, and that is income which is earned in India. But for the purpose of this 15 lakh calculation alone, income from Indian source will mean three things. We will also consider business incomes from businesses which are controlled in India and professional incomes from professions which are set up in India. Okay guys, crystal clear? That's it. This is our entire discussion about residential status of individuals. You learned your main chart. Then you learned 3 situations in which basic condition 2 will not apply in the regular provision. Then you learned who is person of Indian origin. Then we learned generally day on which assessee comes to India and leaves India, both you treat as if he is in India. But CTC exception you learned. Then you learned about deemed resident, and then you learned about this 15 lakhs calculation. Okay. Now listen, coming to our next discussion, residential status of HUF. This is very simple guys. Individual part only is time taking and little effort consuming, but this is going to be simple. Residential status of HUF, Hindu undivided family. You will simply see where is this HUF being controlled and managed from. Where are the decisions being taken? If the control and management is even little bit in India, that's all guys, HUF will become resident. Which means only if the control and management is 100% outside India, only then your HUF will become non-resident. Are you understanding? So listen guys, let's say control and management is 0% in India. Then your HUF will definitely become non-resident guys. What if the control and management is 1% in India? Which means some control and management is in India, HUF will become a resident. What if 50% of the control and management is in India, 50% is outside India? Again, HUF will become a resident because at least some control and management is in India. What if 100% of the control and management is in India? Again, HUF will become a resident. That's why I was telling you, HUF will become a non-resident only if 100% control and management is outside India. That is, 0% control and management is in India, then only HUF will become non-resident. Otherwise, even little bit control and management, if it is in India, HUF will become a resident. Now, if HUF becomes a resident, then how will you know whether HUF is ROR or RNOR? That will depend upon the Karta guys. So which means, are you noticing whether HUF is resident or non-resident? For this, I don't care about the karta. For this, I only care about control and management. But if HUF is a resident, now is HUF ROR or RNOR? That will depend upon the karta. If the karta is fulfilling two additional conditions, we have two additional conditions, right? Additional condition number 1 is that in 7 preceding previous years, a assessee must stay in India for at least 730 days. And the second additional condition is that in at least 2 out of 10 preceding previous years, assessee must be a resident. So if the karta fulfills both of these additional conditions, then HUF will become ROR. If even one additional condition karta doesn't fulfill, then HUF will become RNOR. Understanding? So once a HUF is resident, is it ROR or RNOR? That depends upon the karta. See, whether the karta is resident or not, I don't care. I will straight away apply these two additional conditions on the karta. Whether karta is coming under regular provision, special provision, I don't care. Whether karta is resident, non-resident, I don't care. I will straight away apply these two additional conditions on the karta. If he fulfills both of them, HUF will become ROR. Got it, guys? Yes, that's it. This was about the residential status of HUF. Then coming to residential status of firm, AOP, BOY, AJP, local authority. This is very simple, guys. Very similar to what we learned even under HUF. If the firm, AOP, BOY, as the case may be, if the control and management is even partly in India, then it will become a resident. Only if the control and management is fully outside India, it will become a non-resident. It's the same thing that we had learned for HUF. But however, there's a catch. Listen to me, guys. If assessee is a non-resident, then you think about deemed resident. You do this for which assessee? This is only for individual assessee, not for anybody else. If assessee happens to be a resident, then you will check ROR and RNOR, you check additional conditions and all. This you do for which assessee? This you do for individual and for HUF. For nobody else, which means if assessee happens to be a firm, AOP, BOY, AJP and all, then resident or non-resident, that's all. The story ends over there. If non-resident, you will not come to deemed resident and all. If resident, you will not come to ROR, RNOR and all. Story ends over there. Very simple now, isn't it? If the control and management is even partly in India, the SSE will become resident. If resident, nothing, there's no discussion about ROR and RNOR. If control and management is fully outside India, then it will become a non-resident. Story over. Okay, so does it matter to you now what is the residential status of the partners of the firm? Does it matter to you now what is the residential status of the members of the AOP or BOY? It doesn't matter. The residential status of members is irrelevant. Only thing that is relevant is where is the control and management happening from. Got it, guys? This is about the residential status of firm, AOP, BOY, AJP. Now coming to the last person, company. Company's residential status. This is very important and very interesting. See, a company, whether it is a resident or not resident. First, you will see, is it an Indian company or is it a foreign company? That is a company incorporated in India, then in that case it will become an Indian company. Or if it is incorporated outside India, in which case it will become a foreign company. If it's an Indian company, you won't check anything, guys. You will straight away conclude it's a resident. That's all, story over. But if it's a foreign company, then you will check where is the poem of the company, that is, where is the place of effective management? What is the place, where is the place where key managerial and commercial decisions are taken for the company? If the poem happens to be in India, then that foreign company will become a resident. If the poem happens to be outside India, then that foreign company will become non-resident. Okay, so if it's an Indian company, nothing to check. Straight away I will conclude resident. If it's a foreign company, I will check where is the poem. If the poem is in India, then that even though it's a foreign company, it will become a resident. But if the poem is outside India, then the foreign company will become non-resident. Simple. Even over here, the residential status of the shareholders, residential status of the directors, all that is irrelevant. It all depends upon two factors, Indian company, foreign company and poem. Okay guys, now looking at this flowchart, can I say that a foreign company will not always be non-resident? Yes, isn't it? Because if it's a foreign company, even though it's a foreign company, if the poem is in India, it will become a resident, guys. So just because it's a foreign company, because of that reason alone, you can't conclude it's a non-resident. Even though it's a foreign company, it can be a resident. Okay, now come on, to get even better understanding, look at this small chart. I am an Indian company and I have poem in India. See, if it's an Indian company, I don't care where is the poem, whether the poem is in India, whether the poem is outside India, doesn't even matter. It's an Indian company. It has to be resident only. Story over. If it's a foreign company with poem in India, even though it's a foreign company, because poem is in India, it will become a resident, guys. Then if it's a foreign company and even poem is outside India, then it will become a non-resident. So only in one situation the company will become non-resident. What is that situation? That company will be a foreign company and the poem also will be outside India. So neither is it an Indian company nor is a poem in India. Then only it will become a foreign. Then only it will become a non-resident. Otherwise, either if it's an Indian company or if poem is in India, it will become a resident. Got it? Yes. So this was our discussion on the residential status of all the SSEs. We spoke about the residential status of individual. Separately, we learned the whole chart. Then HUF we learned separately. Then firm, AOP, BOY, AGP, local authority we learned together. And now we spoke about company. Okay. Now tell me. I'll ask you one question. For dash companies, the tax rate is 35%. For dash companies, the tax rate, if 115BAB is applicable, then 15% plus 10% surcharge. If 115BAA is applicable, then 22% plus 10% surcharge. 2 years back turnover, if it is within 400 crores, then 25% tax, otherwise 30% tax. Fill in the blanks. For which company should I say 35% tax? Should I say non-resident company? No, foreign company. If it's a foreign company, whether it's a resident, whether it is a non-resident, I don't care. If it's a foreign company, tax rate is 35%. Then if it's an Indian company, if it's a domestic company, the tax rates will be these four. Remember, in a basic concepts chapter, we had learned the tax rate. Basically, what I'm trying to tell you is the tax rate does not depend upon the residential status of the company. No, the tax rate depends upon is it an Indian company or a foreign company. If the company is incorporated in India, it will become an Indian company. If it is incorporated outside India, it will become a foreign company. So the tax rate does not depend upon resident company, non-resident company. No, because foreign company guys can be resident also can be non-resident. No, it can be both, doesn't matter. So that is why the tax rate of a company does not depend upon resident or non-resident. The tax rate of a company depends upon Indian company or foreign company. That is, it will depend upon the place of incorporation. If it is incorporated in India, the company will become an Indian company. If it is incorporated outside India, it will become a foreign company. If foreign company, tax rate will be 35%. If Indian company, 4 options we had, remember, 15%, 22%, 25% and 30%, 4 options will apply. Got it? So this is it guys with our entire discussion on residential status, and now let's spend some time to quickly revise scope of total income. See, assessee can be a resident or assessee can be a non-resident. If assessee happens to be a non-resident, only Indian income will be taxable for the assessee. If assessee happens to be a resident, assessee can be ROR or RNOR. For ROR, global income will be taxable, which means Indian income, foreign income doesn't matter, all incomes will be taxable. But if assessee is an ROR, Indian income will anyways be taxable. In addition to that, business income from businesses controlled in India and professional income from professions set up in India, all of this will be taxable. Please understand, please remember that if it's Indian income, doesn't matter what is the residential status of the assessee, Indian income will be taxable for all assessees. Okay, so for non-resident, only Indian incomes. For ROR, all incomes, Indian income, foreign income, doesn't even matter. For RNOR, Indian income is anyways taxable. Also, business incomes from businesses controlled in India and professional incomes from professions set up in India. Got it, guys? So this is it about our discussion of scope of total income. Now a question will arise that what do you mean by Indian income? This, just some time back only, I had told you about this. Indian income means two things. Number one, income which is earned in India, and number two, income which is received in India. So the income is either earned in India or if it is received in India, even one, either earned in India or received in India, then it will become Indian income. Okay, and you know, right, in questions sometimes they'll give you past incomes. You will ignore past incomes because past incomes belong to some past year. So tax those incomes in the past year. Don't trouble me now. Similarly, remittances, even remittances we ignore. Like for example, let's say I have a house property in New York, okay, and I received the rent also in New York. Then after receiving the rent in New York, I remitted that rent to my Indian bank account. Now, can I say that the rent is received in India? See guys, where is the source of the rent? The house is situated in New York. Source is outside India. Where is the rent received? It is received also in New York, outside India. Now, after receiving the rent, what are you doing with it? You are remitting it to an Indian bank account. This becomes irrelevant information. Right guys? So you only see where is the source of the income and where is the income received. You only look at the first instance of receipt. After receiving the income, where are you remitting it? To whom are you remitting it? For what purpose are you using it? I don't care about it. So remittances we always ignore because we only look at the first receipt and not the second instance. We always look at only the first instance of receipt. So remittances we ignore. Even past incomes we ignore because they are not incomes of the current year. Okay guys, now let's move on. We will compare three terms now. We get very often confused between these three. Indian incomes, incomes earned in India, and incomes from Indian sources. You shouldn't be having much difficulty over here because we already spoke about this just some time back as well. So Indian income means either the income is earned in India or the income is received in India, guys. It becomes Indian income. Now, income earned in India is nothing but this first point over here, income which is earned in India or arising in India or accruing in India or having a source in India. Then for the 15 lakhs calculation, in two places you have 15 lakh calculation, one in special provision and the other in deemed resident. In 15 lakh calculation, you need income from Indian source. That is total income minus income from foreign sources is nothing but income from Indian source. Now, income from Indian source is generally only one thing, that is income which is earned in India. But for the purpose of the 15 lakh calculation, it will be three things. Not only will you take income which is earned in India, you will also consider business incomes from businesses controlled in India and professional incomes from professions which are set up in India. Got it, guys? We had already learned this, just showing it to you once again that Indian income is two things, incomes earned in India or received in India. Income earned in India is just this first thing over here, income which is earned in India or arising in India or having a source in India. Then for the 15 lakhs calculation, we don't need Indian income. For the 15 lakh calculation, we don't need income which is earned in India. For the 15 lakh calculation, we need income from Indian source. Income from Indian source is generally only one thing, but for the purpose of the 15 lakhs calculation alone, income from Indian source will be three things, okay? Keep in mind, when you're doing this 15 lakhs calculation, okay, if an income is only received in India, you will not take it. Because if an income is received in India, yes, it will become an Indian income. But when an income is received in India, it doesn't fit under any of these three. So it will not be an income from Indian source, okay. So that received point is going to be a point to remember, that when you're talking about Indian incomes, yes, you will consider incomes which are received in India also. But when you're calculating income from Indian sources, you will consider only these three incomes which do not include incomes which are received in India. So be careful about the received point, okay. Then this I've already told you that Indian incomes will be taxable for all assessees, ROR, RNOR, NR, doesn't matter. Then if income accrues in India, you don't see, if the income is accruing in India, that is if the income is earned in India, then it becomes an Indian income, guys. You don't care where is it received. You will straight away say it is Indian income and you will conclude taxable for all assessees. But if the income is accruing outside India, don't conclude it's a foreign income. If it is accruing outside India, check where is it received. If it is received in India, then again it will become an Indian income. And if it becomes an Indian income, it will be taxable for all. So if income accrues in India, then no need to even check where is it received. But if it is accruing outside India, then I will check whether it is received in India or not. Accordingly, I'll give my answer. Okay, then look at this one, guys. Profit from business in Canada, controlled from Delhi. These kind of transactions, guys, be very careful when you're reading the question, okay? Profit from business in Canada. Where is the business? Business is in Canada. So the source of the income will be in Canada. The source will be outside India. But you remember, right, when you're doing the calculation for RNOR, you also consider business incomes from businesses which are controlled in India. Also, when you're doing this 15 lakhs calculation, you consider business incomes from businesses controlled in India. So for these two purposes alone, for RNOR purpose and also for the 15 lakhs calculation purpose, for these two purposes alone, where is the business controlled from will become relevant. If the business is controlled from India, even when you're calculating for RNOR, you will consider the income. Also, when you're doing the 15 lakh calculation, you will consider the income. Okay, guys. So where is the source of the income? Where is the source of the business income? It depends upon where is the business. Business is in Canada, so source is outside India. Source is in Canada. Then where is the business controlled from? This control point is relevant only in two places. Number one in RNOR and number two when you're doing the 15 lakh calculation. Now listen to me. One small thing, okay. Many a times students think that the RNOR calculation and the 15 lakhs calculation are the same. They are not the same, guys. See, for RNOR, what do you tax? You tax Indian income. Indian income means either the income is earned in India or the income is received in India. Then you also tax business incomes from businesses controlled in India and professional incomes from professions which are set up in India. You tax all this for RNOR. In the 15 lakhs calculation, you're looking at income from Indian sources. Income from Indian sources is generally only one thing, and that is income which is earned in India. But for the purpose of the 15 lakh calculation, it means three things. You will also consider business incomes from businesses controlled in India and professional incomes from professions which are set up in India. Are you noticing where am I taking you? Are you grasping what I'm trying to convey to you? In RNOR calculation and in the 15 lakh calculation, yes, there are some common points. We do consider income which is earned in India. We do consider business income from businesses controlled in India. We do consider professional incomes from professions set up in India. There are some common points, but there is also one difference. Income which is received in India becomes an Indian income and it will be taxable for RNOR. But incomes which are received in in India, we don't consider those incomes in the 15 lakhs calculation. Are you understanding? So don't have this conclusion in your mind that RNOR calculation and 15 lakh calculation are the same, because they are not the same, guys. Small points. This is what impacts your answer when you're solving. So remember this pro tip, guys, and I bet you will not go wrong. These little things only will make life easy for you in direct tax. Now come on, let's move on to our next discussion, interest, royalty and FTS. Now this is one such concept which I know that you are not very comfortable in, and who also knows this? The examiner. So correctly, whenever he wants to give you a tricky question paper, he will nicely test you on this. So therefore we are not going to compromise over here. Come on guys, sit up straight, no tension, listen to me with a calm mind. Interest, royalty and FTS, what are we learning right now about this? We are learning where is this income accruing. We are learning what is the place where this income is being earned. Okay, so we are not trying to understand whether it is Indian income or foreign income. We are trying to learn over here where is the income accruing. What is the place of accrual of this income? Okay, one pro tip you remember even over here, and the pro tip is it all depends upon who the giver is. If you start with the giver, your entire answer will fall into place. So your starting step would be to check who the giver of the income is. Which income? Interest, royalty, FTS. See, the person who is giving the income I'll put on this side of my diagram, and the assessee who is receiving the income will be on the other side. In my entire discussion of interest, royalty, FTS, my assessee is not the person who is giving the income. No, my assessee is a person who is receiving the income. My assessee is a person who is earning the income. So for this assessee who is earning this income, where is the source of the income is what we're trying to understand. Where is the source of the income? It is going to fully depend upon who the giver is. If the giver is central government or state government, nothing to think, guys. No if, no but, no condition, no exception, nothing. If central government or state government is a giver, then the assessee who is earning this interest, royalty or FTS, for this assessee, this income will be accruing in India. Nothing else to check. Income will accrue in India. Okay, if it accrues in India, it will become Indian income, and if it becomes an Indian income, it will be taxable for all my assessees. Right, guys? Then coming to my second situation. In my first situation, central government or state government was a giver. In my second situation, resident is a giver. See, I have drawn two diagrams for resident, okay? One, resident is giving interest, and second, resident is giving royalty or FTS. We'll go one by one. If resident is giving interest to the assessee, why is resident giving interest first of all? Assessee would have, of course, given some loan to the resident, guys. That is why he is giving interest now. So if resident is giving interest, your first answer will be accruing in India. Come on, guys, resident is giving interest. So your first answer will be interest is accruing in India. But there are two exceptions. If the resident is using this loan for a business or profession outside India, if the resident is using this loan to buy some source of income outside India, like for example, he is using this loan to buy some asset outside India, he is using this loan to buy some house outside India, in these two exceptional cases, that interest income will accrue outside India. For whom? For my assessee who is earning the income. For the assessee who is earning the income, this interest income, where is the source we are trying to understand. If resident is a giver, your first answer will be accruing in India. Your first answer will be sources in India. But if any of these two exceptions are applicable, then you will conclude sources outside India. Okay. But however, if it is royalty or FTS, similar answer only. Resident is giving you royalty or FTS, your first answer will be accruing in India only. Same thing, guys, two exceptions you will have. If the royalty or FTS is relating to a business or profession outside India, or if it is relating to some source of income outside India, then you will conclude it is accruing outside India. Now see, if it is accruing outside India, can you conclude it is foreign income? No. We discussed over here. If it is accruing outside India, you will not conclude it as foreign income. Then you will check where is the income received. If it is received in India, then it will become Indian income. No. So just because that's why when I started this discussion, I told you that through this discussion, I'm not teaching you what is Indian income, what is foreign income. No. I am discussing with you where is the income accruing. If the income is accruing in India, it immediately becomes Indian income. But if the income is accruing outside India, then you will check where is it received. Only on that basis you will give your answer. Okay, guys, so we discussed about central government, state government and resident. So the assessee who is earning the income, for this assessee, where is the source of the income? It depends upon the giver. If giver is central government or state government, you will immediately conclude income is accruing in India. That's all. If the giver is resident, your first answer will be accruing in India, but two exceptions. If the transaction relates to a business or profession outside India, or if the transaction relates to some source of income outside India, then you will conclude that the income is accruing outside India. Then comes the hero of our discussion, non-resident. What if non-resident is giving you interest, royalty, FTS? Let's talk about interest first and later royalty, FTS. If non-resident is giving you interest, of course, guys, total ulta of resident. If non-resident is giving you interest, your first answer will be that the income is accruing outside India. But see, we have exceptions, guys. When we spoke about resident, we gave two exceptions. Similarly, even over here, there should be exceptions. Everywhere there are two exceptions. But when non-resident is giving interest, we have only one exception. If the loan is being used by the non-resident for a business or profession in India, India, then that interest income will be accruing in India. So everywhere you have two exceptions, but non-resident interest you have only one exception. Then what if the non-resident is giving you royalty or FTS? Same thing guys, your first answer will be what? Non-resident is the person who's giving the income, non-resident is a giver, so your first answer will be that the income is accruing outside India. Then everywhere you have two exceptions, so same two exceptions I will apply even over here. If the transaction is relating to a business or profession in India, or if the transaction is relating to a source of income in India, then you will conclude that the income is accruing in India. Okay, so everywhere you have two exceptions, but central government, state government is a giver, here there are no exceptions, and non-resident is giving interest, here you have only one exception. Okay guys, so the best way to handle this interest royalty FTS is your starting point. If your starting point is who the giver is, then everything else falls into place. So for the assessee who is earning the income, where is the source of the income? It is depending upon who the giver is. Okay, so everywhere there are two exceptions, only non-resident plus interest we had only one exception. Alright guys, now listen to my next point, dividend. If where is the source of dividend income? That's our next question. Where is the dividend income being earned? Where is this place of accrual? It fully depends upon which company is declaring the dividend. It has, like for example, if the company declaring the dividend is an Indian company, if dividend is from an Indian company, the income will accrue in India. If the dividend is from a foreign company, the dividend will accrue outside India. Now same thing, if it is accruing in India, you will conclude it is Indian income and you will say taxable for all. But if it is accruing outside India, you can't say it's a foreign income. Now you will check where is the income received. Only if it is received also outside India, only then it becomes a foreign income. But if it is received in India, it will become Indian income and it will become taxable for all. So be careful. Okay. Then comes salary. Where does salary accrue? Salary generally accrues in the place wherever you're rendering your services. Like for example, if I'm rendering service in India, the salary income will accrue in India. But there's an exception guys. In that exception, there are three conditions guys. Condition number 1, the assessee is an Indian citizen. Condition number 2, employer is government of India. Condition number 3, the assessee is rendering services outside India. Now, even though he is rendering services outside India, still his salary income will accrue in India. Basically, we're targeting ambassadors and embassies and representatives and all. So let's say there's a person who's representing India in Australia. So he's rendering service in Australia, but then he's an Indian citizen and he's employed by the government of India. He is rendering services in Australia, which is outside India, but still the salary income will be deemed to accrue in India. So generally, salary accrues wherever you're rendering services. But however, if assessee is an Indian citizen, employer is government of India, then even though he's rendering services outside India, still the salary will be accruing in India. In this exceptional cases, listen carefully now. Salary, allowances, perquisites, everything will accrue in India. After accruing in India, salary alone will be taxable, allowances and perquisites will be exempt. Everything will first accrue in India. After accruing in India, salary alone will be taxable and allowances and perquisites only will be exempt. And this exemption will be in both the regimes guys. Generally, you know, right, in the default regime, allowances you don't get exemption. But however, this will stay the same under both the regimes, whether normal regime, whether default regime, this exemption you can enjoy. So this was a discussion about salary. So we spoke about interest royalty FTS, we spoke about dividend, and now we spoke about salary. Now listen, there are some special points with respect to non-resident. If a non-resident has a business connection in India, okay, and from this business connection, if he's earning income, that income will be deemed to accrue in India. Business connection, like for example, if he has a shop in India, or if he has a warehouse in India, or if he has a branch in India, or an agent in India, or a factory in India, all of these are examples of business connection. So if a non-resident has a business connection in India, and from that whatever income he's earning, that income will be deemed to accrue or arise in India. Here the most interesting discussion is about agent. Now when it comes to agents are of two types. They may be independent agents or they may be non-independent agents. Now independent agent means that agent is working for multiple principals guys. So if the agent is an independent agent, he will not be a business connection. But if he is not an independent agent, it means he's an exclusive agent. He is working for only one single principal. This kind of an agent will become a business connection. So point number 1, if a non-resident has a business connection in India, from that business connection whatever income he earns, that income is deemed to accrue or arise in India. Business connection includes agent, but it doesn't include every agent. It includes only non-independent agent. So if you're having an independent agent, we will not consider it as a business connection. But if your agent is an exclusive agent, that is he's not an independent agent, then this will be considered as a business connection. So through this non-independent agent, whatever income you earn, that income will be deemed to accrue or arise in India. Okay, point number 1. Second point, if a non-resident, if his only business is coming to India, purchasing goods from India and exporting. He's not doing any manufacturing, he's not doing any processing, he's just coming to India, purchasing goods and exporting. So whatever income he earns from this activity, it is not deemed to accrue or arise in India. Basically, we will treat as if it is not earned in India. Simple, guys. Then comes the third transaction. There's a non-resident again. His only work is coming to India, collecting news and views in India and transmitting them outside India. So he's running a news agency. He's only coming to India, collecting news and transmitting them outside India. So whatever income he earns from this, that income is not deemed to accrue or arise in India. Third transaction. Then comes your fourth transaction. Here a non-resident comes to India, just shoots a movie in India and he goes back. So whatever income he earns from this movie, it's not deemed to accrue or arise in India. For example, let's say Ed Sheeran, he comes to India, shoots a video for his music album and he goes back. So whatever income he earns from this, it is not deemed to accrue or arise in India. Got it, guys? And lastly, there's a foreign company whose business is mining diamonds. Now, this company is earning income from displaying the diamonds. This company is displaying uncut and assorted diamonds in specified zones. Basically, this company is exhibiting diamonds. From the exhibition of diamonds, whatever income they're earning from India, even that income is not deemed to accrue or arise in India. So, 5 special points we learned over here. Number 1, business connection. Whatever income, if you're having a business connection in India, whatever income you earn from that business connection in India, that income is deemed to accrue or arise in India. Second point, if you're a non-resident and if your only work is buying goods from India and exporting, that income is not deemed to accrue or arise in India. Then if you're a non-resident running a news agency, you're simply coming to India, collecting news and views and transmitting them outside India, the income is not deemed to accrue or arise in India. When you're coming to India and simply shooting a movie and going, or you're coming to India and you're just displaying uncut or assorted diamonds, whatever income you earn from all this, that income is not deemed to accrue or arise in India. Got it, guys? That's it. So with this, we're done revising our basic concepts discussion and our residential status along with scope of total income. In residential status, we first spoke about the residential status of each assessee. Then we discussed about the scope of total income, that for which assessee, which income will be taxable. Then we discussed about interest, royalty, FTS, dividend, salary income, and then we saw our 5 special transactions. Now we will start our discussion on agricultural income, guys, starting with some basic points. If assessee is having agricultural income from an agricultural land which is in India, so what's your equation? Agricultural income plus agricultural land plus in India, that income will be exempt under section 10(1). The land can be in urban area, rural area, doesn't matter. Assessee can be resident, non-resident, doesn't matter. Equation is agricultural income plus agricultural land plus in India is equal to exempt under section 10(1). Simple, guys. But if the same agricultural land is situated outside India, then this exemption will not be available. Point number 1. Then what exactly is agricultural income? Agricultural income can be of 3 types, guys. Let's talk about each of them one by one. Let's talk about income derived from agricultural operations first. See, agricultural operations are nothing but whatever the farmer does, basically. So we're talking about the farmer's income over here. It will go under the PGBP head, and if this income is from an agricultural land in India, that income will be exempt. But exempt under which head? Under the PGBP head. Now, what is agricultural operation? Listen carefully. Agricultural operations are of 2 types. Straight away come to this diagram. Agricultural operations are of 2 types. Basic operations and subsequent operations. Now, how will you differentiate between the two? It all depends upon when is the seed germinating. It all depends upon when does the seed sprout into a plant. When does the seed become a plant? So, as soon as the seed sprouts into a plant, you call it a seed germination. So, before whatever you do before the seed germinates becomes basic operation. Whatever you do after the seed germinates becomes subsequent operations. Easy. So, like for example, plowing the soil. We do it before the seed germinates, so it becomes basic operation. Then harvesting is something we do after the seed germinates. It becomes subsequent operations. So, agricultural operations are of 2 types, basic operations and subsequent operations. Whatever you do before the seed germinates becomes basic operation, and whatever you do after the seed germinates becomes subsequent operation. Easy, guys. Now listen, everything you do after seed germinates, everything will not be subsequent operations. We have to put a full stop somewhere or the other. So where are we putting the full stop? When the produce is marketable. Let's take one simple example. You cultivated sugarcane. You did basic operations, then the seed germinated, it sprouted into a plant, then you harvested the sugarcane. Now once you harvest the sugarcane is marketable, guys. So marketable means you can go to the market and you will be able to sell it. So sugarcane is marketable. So till that stage only whatever you did will come under agriculture. Once the sugarcane is marketable, after that you're taking the sugarcane to the factory, you're crushing the sugarcane, you're making sugar out of it, all that will become non-agricultural activity. Understanding, guys? So whatever you do before the seed germinates, basic operations. Whatever you do after the seed germinates, subsequent operations. But the subsequent operation will be considered as agricultural operations only till the produce is marketable. After the produce is marketable, after that whatever you do will not be considered as agricultural activity. So if I'm in the business of growing sugarcane, cultivating sugarcane and manufacturing sugar, then in that case I'm doing both agricultural activity and business activity. Till the sugarcane is marketable, I'm doing agricultural activity. After the sugarcane is marketable, whatever I do becomes my business activity. Okay guys, so this is about our discussion of the first category of agricultural income, which is income from agricultural operations. Now here there's one more thing. Okay, there are two types of agricultural operations. I told you, basic and subsequent. Now basic operations is must, basic operations is mandatory, which means if I do only subsequent operations, it will not be considered as agriculture guys. I have to do basic operations. Either I do only basic operations or I do basic and subsequent operations, only then it will be considered as agricultural operation. If I don't do basic operations, if I just do subsequent operations, it will not be considered as agricultural operation. Okay, then listen, let's talk about the paddy example, very important example. See guys, paddy as such is not marketable. Okay, paddy has to be converted into rice, only then it becomes marketable. So after you cultivate paddy, you have to remove the hay, then you have to remove the chaff, you have to filter the grain to remove the stones, and then you will get rice. You have to pack this rice into gunny bags, and then only you can take them to the market to sell. So only after you do all of these activities, only after you do all of these operations, only then the produce becomes marketable. So therefore everything will come under agricultural operations. Understanding? So basically what I'm trying to tell you through the paddy example is that whatever you do till the produce is marketable, remember we learnt it over here, whatever you do till the produce is marketable, till there only it will be agricultural operation. After the produce is marketable, whatever you do will be non-agricultural operation. So paddy as such, it is not marketable. You have to remove the hay, you have to remove the chaff, you have to filter the grain, pack them into bags, only then it becomes marketable. Only when you convert paddy into rice, only then it becomes marketable. So till that stage, everything will come under agricultural operations. Your income will be agricultural income. Even after the rice is marketable, even after the produce is marketable, if you still do any activities, that will be non-agricultural activities. Okay, then comes my next point, income from sale of trees grown spontaneously. What does this mean? Here I'm talking about those plants guys which grow on their own, like for example mushrooms. Now here you're not sowing the seed, you're not doing any basic operations. Did you hear? You're not doing any basic operations. So there is no human effort involved. Without human effort, the mushroom grows on its own. That is called as plants which grow spontaneously, or trees which grow spontaneously. They grow on their own without any human effort. So here there is no basic operations, and you know very well, if I want to call it agricultural operations, then basic operations is must. So if there are no basic operations, we can't call it as agricultural operations. So therefore whatever income we get from this activity will not be agricultural income. Okay, so any income from trees which grow spontaneously on their own without any human effort will not be considered as agricultural income. Then comes my next point, income from seedlings and saplings. One equation will come into the picture over here. If I'm earning income from seedlings and saplings, point number 1, grown in a nursery, point number 2, and the nursery has to be in India. So income from growing seedlings and saplings in a nursery in India. If these 3 points, if these 3 boxes are ticked for you, then whatever income your assessee earns, that income will be considered as exempt agricultural income. Now in the nursery, whether you're carrying on basic operations or not, that's going to be irrelevant for me. In this situation, whether basic operations are carried out or not is irrelevant. What is relevant is 3 boxes. Growing seedlings and saplings in a nursery in India. So whatever income you earn from growing seedlings and saplings in a nursery in India, that income will be exempt agricultural income, whether basic operations are carried out or not. Okay, so this was our first discussion guys. The first 3 types of agricultural incomes I told you, right? This was the first type of agricultural income, which is income from agricultural operations, nothing but your main agricultural activity. So here remember, basic operations is must, subsequent operations whether you do or not doesn't matter, but basic operations is must. Then whatever you do before the seed germinates is basic operations, whatever you do after the seed germinates is subsequent operations. Now subsequent operations however will be considered as agricultural operations only till the produce is marketable. After the produce is marketable, if you still do activities, it will be considered as non-agricultural income. Then we learned that when it comes to paddy, only when it is converted into rice, only then it becomes marketable. So till that stage it will be considered as agricultural activity only. Then we learned if you have any income from trees which grow spontaneously, they grow on their own without any human effort, which means there is no basic operations. Even this will not be considered as agricultural income because there is no basic operations. And then we learned another equation, income from seedlings and saplings plus in a nursery plus in India, that income will be fully exempt agricultural income. Whether you do basic operations or not will become irrelevant. Okay, so this was our first agricultural income guys. Now coming to the second one. In the second one we're talking about rental income. Rental income from an agricultural land which is used for agricultural purposes. Listen to me guys, it is rental income. Rental income can go to 2 heads. Either it can go into IFHP head or it can go into IFOS head. See, but it can, you can put something in the IFHP head only if there's a superstructure, only there's a building, right? But here I'm earning rental income from a piece of land. From a land, there's no superstructure, so therefore no IFHP head, hence IFOS head. So any rental income you earn from an agricultural land which you're using for agricultural purposes, that rental income itself will be considered as exempt agricultural income. So again you have an equation over here, rental income plus agricultural land plus land has to be in India plus the land has to be used for agricultural purposes. If these four boxes are ticked for you, then that that rental income will be considered as exempt agricultural income. Whether you own the land or whether you have sublet the land, it doesn't matter. You're having rental income from an agricultural land which is being used for agricultural purposes and the land is in India. That's all, guys. It will be considered as exempt agricultural income. Best example, let's say I own a piece of land. It's an agricultural land, but I don't want to do any agriculture over there. So I've given this land on rent to a farmer and the farmer is using that land for agriculture. Now whatever the farmer grows on that land, a percentage of that, let's say 1% of that, the farmer is giving to me as rent. So I'm having rental income. Rental income can be in cash or it can be in kind, doesn't matter. I'm having rental income from an agricultural land which the farmer is using for agricultural purposes. So this rental income will be considered as exempt agricultural income. Of course, the land has to be in India. But however, guys, what if I have an agricultural land and what if I'm giving it on rent and what if the tenant is not using it for agricultural purposes? What if the tenant is using it for other purposes, like what if he's using it for movie shooting purposes? Then in that case, it will not be agricultural income, guys. Rental income from agricultural land will be considered as agricultural income only if the land is being used for agricultural purposes. If it is being used for any other purposes, then it will not be considered as agricultural income. Okay, then what if I have a piece of land, an agricultural land which I've given on rent and the tenant is using the land for grazing of cattle? Grazing of cattle is considered as agricultural purposes, guys. So it will be as if the land is being used for agricultural purposes and hence the rental income will be exempt agricultural income. Simple, guys. So this is my second discussion, my second type of agricultural income where I'm having rental income plus agricultural land plus in India plus the land is used for agricultural purposes. If all these conditions are fulfilled, the rental income will be considered as exempt agricultural income. Under which head? Under the IFOS head. Alright, and remember, whether I own the land or not, it doesn't matter. Whether this rental income happens to be in cash or in kind, it doesn't matter. It has to be rental income from an agricultural land which is used for agricultural purposes. That's all. Then comes my third bucket, income from farm building. Let's talk about this one now. Farm building is a very simple discussion, guys. There are two things in this discussion. Number one, there's a building, and number two, there's a land. Okay, two things. Let's talk about them one by one. Let's talk about the land first. Now this land is an agricultural land. Okay, now where is this land situated? Doesn't matter. Either it can be in urban area or it can be in rural area. But there's one small extra point over here. If it is in urban area, it has to be assessed to land revenue, which means on that land tax should be applicable. So this is one point, that there must be a land. That land has to be an agricultural land. Either it has to be in rural area or it has to be in urban area. If it is in urban area, it has to be assessed to land revenue. Okay, guys. Then I was telling you there are two things, building and land. About land I spoke to you. Let's talk about building now. So there's a building. Now there are two options. Either this building is going to be here, outside the land. Either it is outside the land, but it's not far away from the land. It is near the land. It is in the vicinity of the land. In the vicinity means it is visible from the land. The word vicinity comes from the word visible. It is visible from the land. It is near the land. It is not far away. So either the building is in the vicinity of the land, or one more option, this building can be here, which means a building can be on the land. In the land. So either the building is in the agricultural land or it is in the vicinity of the agricultural land. Okay, guys. So there are two things over here. Both the things are clear. Number one, there's a land. It's an agricultural land. Either it should be in urban area, which is assessed to land revenue, or it should be in rural area. Then number two, there's a building. Either this building is in the land itself or it is in the vicinity. It is near the land. It is outside the land but near the land. Okay. Then another important question comes up, and that is, what is this building being used for? See, this building and this land, there's a connection. What connection? The building is not being used for any random purpose. The building is being used in connection with the land. The building is being used in connection with the land, which means in the land, this land is an agricultural land, right? So here the farmer is doing agriculture and all. So all his equipment, all his seeds, fertilizers and all, he will not keep at home. So he will keep all that in this building. So this building is having connection with this land. From use point of view, the building is being used for the purposes of the land. It is being used as a dwelling house, as a storehouse, storehouse to keep your equipments, to keep fertilizers, to keep the pesticides and all with respect to this land, all that is being kept over here. So it is being used as a storage house or as a dwelling house. Okay guys, so there are three conditions over here. Condition number one, there's a building. Either this building is in the agricultural land or it is in the immediate vicinity of the agricultural land. It is near the agricultural land. Condition number two, there's an agricultural land which is either in rural area or if it is in urban area, it is assessed to land revenue. And third condition, the building is being used in connection with the land. It is being used as a dwelling house or as a storehouse. So if all these conditions are fulfilled, then whatever income we have from this farm building, it will be exempt agricultural income. See guys, there's a superstructure over here. So because it's a superstructure, of course I will think about the IFHP head, but the IFHP in this case will be considered as exempt agricultural income, and hence your answer will be fully exempt. Okay, so these are your three types of agricultural incomes. Your first was income from agricultural operations, basic operations, subsequent operations, all that we discussed. That income will be fully exempt under PGBP head. Then we spoke about agricultural land which have given on rent for agricultural purposes. This rental income will be fully exempt under IFOS head. And now we learned about farm building. I am having a superstructure which is being used in connection with the agricultural land. Now this farm building, because I have a superstructure, it will go into the IFHP head, but under the IFHP head, it will be exempt agricultural income. Okay guys, so this was a discussion about the meaning of agricultural income. Now see, I have some more examples of agricultural income for you. Income from growing flowers, income from growing fruits and vegetables, income from growing bamboo, pasture for the consumption of animals, all this will come under agricultural income guys, which means agricultural income, it is not necessary that you must be growing only things which are for human consumption. They can also be for animal consumption. Basically, you can grow anything which has some consumption utility, which means you can grow anything which if I take to the market, somebody will buy. There must be some marketability, there must be some consumption utility. Then, however, if I'm going to be doing dairy farming or fishery or butter and cheese making or poultry farming, see, no doubt all of this does have some connection with land, but none of this will be considered as agriculture. Dairy farming, that is milkman's business, then fishing, butter and cheese making, poultry farming, none of it will be considered as agriculture. Then if I'm simply going to buy and sell agricultural produce, simply trading in agricultural produce, even this will not be considered as agricultural income. Okay. Then listen, let's say this is a company. The company is doing agriculture. So the company's income will be exempt agricultural income guys. Now the company is going to distribute its profits as dividend to the shareholders. For the shareholder, the dividend income will not be agricultural income. For the company, who is doing agriculture? Company is doing agriculture. So for the company, their income will be exempt agricultural income, but for the shareholder who's getting dividend income will not be agricultural income. However, there's an exception, the partnership firm and LLP. See, we know very well that a partnership firm or an LLP for that matter, it gives three things to the partners guys. Three things. Number one, share of profit. Number two, interest. And number three, salary. Now, share of profit is always exempt for the partners. That's not even a matter of my discussion. But interest and salary are generally taxable for the partners, guys. We learn in PGPP chapter, no, whatever is allowed for the firm, that only will be taxable for the partner. So, interest and salary are generally taxable for the partners. But however, listen carefully. If the firm is doing agricultural business, if the firm is doing agricultural operations, the firm's income will be exempt agricultural income, guys. So, in that case, whatever interest and salary the partners get, even that will be considered as exempt agricultural income. Getting my point? So it's different for companies and different for firms. If company is carrying on agriculture, then company's income is agricultural income, but the dividend income which is being distributed to shareholders is not agricultural income. However, when the firm is carrying on agricultural operations, their income is exempt agricultural income. Also, whatever interest and salary this firm gives to partners, even for the partners, this interest and salary will be considered as if it is exempt agricultural income. Got it. Then we have the partial integration method. I've made a rule for you already. When do you think about the partial integration method, guys? As soon as you see in the question, assessee is having exempt agricultural income, and if they ask you to compute tax, immediately the partial integration method should come to your mind, right? That's a rule I have made for you. If assessee is having exempt agricultural income, and if they're asking you to compute tax, immediately the partial integration method will come to your mind. But if partial integration method is applicable, you will not blindly start applying the method, guys. You will first check the conditions. See, before we go to the conditions, point number one, this partial integration method is also called as aggregation method. Point number two, this method will not impact income computation. It will only impact your tax computation. Then what are the conditions? Before you start applying this method, you have to fulfill some conditions. Condition number one, assessee has to be individual HUF, AOP, BOI or AGP. Condition number two, the net agricultural income has to be more than 5,000. And my last condition, my third condition is that the non-agricultural income of the assessee, that is the total income, the taxable income, has to be more than basic exemption limit. So if only all the three conditions are fulfilled, fulfilled, only then you will apply the partial integration method. Condition number 1, who is the assessee? Individual HUF, AOP, BOY or AGP. Condition number 2, the net agricultural income is more than 5,000. And condition number 3, the non-agricultural income is more than basic exemption limit. So if all these conditions are fulfilled, then your partial integration method will apply. If partial integration method is applicable, 6 steps you generally follow. In your first step, you will see what's a non-agricultural income and what's a net agricultural income, both put together. Agricultural income and non-agricultural income put together. Now on that income, in step 2, you will have to compute tax. When you're computing tax, one silly mistake area is possible over here. What? Listen to me. Inside this non-agricultural income, you might have lottery income also. You might have capital gains also. You might have special rate incomes also. Basically, on that special rate income, you have to compute tax on special rate only. So be careful about that. So step 1 is non-agricultural income plus net agricultural income. Step 2 will be tax on this step 1 income. Then comes step 3. Step 3 will be basic exemption limit plus net agricultural income. Be careful. In step 1, you did non-agricultural income plus agricultural income. In step 3, you're doing basic exemption limit plus agricultural income. Then on this number, you will compute tax. That will be your step 4. Now you're having two tax numbers, guys. Step 4 tax and step 2 tax. You will simply find a difference between these two tax numbers. The difference between these two tax numbers, that will become your basic tax. Once you compute basic tax, your remaining calculation remains the same. Rebate, surcharge, cess, all that remains the same only. That will be your step 6. So your first 5 steps, this is what is unique. This is what comes under partial integration method. Your first step will be net agricultural income plus non-agricultural income. Step 2 will be tax on that. Step 3 will be basic exemption limit plus agricultural income. Step 4 will be tax on that. And the difference between these two taxes will become your basic tax. Okay guys, so this is it about your entire discussion about partial integration method. Then comes composite income. Composite income means the income is having two components, business income component and agricultural income component. Like for example, I'm in the business of growing sugarcane and also manufacturing sugar. So you remember we learned whatever activity I do till the produce is marketable, only till that it is agricultural operation. So once I harvest the sugarcane is marketable. So till that stage only it is agricultural operation. Whatever I do after the produce is marketable, like I'm taking the sugarcane to the factory, crushing the sugarcane, manufacturing sugar, packing it into bags, all that will be non-agricultural activity. So my income will have two components over here, agricultural component and non-agricultural component. So when my income is having two components like this, that income is called as composite income. Now for those composite incomes, for 4 of those composite incomes, the income tax rules itself tell us how to find agricultural income component and business income component. What about everything else? For everything else, we have a different way of computing. I'll come to that. So if it is rubber, if my assessee is in the business of growing and manufacturing rubber in India, rubber grown and manufactured in India, then 65% of the income will be exempt agricultural income and 35% of the income will be taxable business income. Then if assessee is in the business of growing and curing coffee in India, he is not manufacturing coffee, he is only growing and curing coffee in India, then 75-25. If assessee is in the business of growing and manufacturing coffee in India, that is, he is growing, curing, roasting, grinding, he is doing everything and he is manufacturing coffee, then in that case 60-40. Similarly, growing and manufacturing tea in India also 60-40. So rubber grown and manufactured in India 65-35. Coffee grown and cured in India 75-25. Coffee grown and manufactured in India 60-40. Tea grown and manufactured in India 60-40. Points to be noted. Silly mistake areas. Silly mistake area number 1. The activity has to be in India. Only then you can call it as composite income. If the activity happens to be outside India, then no agricultural income, guys. Fully business income only. Basically, you remember in section 10.1 exemption, in the initial part itself I told you, you will enjoy exemption only if the land is in India. Right guys? So if the land is outside India, then there will be no component of exempt agricultural income. The entire income will become taxable business component only. Silly mistake area number 1. Silly mistake area number 2. Yes, everybody knows 65-35, 75-25, 60-40, 60-40. Everybody knows this. But in the examination, you will get confused. You will start wondering, okay, 65-35, but is 65 agricultural income or is 65 business income? You're understanding that confusion may arise. So always remember, the bigger number is agricultural income. The smaller number is business income. The bigger number is exempt agricultural income. The smaller number is taxable business income. This was a second silly mistake area. Then comes your third silly mistake area. Be careful. You always have to find the net income first. That net income is what you have to split into agricultural income and business income. I'll repeat again. Like for example, you have your revenue, sale revenue, guys. Then you will have expenses. Some will be agricultural expenses, some will be business expenses, doesn't matter. Subtract everything, find the net income. It is a net income which has to be split into these two numbers. Don't split the revenue, guys, split the net income. From the revenue, subtract agricultural expenses, non-agricultural expenses, find the net income. Net income is what you should split into these two numbers. Got it, guys. Now listen, what if, see, if it is rubber, tea, coffee, we will follow the numbers over here. But what if it is anything else? Like what if it is sugarcane? Our same sugarcane example. What if my assessee is cultivating sugarcane, and then instead of selling the sugarcane, what if your assessee is using that sugarcane to manufacture sugar? Then what will you do? How will you compute? Let's take one numerical example. Assessee cultivated sugarcane. The market value of the sugarcane is 2 lakh rupees. If assessee wants, assessee can go to the market and sell the sugarcane, guys, for 2 lakh rupees. But assessee is not selling. Instead, what he is doing is he is processing that sugarcane into sugar. He is spending another 1,50,000 and he is processing it into sugar, and then he is selling the sugar for 10 lakh rupees. Let's make one small change in this example for us to understand a little better. Assessee cultivated sugarcane worth 2 lakh rupees, right? And let us say for this cultivation, the assessee has incurred expense of 50,000 rupees. So what is assessee's agricultural income, guys? See, he did not sell the sugarcane, but had he sold the sugarcane, he would have sold it for 2 lakh rupees. So this 2 lakh rupees minus what expense has he incurred to cultivate this sugarcane? 50,000 expense he has incurred. So the net 1,50,000 rupees, this will become his agricultural income. Now after this, so till here agricultural activity. Then what did he do? He took this sugarcane to the factory and he produced sugar. He sold the sugar. He sold the sugar for 10 lakh rupees. That will become his revenue. To make this sugar, he had to incur 1,50,000 expense. That expense I'll subtract over here. Then to make this sugar, he first of all needed sugarcane. The sugarcane is worth 2 lakh rupees, guys. So I'll subtract that also. So the net 6,50,000 will become my business income. So basically, you will treat as if my assessee has sold the sugarcane and purchased the sugarcane. In reality, he has not sold the sugarcane, but you will treat, to make it simpler for yourself, treat it as if he is selling the sugarcane. For the agricultural portion, imagine as if he is selling the sugarcane. Had he sold the sugarcane, he would have sold for 2 lakh rupees, and his expense is 50,000 rupees, his cultivation expense. So 1,50,000 will become his agricultural income. Then for the business income, to manufacture sugar, he first of all needs sugarcane. Imagine as if he has purchased the sugarcane. So if he is purchasing, he'll purchase for the market value 2 lakh rupees. That will become his cost. Then his processing cost is 1,50,000. So these are his two costs. And he's selling the sugar for 10 lakh rupees. So 6,50,000 will become his business income. Getting it? So had it been rubber, tea or coffee, you will straight away apply these percentages. If it is anything else apart from rubber, tea and coffee, this is how you will calculate. Let's take one more example. Assessee cultivated mulberry leaves having a market value of 2 lakhs. And let us say to cultivate the mulberry leaves, assessee has incurred an expense of 40,000 rupees, let us say. Then assessee has fed these mulberry leaves to silkworms, obtained silk cocoons by spending 1,50,000 rupees. He then sold the silk cocoons for 10 lakh rupees. Now mulberry leaves as such, they are marketable, guys. So if you want, you can sell the mulberry leaves in the market. So till you cultivate the mulberry leaves, till there it is agricultural operation. After harvesting the mulberry leaves, you're feeding the mulberry leaves to the silk cocoons, to the silkworms. You're obtaining silk cocoons. You're selling the silk cocoons. All that becomes non-agricultural activity, guys. So again here same thing, guys. In reality, my assessee is not selling the mulberry leaves. I will imagine what if he's selling. See, what is this agricultural produce over here? Mulberry leaves. So what if he had sold the mulberry leaves? Had he sold, he would have sold for 2 lakh rupees. This 2 lakh rupees minus what expense has he incurred to cultivate this mulberry leaves? 40,000, guys. So the difference 1,60,000, that will become his exempt agricultural income. Then to sell the silk cocoons, first of all he needs mulberry leaves. I will imagine as if he has purchased the mulberry leaves. If he is purchasing them, he will purchase them at the market value of 2 lakh rupees. That will become his cost. Then he is incurring processing cost of 1,50,000. So these are his two expenses. And then he is selling the silk cocoons for 10 lakh rupees. That becomes his sale revenue. So the net 6,50,000 will become his business income. Okay, so here also there are two components. Till we cultivate the mulberry leaves, till that stage everything will be agricultural operations. After we harvest the mulberry leaves, the mulberry leaves are marketable. So because they are marketable, at that stage my agricultural operations will stop. So after the mulberry leaves are marketable, whatever you do after that, you're feeding them to the silkworms, getting silk cocoons, selling the silk cocoons, all that will become non-agricultural operations. Got it, guys? So this is our discussion about composite income. Then coming to our last discussion in our agricultural income discussion, urban land and rural land. See, when it comes to agricultural income, it doesn't matter whether it is urban land or rural land. It doesn't matter. If you're having agricultural income from an agricultural land which is situated in India, that's all. You will see it is exempt under section 10.1. Whether urban area, rural area, doesn't matter. Now, where does urban area, rural area matters? It matters in our farm building point, guys. In our farm building point, we had learned that the agricultural land, either it should be situated in rural area or it should be situated in urban area which is assessed to land revenue. So here it does matter. Also in capital gains, urban agricultural land is a capital asset, but rural agricultural land is not a capital asset. So especially for the purpose of capital gains in farm building, we need to differentiate between urban area and rural area. That is what we're going to be doing now. How will you know whether my land is situated in urban area or rural area? It's fully a game of population, guys. Let's say there's a municipality. This municipality has a population of more than 10,000 but within 1 lakh. This municipality is definitely an urban area. Around this municipality, for 2 kilometers around this municipality will also be considered as urban area. See, obviously guys, as soon as the Chennai municipal limits are over, immediately right after that does the rural area begin. Immediately after the city is over, do you start finding huts and farms and all? No, there is development around the city also. There is development around the urban area also. That same logic, guys. So not only will my municipality be urban area, around that municipality for 2 kilometers also we will treat as if it is urban area. Similarly, let's say there's another municipality, bigger municipality. This one has a population of more than 1 lakh but within 10 lakh. Now this municipality is definitely going to be an urban area, guys. Now around this municipality for 6 kilometers also it will be considered as urban area. So if your land is situated in the municipality or within 6 kilometers, within 2 kilometers, it will be urban area. If it is situated beyond 2 kilometers, then rural area. Beyond 6 kilometers, then rural area. Okay, then comes my last slab. Let's say this is an even bigger municipality. This time the municipality has a population of more than 10 lakh rupees, guys. In that case, this municipality is definitely an urban area. No doubt about that. Around the municipality for 8 kilometers also, it will be considered as urban area. Which means if my land is situated within these 8 kilometers, it will be treated as if it is urban agricultural land. Only if it is situated at 9 kilometers or at 10 kilometers, which means beyond 8 kilometers, then only that land will be considered as rural agricultural land. Okay, so through my table I'm discussing with you what is urban land. So any land which is not situated in urban area, the remaining lands will become rural land. Okay, so what are the slabs? You're clear with the slabs, guys? So if the population of the municipality is more than 10,000 and within 1 lakh, that municipality is definitely urban area. Around that municipality, up to 2 kilometers also will be considered as urban area. Then if the population is more than 1 lakh but within 10 lakh, that municipality is definitely urban area. Around that municipality, up to 6 kilometers also you will consider it as urban area. If the population of the municipality is more than 10 lakh, the municipality is definitely urban area. Around that municipality, up to 8 kilometers also it will be considered as urban area. And now comes a $1 million question: how will you measure 2 kilometers? Like for example, if this is the municipality, then from here how will you calculate 2 kilometers? How will you calculate 6 kilometers? How will you calculate 8 kilometers? Will it be on the basis of the road? No, this is where General Clauses Act comes into the picture. You will measure distance in an aerial manner. Aerial distance, which means you will measure distance in a straight line on a horizontal plane. Right, guys? Not on the basis of roadways, waterways and all. No, you will just draw one straight line and that's how you will measure the distance. Basically, your crow flying distance. If crow has to fly from point A to point B, crow will not fly only over the road. The crow will fly in one straight line. So we will measure distance also in a straight line on a horizontal plane. The measurement of distance is not on the basis of roadways. Like for example, guys, let us say this is where the municipality ends, okay? And this is where one piece of land is situated. So if I want to know whether this land is situated in urban area or rural area, I want to know, okay? Now if I have to actually travel from the end of the municipality till this land, if I actually have to travel, I have to take the road, guys. And the road is a very crooked road. Let's say we have to take a right over here. Then here we have to take one U-turn. And then we have to come back. And then we have to go like this. Let's say this is how the road is built. If I want to go from the end of the municipality till the land, this is the route I have to take, let us say. Long, lengthy route, guys. This is, let's say, 12 kilometers. But however, if you draw one straight line and if you see between the municipality end, the municipality limit, and between this land, if you draw one straight line, let's say this land is situated at 1.5 kilometers. This gap is only 1.5 kilometers, let's say, if you draw one straight line. But if you go on the basis of road, the road is a lengthy distance. It's a crooked road, let's say 12 kilometers, the distance is. So which distance will you consider? You will consider on the basis of the straight line, 1.5 kilometers. Let's say the municipality's population is 80,000, which means the municipality's population is more than 10,000 within 1 lakh, guys. So up to 2 kilometers, if the land is situated, it will be urban area. Land is situated situated at 1.5 kilometers. Land is situated within 2 kilometers. So this will become one urban piece of land. Getting it, guys? This is how the whole thinking process will be. It will not be on the basis of road, it will be on the basis of one straight line. If you draw a straight line from point A to point B, what is the distance? That is how you will measure distance for the purpose of this urban area rural area discussion. Got it, everybody? You understood what I did, right? Population is 80,000. Population is more than 10,000 within 1 lakh, which means up to 2 kilometers it will be considered as urban area. And here this land is situated at 1.5 kilometers, which means it is situated within 2 kilometers. So therefore this land will be considered as urban area. Got it? That's it. So this was our entire discussion of our agricultural income concept. We spoke about the 3 types of agricultural income. Then we discussed about partial integration method. We spoke about composite income. And then we discussed about urban area and rural area. So with this basic concepts, residential status, agricultural income, all 3 completed. And now we will start with our 5 heads of income one by one. The very first point, the very basic point in your salaries head, who is your assessee? Your assessee has to be an employee. Basically, there must be an employer-employee relationship. Your assessee must be getting salary from the employer. There must be an employer-employee relationship. There must be a master-servant relationship and not a principal-agent relationship. There must be a master-servant relationship. Now, when it comes to MPs and MLAs, they are not employees. We cannot call them as employees of the government. So, therefore, whatever remuneration the MPs and MLAs get, we can't put it under the salaries head, and that is why whatever remuneration they get, we put it under the IFOS head, not salaries head. Then, if you look at the partners of the firm, even they get salary from the firm, guys. They get salary from the firm, remuneration from the firm. But however, between the partners and the partnership firm, there is no employer-employee relationship. You must have learnt in CA Foundation that partners are agents of the firm. There is a principal-agent relationship between the partners and the firm, but there is no employer-employee relationship. Therefore, whatever salary the partners get, we can't put it under the salaries head. It has to go to the PGBP head. So point number 1, you can put a transaction into the salaries head only if there's an employer-employee relationship, that is master-servant relationship. If it's a principal-agent relationship, then the salaries head will not come into the picture. MPs and MLAs, the salaries head will not come into the picture because there's no employer-employee relationship. Instead, whatever remuneration they get, it will go into the IFOS head. Then whatever remuneration the partners of the firm get, even that we can't put under the salaries head because partners, they are not employees of the partnership firm. They are agents of the partnership firm. So even though we use the word salary, still substance over form, there is no employer-employee relationship. Hence, partners' remuneration will come to the PGBP head and not the salaries head. Point number 1. Then comes the second point, foregoing of salary and surrender of salary. Listen, waiver of salary, foregoing of salary, both mean the same thing only. Even contributing salary to a charitable cause, all of these 3 things have the same tax implications. Straight away, let's take an example. Let's say I have earned salary of 10,000 rupees, guys. This is how much I have earned. Now, after earning this much salary, I'm telling the employer, listen, don't give me 10,000. Give me only 8,000. What about the balance 2,000? This balance 2,000 donate towards some charity. So here the question is, what is my taxable salary? Will my taxable salary be 10,000 rupees? Or will it be 8,000 rupees? In my example, I have earned 10,000, but in hand I got only 8,000. But my taxable salary will be the whole 10,000 rupees, guys. Because always understand, it is as if I have earned this 10,000 and then as if I have spent the 2,000. This 2,000 will be an application of income. Okay, so therefore your taxable salary income will be 10,000 only. So even the salary which you waive, even the salary which you forego, even the salary which you contribute to charitable cause, even that's going to be taxable. Even though you're not receiving it, you have earned it. It's your income. After earning the income, you're applying the income. So where are you applying the income? I don't care. You have earned 10,000, so 10,000 is your taxable salary. However, there's an exception. The exception is surrender of salary. There's something called as surrender of salary under Voluntary Surrender of Salaries Exemption from Taxation Act 1961. Here what happens is same thing, guys. You have earned 10,000 rupees salary. You're telling the employer, listen, give me only 8,000. The balance 2,000 you want to surrender to the central government. This you're surrendering to the central government under Voluntary Surrender of Salaries Exemption from Taxation Act. When you do this surrender, who is getting the money? Central government is getting the money. Central government wants to encourage you to do this. Therefore, the Income Tax Act very clearly says that if you surrender your salary to the central government under this act, then on that salary which you have surrendered, on that no tax. The salary which you have surrendered will be exempt. So in this case, you will have to pay tax only on 8,000. Simple, guys. So waiver of salary, foregoing of salary, whole 10,000 you will have to pay tax on. But however, if it is surrender of salary under Voluntary Surrender of Salary Exemption from Taxation Act 1961, under this act, if you surrender salary to the central government, then it's good for the government. Government wants to encourage you to do this. Therefore, the government is saying, listen, if you do the surrender of salary, then on the amount that you have surrendered, you don't have to pay tax. It's going to be exempt. So in my second example, I'll have to pay tax only on 8,000 rupees. Okay, guys. And this was my second point. Now comes to the third point. In your salaries head, your charging section is section 15. Now section 15 says that salary will always be taxed on due basis or receipt basis, whichever is earlier. Either on due basis or on receipt basis, whichever is earlier. Like for example, advance salary for April 26. I have received in 25-26 itself. So when will the salary be due, guys? It will be due in April 2026. But when have I received it? I have received it in 25-26 itself. So here if you see, receipt is earlier. So because receipt is earlier, I will tax it on receipt basis. So when was it received? In 25-26. So in 25-26 itself, it will be taxed. Then later when it is due in April month, April 2026, again we will not tax. So salary will be taxed on due basis or receipt basis, whichever is earlier, and that's all. Story over. Look at my second example. Arrears of salary for March 25 received in previous 25-26. When was the salary due? Here salary is due in March 25. But when are we receiving it? We're receiving it later. We're receiving only during previous 25-26. Okay. So when this happens, when is salary due now? When have I earned the salary? The salary is due in March month itself. But when have I received it? I have received it in 25-26 previous year only. So what is earlier over here? Here due is earlier, guys. March 2025, which means previous year 24-25. So it will be taxed in 24-25. When it is due itself, it will be taxed. Later when it is received, we will not tax it again. Got it, guys? So section 15 says, by the way, section 15 is your charging section, okay? So, charging section for your salary set. So this section says we tax salary on due basis or on receipt basis, whichever is earlier. Simple point. Then we have this grade scale concept, guys. You must have seen this in a lot of questions. So when the grade scale is something like this, what it means, how do you interpret this? What it means is that your assessee's basic salary is going to be somewhere in the range of 60,000 to 78,000. So the range over here will be 60,000 to 78,000. Assessee salary can be anywhere in this range, okay? And every year, and by the way, this is the range of monthly salary. Assessee's monthly salary will be anywhere in this range, okay? Then every year, my assessee will get 1,000 rupees increment in the salary. Like for example, let us say assessee's starting salary is 62,000 rupees per month, okay? And let's say he joined the job on the 1st of February 2024. Now, 1st February 2024 to 31st Jan 2025. This will be the first year, guys. In the first year, his salary will be 62,000 every month. Then second year, that is 1st February 2025 to 31st Jan 2026. This is the second year. Here he will get an increment in the monthly salary. How much increment? 1,000 rupees increment. So in this second year, his salary will be 63,000 per month. Like this, every year his salary will keep changing. It will keep increasing by 1,000 rupees. Every year it will keep changing till it reaches 78,000. That's how you interpret grade scale. Okay. Then I have a small tip for you. Whenever you're calculating the taxable value of allowances or retirement benefits, you will first find the exempt amount. Then you will say received minus exempt balance is taxable. Basically, for allowances and perquisites, you first find the exempt number. Whereas when you're doing the tax treatment of perquisites, here you directly find the taxable value. You don't find the exempt amount and all. But allowances and retirement benefits, you first find what is exempt. Like HRA, you do 3 calculations. Least of the 3 is exempt. Gratuity, you do 3 calculations. Least of the 3 will be exempt. Leave salary, you do 4 calculations. Least of the 4 will be exempt. So in retirement benefits and in allowances, you find the exempt number first. And then you say received minus exempt balance is taxable. But perquisites, like for example RFA, you directly find the taxable value. No question of finding the exempt amount. Okay. Then coming into our allowances discussion, I'll give you a quick revision of the allowances. The whole discussion of allowances generally we split into 5 parts. Okay. In the first part, we're talking only about some 5 allowances. In these 5 allowances, how much is exempt? The number is given in the act itself. Like for example, tribal area allowances, agency area allowance, scheduled area allowance. All the 3 mean the same thing. Here, 200 rupees per month is going to be exempt. Then children education allowance, 100 rupees per month per child will be exempt for maximum 2 children. Children hostel allowance, 300 rupees per month per child will be exempt for maximum 2 children. Transport allowance, 3,200 per month will be exempt only if the employee is blind, deaf, dumb or handicapped. If the employee is a normal employee, then there will be no exemption. Then if the employee is working in the transport sector, like for example, if he's a pilot or an air hostess, or conductor, driver and all, then 10,000 rupees per month or 70% of the allowance received, whichever is lesser, is exempt. If you remember the tip that I just told you, in allowances, we first calculate the exempt number, right? So all these are exemptions. So then you will do simply received minus exempt, balance will be taxable. Okay, so in these 5 allowances, guys, how much you have actually incurred becomes irrelevant. So in these 5 allowances, how much is exempt is given directly in the rules itself. So therefore, you just have to remember these numbers, how much my SSE has actually incurred for these purposes, that is irrelevant. Okay, this is your first part. Don't forget guys, we're learning allowances in 5 parts. This is the first part. In the first part, the exemption amounts are fixed already. Alright, now we will talk a little bit more about children education allowance and children hostel allowance. See guys, this is exempt for only 2 children. In your entire syllabus, you have the 2 children limit only in 4 places. In children education allowance, in children hostel allowance, leave travel concession, which we will be discussing a little later in salaries head only, and tuition fees in chapter 6a. Only in these 4 places we have the limit of 2 children. Nowhere else in our syllabus we have the 2 children limit. Now children education allowance, 100 rupees per month per child is exempt. Children hostel allowance, 300 rupees per month per child is exempt. Sometimes examiner will say combined allowance. Combined allowance will be nothing but children education allowance and hostel allowance combined. So therefore 400 rupees per month per child will be exempt. 100 of education allowance, 300 of hostel allowance, total 400 rupees per month per child will be exempt. Okay. Then remember, when it comes to children education allowance and children hostel allowance, you will get the exemption of 100 per month per child or 300 per month per child, as the case may be. You will get the exemption only if first of all SSE has children. Children should go to school and school has to be in India. SSE should have children. Children should go to school. School has to be in India. Only if these conditions are fulfilled, only then SSE will get the exemption. See, what is the actual fees? How much SSE is actually incurring for hostel? The actual expense I don't care. But SSE must be having children. Children should go to school in India. Only then you will get the 100 rupees per month exemption and the 300 rupees per month exemption. Okay guys, so this is it about a discussion about the 5 allowances. The first discussion, the first part of allowances, where we are having 5 allowances. These 5 allowances doesn't matter how much you're actually incurring, the exemption is straight away given in the rules itself. Now moving on to the second category of allowances. In the second category of allowances, you're having 7 allowances. In these 7 allowances guys, whatever my SSE has actually incurred for official purpose, that only will be exempt. So then received minus exempt, balance will be taxable. Even over here, even in the first part, this is the exempt amount. Then received minus exempt, balance will be taxable. In the second part also, what is going to be exempt? Here there is no fixed amount of exemption. The law simply says that whatever SSE has actually incurred for official purposes will become exempt. Then received minus exempt, balance is taxable. 7 allowances we have over here. What are the 7 allowances? Very simple guys, listen to me. First we have travelling allowance and conveyance allowance. Both are interconnected, travelling and conveyance. Then another T, transfer allowance. Then D, how are you? Daily allowance, helper allowance, research allowance, uniform allowance. Helper allowance is also called as servant allowance, and research allowance is also called as academic allowance. So these 7 allowances, whatever my SSE has actually incurred for official purpose will be exempt. Then you will say received minus exempt, balance is taxable. Okay, so in the first part we had 5 allowances, second part we are having 7 allowances. Now coming to the third part, in the third part we are having HRA. Now when it comes to HRA, I've always asked you to follow the 4-step process. In the first step, you calculate salary for the purpose of HRA. In the second step, you find the actual HRA. In the third step, you find the exempt HRA. And then actual minus exempt, that is received minus exempt. Fourth step, you will get the taxable HRA. Received minus exempt will be taxable. Okay. So the first step, salary. Salary will have 3 components guys. Basic salary, DA forming part, employees turnover based commission. Then second step, you will see what is the actual HRA. Third step, you will find the exempt HRA. To find the exempt HRA, you will do 3 calculations. Out of the 3 calculations, whichever is the least will be your exempt HRA. What are the 3 things? Thing number 1, 50% of salary or 40% of salary. 50% of salary if the assessee is staying in a metro city, that is Chennai, Delhi, Mumbai, Kolkata. Only 4 metro cities. Not Pune, not Bangalore. Only 4 cities, Chennai, Mumbai, Delhi, Kolkata. If the house is situated in the metro city, then 50% of salary. Otherwise 40% of salary. Then actual HRA. And rent paid minus 10% of salary. Out of these 3 numbers, whichever is least. Whichever is least is what? Exempt or taxable? Whichever is least is exempt. Come on guys, my basic tip. In allowances, you first calculate the exempt number. Then only you do received minus exempt, balance is taxable. Right guys, so these are going to be your 4 steps in HRA. You will first do salary, 3 components, then you will find the actual HRA, then you will find the exempt HRA. For exempt HRA, you will do 3 calculations. Out of the 3, you will pick whichever is the least, that will be your exempt HRA, and then received minus exempt will be your taxable HRA. Now listen, a very important point. This exemption you will calculate only if assessee is having rent expense and assessee is following the normal regime. Basically, assessee must have opted out of 115 BAC. Assessee must be following the normal regime. See, if assessee is not even having any rent expense, then no exemption. No exemption means HRA will become fully taxable. Also, if assessee is following the default regime, that is 115 BAC, then no exemption. If no exemption means HRA will become fully taxable. So before you calculate exemption, we made a rule for ourselves. We will first check whether assessee is having rent expense or not. We will check whether assessee is following the normal regime or not. Only after fulfilling these two criteria, then only we will calculate exempt HRA. If assessee is not having rent expense, or if assessee is following 115 BSE, then no exemption. If no exemption, then HRA will become fully taxable. Okay guys, this was your HRA discussion, third part. So 5 categories of allowances I was telling you. In the first category, we saw 5 allowances. For these 5 allowances, how much you're actually incurring, I don't care. Straight away, how much is exempt is given in the rules itself. Then in the second category, we had 7 allowances. These 7 allowances, whatever you are incurring for official purposes, that only is exempt. Received minus exempt, balance is taxable. In the third part, we saw HRA. Now comes the fourth part, entertainment allowance. In entertainment allowance, guys, there are going to be 2 steps in our tax treatment. In the first step, it's going to be taxable. Doesn't matter which kind of employee, for all employees, it will first be fully taxable. This is your first step. Then comes the second step. In the second step, you will get section 16 deduction for the entertainment allowance. To find the section 16 deduction, you will do 3 calculations. Out of the 3 calculations, whichever is the least will become your section 16 deduction. What are the 3 things? Number 1, 5,000 rupees. Number 2, 20% of basic salary. No DA, no commission, nothing. Only 20% of basic salary. And actual entertainment allowance received. Out of these 3 numbers, whichever is the least number will become a section 16 deduction. Okay. But however, there's a however in every place. Listen to me. However, this section 16 deduction you will get only if you're a government employee. Central government, state government doesn't matter, but you should be a government employee. And you will get this section 16 deduction only if assessee is following the normal regime. Because see guys, in normal regime, you have 3 deductions under section 16, right? One is standard deduction, then professional tax, and third is entertainment allowance. But in the default regime, you have only 1 deduction under section 16, and that is your standard deduction. So therefore, if assessee is following the default, if assessee is following the normal regime, and also assessee is central government employee or state government employee, only then you will have section 16 deduction. So once again, no confusion, very simple. Entertainment allowance, first step, fully taxable for all employees. Second step, section 16 deduction. But section 16 deduction you will get only if you are a central government employee or a state government employee and you must be following the normal regime. If you're not a government employee, forget about section 16 deduction. If you're following the default regime, forget about section 16 deduction. Then how to find the section 16 deduction? Very simple. Do 3 calculations. Pick the least of the 3. That's all. You will get your section 16 deduction. What are the 3 things? Number 1, 5,000 rupees. Number 2, 20% of basic salary. And number 3, the actual allowance. So whichever is the least will become your section 16 deduction. Okay guys, so we're learning allowances. We learned the 5 allowances, we learned the 7 allowances, we learned about HRA, and then we learned about entertainment allowance. Now comes the 5th part, the last part of our allowances discussion. If you have any other allowance which we haven't discussed about, like for example, medical allowance, we didn't talk about it anywhere. Lunch allowance, we didn't talk about it anywhere. Telephone allowance, we didn't talk about it anywhere. So if you have any other allowance which we have not spoken about in any of the other parts, all other allowances will be fully taxable without any thinking at all. Got it everybody? So this was our entire discussion with respect to allowances. So we spoke about the first part where we have 5 allowances. In these 5 allowances, how much is exempt is given in the rules itself. So we don't care about the actual expenditure. Then we have 7 allowances. These 7 allowances, whatever you've incurred for official purpose will be exempt. Received minus exempt, balance will be taxable. In HRA, you have your 4-step process. In HRA, you will do the exemption calculation only if first of all assessee is having rent expense and assessee is following the normal regime. Then entertainment allowance, first fully taxable. Then you will get section 16 deduction, but you will get section 16 deduction only if you are a central government employee or a state government employee, and also you must be following the normal regime. And then we learned all other allowances which we haven't spoken about. Everything else will become fully taxable. Thorough guys? Yes. So in our salaries, we first spoke about the preliminary points, then we discussed about grade scale, we spoke about section 15, our charging section, and then we've completed all our allowances. Now come on guys, let's talk about our RPF discussion. See, when it comes to RPF, there are 2 concepts: the employer's contribution, employee's contribution. Okay, I should say 3 concepts: employer's contribution, and interest. So three concepts are there. Let's talk about them one by one. The first concept, employer's contribution. Here totally 5 steps guys. 4 plus 1, 5 steps. First, you will find salary for the purpose of RPF. Same three components which we saw in HRA, basic, DA forming part, employees turnover based commission. Then second step will be the actual contribution, how much employer has actually contributed. Third step will be the exempt contribution, 12% of the salary will be exempt contribution. Then same thing, received minus exempt, balance is taxable. Don't you think the same four steps we saw in HRA also? Even in HRA, my first step was salary for the purpose of HRA. My second step was the actual HRA. Third step was the exempt HRA. And fourth step was received minus exempt, balance is taxable. Same thing even over here. Salary, first step is salary. Second step is actual contribution. Third step is exempt contribution. And fourth step is received minus exempt, balance is taxable. The only thing that changes in HRA and RPF, the only thing that changes is the third step. How do you find the exempt number? In HRA, you calculate three things. Out of the three things, you pick the least, that is exempt. But in RPF, straight away, 12% of the salary. You're finding salary for the purpose of RPF. No, these three components put together. So 12% of that salary will be exempt contribution. Received minus exempt, balance is taxable. Okay, but don't stop over here. It is 4 plus 1. It is 5 steps. So you will get the taxable number not only from step 4, but also from step 5. From both the places, you will get the taxable number. Step 4, till step 4 you've understood, received minus exempt, balance is taxable. Now what is the step 5? I will see how much is employer's contribution to three things: RPF, superannuation fund, NPS. I will see employer's contribution to these three things put together. Put together, is it more than 7,50,000? If it is more than 7,50,000, I will see what is the excess above 7,50,000. The excess is taxable as perquisite. Also, interest on the excess is also taxable as perquisite. So, if the employer's contribution to these three things is more than 7,50,000, then how many things will be taxable? Two things will be taxable. Even the excess above 7,50,000 will be taxable. Also, interest on that excess will be taxable. Both will be taxable. Okay guys, so that is why I'm saying you will get the taxable number with respect to employer's contribution to RPF from two places, from your step 4 also, from your step 5 also. Step 4, nothing but the excess above 12% of salary guys. Whatever is the employer's contribution above 12% of salary, that will be taxable in your fourth step. And in the fifth step, if the contribution is more than 7,50,000, the excess also will be taxable. Interest on the excess will also be taxable. Okay, this was your first discussion under RPF about employer's contribution. Then comes employee's contribution. Here 2 steps guys, only 2 steps. Thing number 1, very simple. Whatever is the employee's contribution, we will get ATC deduction. Then thing number 2, we'll see how much is the employee's contribution to RPF and to SPF as a case may be. Now, is it more than 2,50,000? If it is more than 2,50,000, we will find the excess. Excess is not taxable. On the excess, what is the interest? That interest will be taxable under the salaries head. Understanding guys? So listen carefully. I'll tell you what are the silly mistake areas now. Point number 1, silly mistake area number 1. In employer's contribution, we see how much is employer's contribution to RPF plus superannuation fund plus NPS put together. Is it more than 7,50,000? In employee's contribution, we see employee's contribution to RPF and SPF. Is it more than 2,50,000? Please notice here 7,50,000 number you have. Okay, and here 2,50,000 number you have. Please notice here SAF you have, which is superannuation fund, and this is SPF, statutory provident fund. They are not the same. Okay guys, then one more point notice. In employer's contribution, if the total is more than 7,50,000, excess is also taxable, interest on the excess is also taxable, both are taxable. But in employee's contribution, if it is more than 2,50,000, excess is not taxable, only interest on the excess is taxable. Got it guys? Yes, so see, I've made one small summary for you. When it comes to employer's contribution to RPF, you will do 4 plus 1, 5 steps. Why am I not straight away saying 5 steps? Why am I saying 4 plus 1? Because you will get taxable number from the 4th step also. You will get taxable number from the 5th step also. In the 4th step, what are you doing guys? Whatever is the employer's contribution more than 12% of the salary, the excess above 12%, that is taxable. That is in the 4th step. In the 5th step, we are seeing is the employer's contribution to RPF plus SAF plus NPS put together. Is it more than 7,50,000? If yes, even the excess is taxable, even interest on the excess is taxable. So 4 plus 1, 5 steps in employee's contribution. In employee's contribution, only 2 steps. First step, we allow section ATC deduction. Second step, we will see is it more than 2,50,000. If the contribution is more than 2,50,000, excess is not taxable. Interest on the excess only will be taxable. Now listen, generally the limit is 2,50,000 guys. But how employee's contribution, generally the limit is 2,50,000. But if the employer is not contributing, if the employer's contribution is 0, then employee's contribution limit will become double. It will be 5 lakhs. Generally, if employee's contribution is more than 2,50,000, the interest on the excess is taxable under salaries head. But if the the employer is not contributing, if employer's contribution is 0, only employee's contribution is there, then in that case, not 2,50,000 limit, instead limit will become 5 lakhs. Simple guys, easy discussion. This was about RPF. Then RPF, three concepts I told you. First concept was employer's contribution, 4 plus 1, 5 steps. Second was employee's contribution, 2 steps. Then we have interest on RPF. Here very simple guys. We will see what is the interest rate. Okay. If the rate is within 9.5%, then fully exempt. If the interest rate is more than 9.5%, we will see what is the excess above 9.5%. The excess above 9.5 will become taxable. Simple guys, this is about your interest on RPF. Okay, now comes my URPF discussion. See, URPF, year on year, like every month employer employee both will contribute, no? So month on month, year on year, no tax implications guys. In URPF, tax implications will come into the picture only when you withdraw the money from URPF. So when you withdraw the money from URPF, whatever money you are withdrawing, it will be split into 4 parts guys. We'll see what is the employer's contribution, what is the interest on employer's contribution. Both of these parts will be taxable under salaries. Employee's contribution, ignore guys. Interest on employee's contribution will be taxable under IFOS. Crystal clear. So this is about my URPF discussion. See, even in RPF, no, when you withdraw the money, sometimes it is exempt, sometimes it is taxable. That we will learn under section 192A when I teach you TDS chapter. There, that point will get covered. But URPF, I discussed about withdrawal with you now itself, because in URPF, month on month, year on year, anyways no tax treatment. Anyways in URPF, tax treatment comes into the picture only when we withdraw the money. So when you withdraw the money, we split the money into 4 parts. Okay, employer's contribution and interest on employer's contribution both be taxed under salaries. Employee's contribution we ignore. Interest on employee's contribution we tax under IFOS. Crystal clear guys? Yes. So we spoke about RPF and URPF. Now listen. Right now itself, let's talk about SPF also, Statutory Provident Fund. Employer's contribution, fully exempt guys. Employee's contribution, you'll get 80C deduction guys. And interest on contribution, even this will be fully exempt. When you withdraw the money from SPF, even that will be fully exempt. Just one small revision. Okay. Now listen, moving on to our next discussion, specified employee. Now specified employees means what? See, and first of all, why do we need to know who are specified employees? See, after specified employee discussion, we will start learning perquisites. There are some perquisites which are taxable only for specified employees. Some perquisites are taxable for all employees. Some are taxable only for specified employees. That is why we need to know that who are these specified employees. So I have 3 criteria. Okay. Any employee who fits under even one out of these 3 criteria, that employee will become specified employee. Very simple discussion guys, listen to me. Next, we are going to be discussing about specified employees, guys. See, understand, first of all, why do we have to learn about specified employees? Because after this, we are going to start revising perquisites. Now, there are some perquisites which are taxable for all employees, but there are some perquisites which are taxable only for specified employees. So, therefore, first we have to know who are these specified employees. So, see, we have 3 criteria, okay. Any assessee, any employee who fits under any of these 3 criteria, that employee will become specified employee. Now, what are the 3 criteria? Criteria number 1, that employee is a director. See, I'm not saying he has to be a director throughout the year. He can be a director for even one day. That is fine. You should be a director at any point of time during the year. First criteria. Second criteria, that employee must be having substantial interest. Same thing. It is not necessary you must be having substantial interest throughout the year. No, not necessary. You must have substantial interest at least at any point of time during the previous year. Even one day it is fine. Now you will ask me, ma'am, what is a substantial interest? Substantial interest is nothing but at least 20% equity shares you must be having carrying voting power. At least 20%. Remember the 20% number. Like for example, if the employer is a company, then the employee must be holding this company's 20% equity shares carrying voting power. Understanding? So the second point is the employee must be having substantial interest at any point of time in the previous year. Then comes my third criteria. The third criteria says you will take the taxable salary. Taxable salary means what? All your basic salary, allowances, perquisites, everything put together, you will get gross salary. From that you will subtract section 16 deductions, you will get taxable salary. So that taxable salary minus non-monetary perquisites. Non-monetary perquisites are those perquisites, guys, which you get in kind. Like for example, RFA, it's a perquisite which you are getting in kind. Then motor car, even that is a perquisite which you are getting in kind. Then let's say ESOP, sweat equity shares, even that you are getting in kind. So from your taxable salary, I will subtract non-monetary perquisites. Whatever net number I get, that has to be more than 4 lakh for that particular year. This 4 lakhs number is an amendment, guys. Earlier it was 50,000. From your examination onwards, it's going to be 4 lakh. Getting my point, guys? So who is a specified employee? I have 3 criteria. Any employee who fits under any of these 3 criteria. See, you don't have to fulfill all the 3. I have the word or in between. So fulfill any one out of these 3. Either you must be a director of the company, guys, or you must be having substantial interest in the employer company, guys, or your taxable salary minus non-monetary perquisites, the net number has to be more than 4 lakhs. Out of these three criteria, fulfill any one criteria, then you will become a specified employee. Now if you're a specified employee, what will happen? There are some perquisites which are taxable only for specified employees. Now what are these perquisites? Motor car, we'll be learning a little later. Motor car perquisite. Education facility, not education allowance. See, education allowance we've already completed learning. 100 rupees per month per child exemption you will get, maximum for 2 children. That we've completed learning. That is same common provision for all employees. I'm talking about education facility. I'm talking about education perquisite, where, like for example, the employer is running a school, and in that same school the employee's children are studying. That becomes education facility, guys. So motor car, education facility, taxable only for specified employees. If you're a non-specified employee, not taxable for you. Now see, motor car, education facility, and this free or concessional tickets. These three we'll anyways be seeing a little later. So we'll keep these pending. But these two, let's focus on these two for now. Facility of sweeper, gardener, watchman, personal attendant, etc. Here the word to be focused upon is facility. See guys, there are two transactions, okay? One is reimbursement and the other is facility. In reimbursement, what happens is, let's say for example an employee, he hires one sweeper, okay? Now whatever the sweeper's charges, the employee has paid the sweeper. Later the employer is reimbursing the charges for the employee. So that reimbursement, this will be taxable for all employees, guys. Why taxable? See, of course I got a benefit from the employer, right? I hired a servant for my house. I am paying the servant salary. Now it is my expense, it is my personal expense. The employer is reimbursing it for me. It's a benefit for me, but this benefit will be taxable for all the employees. However, there is something called as facility also. In facility, there is no reimbursement, guys. In a facility, the employer itself is directly providing the servant to me. Understanding? So if I hire a sweeper, gardener, watchman and all, and if I pay them salary, and if the employer later reimburses those charges to me, that will become reimbursement, and reimbursement will be taxable for all employees. But if I am not hiring the sweeper, gardener and all, the employer itself is hiring all these people and giving for my house, then that will become a facility for me. Facility will be taxable for specified employees only. Getting it? Same way, guys, let's say I'm an employee and I'm having gas connection for my house. Now this gas connection, electricity expense, all of these expenses, if they are in my name, if the gas connection is in my name, electricity bill is in my name, so I am incurring the expense, and whatever is the bill, I'm going and showing it to the employer is reimbursing it for me. So if it's a reimbursement, it will be taxable for all employees. But if it's a gas facility, which means a gas connection itself is in employer's name, it is electricity facility, water facility, which means the connections itself are in the employer's name, employer is directly providing the facility to me, no reimbursement and all, that will become a facility, and facility will be taxable only for specified employees. Got it, guys? So the reason why we're studying specified employees is because of these 5 perquisites. These 5 perquisites are taxable only for specified employees. Motor car, education facility, facilities of sweeper, gardener, watchman, personal attendant, gas, electricity, water supplied by employer for household consumption, and free or concessional tickets. So our whole focus in this discussion was on these two. Remember, guys, if the same sweeper, gardener, gas connection, electricity, if the same thing is a reimbursement will be taxable for all employees. But if it's a facility where the employer itself has directly provided the employee a sweeper or a watchman for his house, or if the gas connection is directly in the employer's name itself, employer is directly meeting the expense, it becomes a facility. And if it's a facility, it will be taxable for specified employees only. Okay, guys, so specified employees, 3 categories we have. Number 1, either you must be a director at any point of time in the previous year, or you must be having substantial interest at any point of time in the previous year, or your taxable salary minus non-monetary perquisites, the balance has to be more than 4 lakh rupees. Now see, we'll spend 1 extra minute understanding this substantial interest point. It's an untested area, guys, so listen to me little extra carefully. Substantial interest means what I told you. Substantial interest means you must be having at least 20% equity shares of the employer company carrying voting rights. Okay, now for these 20% shares, for this substantial interest, you must be having beneficial interest. This is where a little bit of Companies Act flashback you will get. Your section 89, section 90 of Companies Act, all that will come into your mind. Listen to me, guys. Let's straight away take one example. Let's say there's a company, Music Limited. Now in this Music Limited, let's say we have an employee, Mr. A. Okay, he's an employee of this company. The same Mr. A is also the karta of a HUF. Alright, now this HUF wants to buy shares of Music Limited. But what HUF does is HUF gives the money to Mr. A and Mr. A buys the shares. So Mr. A becomes the registered shareholder of Music Limited, guys. Let's say 20% shares Mr. A is holding. He's a registered shareholder. But the shares actually belong to whom? Who gave the money for these shares? The HUF, right? So HUF becomes the beneficial owner of the shares and Mr. A is only a registered owner, guys. No doubt in the books of in the register of members of Music Limited, Mr. A's name only will be mentioned. That's why Mr. A is a registered shareholder. But he's not enjoying the benefits of the shares. The real owner, substance over form, guys, the real owner is the HUF only over here. Now, in this case, we cannot say that Mr. A is a specified employee. We cannot say that he's having substantial interest, because substantial interest means you must be having beneficial ownership. See, whether you are a registered owner or not, I don't care. You must be the one who's enjoying the benefits of the shares. So when we say that you must be having substantial interest of at least 20% equity shares carrying voting power, that substantial interest refers to beneficial interest. You must be having beneficial interest. You must be having beneficial ownership. Whether you're the registered owner of those 20% shares or not, I don't care. But you must be the one who's enjoying the benefits of those shares. So beneficial ownership, in simple words, substance over form, guys. We don't care who's a registered shareholder. You must be the one who's enjoying the beneficial interest over the shares. Only then will we say that this second criteria is fulfilled. Okay, guys, so this was our entire revision about specified employees. I hope you're feeling nice and confident. Why are we learning about specified employees? Come on, quickly tell me. 2 minutes it will take. Why are we learning about specified employees? Because there are some perquisites which are taxable only for specified employees. What about the other perquisites? Other perquisites are taxable for all employees, but I have 5 perquisites which are taxable only for specified employees. So what if I'm a non-specified employee? If I'm a non-specified employee and if I'm getting any of these 5 perquisites, they will not be taxable for me. What are the perquisites? Motor car perquisite, education facility, free or concessional tickets. These 3 we do not even discuss about. These 2, however, we spoke about these 2. Facilities of sweeper, gardener and all, and gas, water, electricity facilities. Remember, same thing. If it's a reimbursement will be taxable for all employees. Only if it's a facility, you will say it is taxable for specified employees only. Okay. Now, who is a specified employee? 3 criteria we have. If any employee fulfills any of the 3 criteria, then that employee becomes specified employee for that particular year. Either he must be a director, or he must be having substantial interest, or he must or his taxable salary minus non-monetary perquisites, the balance has to be more than 4 lakh rupees for that particular year. Then remember, substantial interest means at least 20% equity shares carrying voting power. Now you must be a beneficial owner of these shares. You must be the one who enjoys the benefits of these shares. Whether you're a registered owner or not of these shares, I don't care. Okay, this was about a specified employees discussion. Now come on everybody, with a lot of confidence, with a lot of focus, let's enter into our discussion of perquisites one by one. We'll start with the biggest and the most important perquisite, RFA. Trust me when I say this, when we finish this entire discussion of RFA, you're going to feel nice and confident. Come on everybody, sit up straight, no background music in your mind, no tension, with a calm mind, listen to me. So whenever you're getting rent-free accommodation, what exactly happens over here? See, in HRA, the employer is giving you money and he's telling you, hey listen, use this money to pay your rent expense. So in HRA, he's not giving you a house, he is giving you money to help you pay your rent expense. But in rent-free accommodation in RFA, he is giving you a house to live in. So if it's of course a benefit for you, you're getting a house to live in, and this benefit, is it going to be taxable only for specified employees, guys? It doesn't come under the list of 5 perquisites. So RFA will be taxable for all employees. Okay guys, now what will be the taxable value? See, this is a perquisite. In a perquisite, we directly calculate the taxable value. There's nothing exempt over here. We'll directly calculate the taxable value. Now what is the taxable value? Simple flowchart, guys, very easy. We will first see who is the employee, government employee or non-government employee. If government employee, the license fee will become taxable. If non-government employee, then we will see, is the RFA owned by the employer or is the RFA taken on lease by the employer. Now, if the RFA is owned by the employer, that is if the house is owned by the employer, very simple. We will simply see the population of the city where the house is situated. If the population happens to be within 15 lakhs, then 5% of salary. If the population happens to be more than 15 lakh but within 40 lakhs, then 7.5% of salary. And if the population happens to be more than 40 lakhs, then 10% of salary. So what's the population slab? Up to 15 lakhs to 40 lakhs and more than 40 lakhs. 5%, 7.5% and 10%. Now this 5%, 7.5%, 10% is what? Is it exempt amount or is it taxable amount? Come on guys, basic tip. It is a perquisite. In a perquisite, we directly calculate the taxable value. So these numbers will be the taxable value. Okay, now comes $1 million question. How will I know what is the population of that particular city? For that, the answer is you will simply go and look at the population as per the 2011 census. Okay, guys. Now listen. So this is what if the RFA is owned by the employer. But what if the RFA is what if the employer himself has taken the RFA on lease? Basically, what if the RFA is not owned by the employer? What if he himself has taken the RFA on rent and is giving that rented RFA to the employee? Then in that case, no population, I don't care about the population, straight away 10% of salary or rent paid by employer, whichever is lesser will be what? Whichever is lesser will be taxable. Okay, so if the RFA is owned by the employer, then the answer, the percentage will change on the basis of population. But if the RFA is taken on lease by the employer, I don't care about the population, always 10% of salary or rent paid by employer, whichever is lesser will be taxable. Now comes another $1 million question, and that is, what is the meaning of salary for the purpose of RFA? This salary will have 7 components, guys. Number 1, basic salary. Number 2, DA forming part. Number 3, all commission. I'm not saying turnover based commission, I'm saying all commission, which means a commission can be turnover based commission or it can also be fixed commission. Then number 4, bonus. Number 5, fees. Number 6, taxable allowances. And number 7, any other taxable monetary payments. But when you're doing the salary calculation for the purpose of RFA, you will not take advance salary, you will not take arrears of salary, you will also not take employer's contribution to RPF, you will also not take any perquisite. You will these are the 4 items which are excluded from salary for the purpose of RFA. Okay, so what are the 7 components? Come on, learn it with me twice. Let's repeat the 7 components together. Repeat along with me. Let's register it in our memory. Basic salary, DA forming part, all commission, bonus, fees, taxable allowances, and any other taxable monetary payments. What are the 4 exclusions? See, you should not only know what is included in salary, you should also know properly what is excluded from salary. Only then learning is 360 degrees complete. 4 exclusions I have. Arrears of salary will not be included in salary for the purpose of RFA. Advance salary will not be included. Your perquisites will not be included, and employer's contribution to RPF will not be included. These 4 will not be included in salary for the purpose of RFA. Okay. Now comes another important question. What do you mean by this any other taxable monetary payment? Very simple, guys, nothing to worry, no tension. Simply do one post-mortem. Number 1, it has to be a monetary payment, which means it can't be in kind. It can't be a perquisite. It can't be in kind. It has to be money. It has to be money. And that money has to be taxable. Like, for example, leave salary received during service. I am receiving it during service. It is money and it is fully taxable. Gratuity received during service. It is, see, I leave salary received during service, gratuity received during service. I can't call these as retirement benefits, right? Because I'm receiving them during service itself. And it is money, and that money is fully taxable. So that all that will come under my 7th box over here. Okay. So tell me one last time the 7 components: basic salary, DA forming part, all commission, bonus, fees, taxable allowances, and any other taxable monetary payments. Okay. So any other taxable monetary payments, first of all, it has to be monetary payment. It has to be money. It can't be in kind and all, and it has to be taxable. So leave salary during service, gratuity during service, all this will fit under this box. Now a question will come that, ma'am, I got a gift from employer in cash. Gift from employer in cash is fully taxable. I'll be talking about it to you a little while later. Now this gift is in cash, so therefore it is monetary payment, and also it is fully taxable. So gift received in cash, will it fit under the 7th box? The answer is a big fat no. Why will this not be included over here? It is money, it is taxable, then why will it not be included? Because I have exclusions. In these exclusions I have perquisites. Gift received in cash, any gift, any kind of gift which the employer is giving to the employee is a perquisite, and perquisites have to be excluded. Getting it, guys? So any gift which I get from the employer in cash, this gift, yes, it's taxable, yes, it is money, but I will still not put it under the 7th box because it becomes a perquisite, and perquisites are excluded from salaries. Okay, no confusion. This might have been one small good morning moment for you. So until now, what are the things we have learned? We have learned how to find the taxable value of RFA. Here we learned it all depends upon who is the employee, government employee or non-government employee. If government employee, then you will simply take the license fee, guys. License fee will be taxable. If non-government employee, then you will see, does the employer own the house or has the employer himself taken the house on lease? If the employer owns the house, then the taxable value will fully depend upon population. Population as per 2011 census. What are the slabs of population? Tell me. Up to 15 lakhs, 15 lakhs to 40 lakhs, and more than 40 lakhs. What are the percentages? Tell me. 5%, 7.5%, and 10%. 5%, 7.5%, 10% of what? Of salary. Okay, then what if the employer himself, what if he has taken the house on lease? Then what will you do? Then also will you look at population? No. Straight away you will take 10% of salary or rent paid by employer, whichever is lesser. Whichever is lesser is what? Exempt or taxable? Whichever is lesser will be taxable. Okay, then salary will have how many components? 7 components, and don't forget the 4 exclusions. Okay, so when you're calculating salary for the purpose of RFA, you will never include perquisites in this calculation. Advance salary, arrears of salary, and employee's contribution to RPF and perquisites, these will be excluded from salary for the purpose of RFA. Okay, now after doing all this drama, after doing all this calculation, what will you get? You will get the taxable value of unfurnished RFA. Taxable value of unfurnished RFA. Now to this you will add the value of furniture, because sometimes the RFA which the employer has given to you might be a fully furnished house. So in that case you will also add the value of furniture. So your next question now will be that how will I find the value of furniture? Simple. Just check whether the employer owns a furniture or whether the employer has himself taken the furniture on hire. If he owns a furniture, you will take 10% per annum of the cost of the furniture. That will become the value of the furniture, the taxable value of the furniture. And if the employer has taken the furniture on hire, then employer will be paying some higher charges. No, so you will take that higher charges. Easy, guys. So if the house happens to be a furnished house, then in that case, after you find the taxable value through this flowchart, the taxable value will become the taxable value of unfurnished RFA. To that you will add the taxable value of furniture and you will get the taxable value of furnished RFA. So the taxable value of furniture, that depends upon does the employer own the furniture or has the employer himself taken the furniture on hire. If he owns the furniture, then you will take 10% per annum of the cost of the furniture. If he has taken the furniture on hire, you will take the higher charges of the furniture. Now here, one point to be noted which you might have missed: per annum. Why am I saying 10% per annum? Why am I not saying 10%? That's all. Why am I saying 10% per annum? Because proportionate calculation will be possible here sometimes, guys. See, we have worked out questions where the employer has given the furniture to the employee only November onwards, only for 5 months. So in that case, you will see what is the value of the furniture, what is the cost of the furniture, that into 10% into 5 by 12. Getting my point? This per annum indicates that in case the furniture is provided to the employee only for a part of the year, then you will do proportionate calculation. Okay, so no rocket science over here. So with this flowchart, you will find the taxable value of unfurnished RFA. Then you will add the taxable value of furniture, and now you will get the taxable value of furnished RFA. Okay. Now listen, sometimes the employer might be a little stingy. The employer might tell the employee, hey listen, I am giving you one house to live in. I am giving you one accommodation to live in. I'm not asking you to pay me rent for this house. Pay me at least some money. Who is saying this to whom? Employer is telling this to employee. See, I'm giving you a house to live in. Pay me at least something for this. I'm not asking you to pay the full rent. Pay me at least something for this. So which means the employee is now going to give the employer some money for giving this house. So now tell me, can I still call it as rent-free accommodation? Is it rent-free anymore? It is not rent-free anymore because now employee will be paying some money to the employer. So I can't call it as rent-free anymore. So therefore now I will call it as accommodation at concessional rent. So what I will do is, I will see what's the taxable value of the perquisite. From that I will subtract whatever rent employee has paid to the employer. Whatever is the net value, that will become the taxable value of accommodation at concessional rent. I can't call it rent-free accommodation anymore. So now the name of the perquisite changes. It changes into accommodation at concessional rent. Okay guys, small tiny points, be careful. So through the flowchart you will get the taxable value of unfurnished RFA, you will add the taxable value of furniture, you will get the taxable value of furnished RFA. Then by chance employee is paying any amount to the employer, you will subtract that, and now you will get the taxable value of accommodation at concessional rent. So remember, if employee is paying any rent to the employer for the rent-free accommodation, you can't call it rent-free anymore. So now the name will change. Its name will now be accommodation at concessional rent. 100% clear? Yes guys, now come on, let's focus. So until here the main RFA discussion is over. Now I just have some extra scenarios, a few extra scenarios for you. Listen to me. The first extra scenario relating to RFA only. Sometimes what happens is the employer may give to the employee 2 RFAs at the same time. Like very genuine transaction is possible, guys, wherein let's say I am an employee of the company and I was working in Chennai, and in Chennai the employer had given to me one RFA. Now the employer is transferring me to Bangalore. Okay, so in Bangalore also he is giving me RFA. Now see, I can't leave the Chennai house today and go and shift to Bangalore house tomorrow. It will take me some time to move everything from Chennai to Bangalore. So there might be some time gap or some 2-3 months whatever, where I'm having both the Chennai house and the Bangalore house simultaneously, because I'm shifting from one place to another. So there might be 1 or 2 months in between where I'm having both the houses. So it's a very genuine situation. It's a legit situation. So when this happens, the law is making a favor on us. The law says, listen, SSC, we understand this is a genuine situation. So when this happens, when at the same time you're getting 2 RFAs from the same employer, in that case, for the first 90 days, you find the taxable value of the Chennai house also, you find the taxable value of the Bangalore house also, and whichever is the lesser, on that one alone you pay tax. Which means for the first 90 days, we will ask you to pay tax only on one RFA and not on both the RFAs. Whichever is a lesser taxable value, you pay tax only on that. But however, there's a small catch. If you're getting 2 RFAs for more than 90 days, then something is fishy, because you don't need more than 90 days to shift from Chennai to Bangalore. So if employer is giving you 2 RFAs for more than 90 days, then we're not able to justify it. It's not a genuine situation anymore. So for the first 90 days, we will tax anyone. For the excess above 90 days, whatever is the excess period, we will tax both. Okay, getting my point? Like, for example, let's say employer has given for 120 days. For 120 days, he gave me both the Chennai house also, Bangalore house also. Two houses I'm having at the same time for 120 days. So this 120, I will split into 2 parts. 90 days and the excess above 90. What is excess above 90? 30 days over here. So for these first 90 days, I will find Chennai house taxable value, Bangalore house taxable value. Whichever is lesser will be taxable, which means only one RFA will be taxable. But the excess days beyond 90 days, that is the remaining 30 days, for these 30 days, I will find the Chennai house taxable value, Bangalore house taxable value, and this time both will be taxable, both the RFAs will be taxable for these 30 days. Getting my point? This is your first extra point with respect to RFA. Then comes the second extra point. Sometimes what happens is, a question will tell you that employer has given RFA to the employee in April month itself, but employee started occupying that house only November month onwards. So in that case, you will do taxable calculation only November month onwards. In simple words, guys, RFA will be taxable not from the date on which employer gives you the RFA. No, it will be taxable only from the date on which the employee occupies the RFA. Because only when you occupy the house, only then you actually start enjoying the benefit, guys. Right? Sounds logical to you? So you will tax the RFA only from the date on which the employee actually starts occupying the RFA. Then comes my third point, guest house official use. See, simple point, okay? If guest house was given to employee purely when he comes to India for official visit, then the perk visit will be fully exempt. Like, let's say employee is working in the US. He's living over there along with his family in US. Now employee is coming only for one small project. He's coming to India, let's say, for 15 days. So when he comes to India for 15 days, the employer is giving him a stay in guest house. So any stay in guest house, if you're getting, if it is purely for official purposes, you're coming to India and that time we're giving you a stay, then we do not give you any benefit as such. So therefore nothing will be taxable. The perk visit will be fully exempt. So your equation will be guest house plus purely for official use will be fully exempt. Okay, then comes my fourth point. It's an untested area, so be careful. Let's say the employer fired the employee on 31st May, which means the employee has worked only for 2 months, April and May. Ideally, the employee should vacate the RFA at the end of May, guys. But employee is an adamant employee. He is not even vacating the property. He is keeping the property with him till 31st December. Are you noticing what has happened over here? Employer-employee relationship is till 31st May only. On 31st May, employer has fired the employee. Employee is not an employee anymore. But still, he continues to keep the RFA with him till 31st December. So now what will you do? You will see. From 1st April till 31st December, for this entire 9 months, he has enjoyed benefit. But entire 9 months, you can't tax under salaries head, guys. Because basic point of salaries head is that there must be employer-employee relationship, which in my example is there only for 2 months. So only for these 2 months only, there is employer-employee relationship. Therefore, for these 2 months only, the RFA value will be taxable under salaries head. After the employer-employee relationship is over, that is June month onwards, till 31st December, till he vacates the house, for this period also, he has enjoyed benefit. But I can't put it under the salaries head because there is no employer-employee relationship anymore. So for this period, whatever is a taxable value, it will be taxed under the IFOS head. Okay, guys, small simple points. Then comes my fifth point, which is about RFA indexation. When do you index RFA? See, look at this. Okay, this is a point where very often students get confused. You do know that there is some indexation in RFA, but where you get confused is that when to index and when not to index. So one proper table I have made for you over here. You just have to listen to me patiently. Once if you listen, you will never forget. There are two conditions. If both the conditions are fulfilled, then only you will index RFA. Condition number one, employee is getting one RFA, guys. But that RFA which employee got, this is not the first time when he got that RFA. The same house he got as RFA last year also, or before that also, which means the same RFA, the same house is being enjoyed by the same employee for multiple years. So the first condition is that the same house should be given to the employee for multiple years. And the second condition is that either last year, that is 24-25, or before that, that is 23-24, out of these 2 years, at least 1 year's taxable value of RFA they have to give you. Only then you can index. Okay, so two conditions have to be fulfilled, only then you will apply indexation. Condition number one, the same house should be given to the same employee as RFA for multiple years. And condition number two, they must give you the taxable value of RFA of 24-25 or 23-24 previous year. So only if both these conditions are fulfilled, I have the word and over here, only then you will apply indexation. Which means if this is the first time when the employee got RFA, or even though the same RFA employee got multiple years, but still 24-25 or 23-24's taxable value they did not give you, then you will not index. Simple, guys. So remember when to index. If the same house is given to you for multiple years, and also the employee, also they have given you the taxable value of the RFA for last year or before that, then you will index. So if both these conditions are fulfilled, if indexation is applicable for you, now listen, what will you do? You will first find the taxable value of RFA, like your usual calculation. You will find the taxable value of the perquisite. Okay, as per usual calculation, you will apply your flow chart, the table and all, normal usual calculation you will do. Alright, then I told you, right, they will give you the taxable value of the last year. Like for example, let's say they've given you taxable value of 24-25, it is 1 lakh rupees, let's say. So you will index this number. How do you index, guys? Normal indexation which you do in capital gains, same thing only. Like for example, 1 lakh, this was a taxable value for you in which year? In 24-25. In 24-25, what was the indexation? Your cost inflation indexation, guys, 363. Now I want to find what is the indexed value for 25-26, which is my current previous year. In 25-26, the indexation is, let's say, 376, sorry, it's 376, yeah. So now what you will do is simple cross multiplication. So 1 lakh into 376 by 363. So same thing if I want to write as a formula, what is 1 lakh? 1 lakh is taxable value of the perquisite for the last year into 376. What is 376? 376 is CII of the current year, CII of 25-26 by 363. What is 363? 363 is the indexation of 24-25. Basically, it is the indexation number of the year for which they have given us a taxable value. So CII of the initial preceding previous year. So this is how I will get the indexed value of RFA. Getting my point? So what I will do is, if they have given me the taxable value of RFA of the last year, and the same RFA has been given to me for multiple years, then in that case, first of all, indexation will apply. So to do indexation, first of all, you will take the taxable value of RFA as per your flow chart, your table, your usual calculation you will do. Then you will see what's the taxable value which they have given you for the earlier year. You will index that number. Okay. Now out of these two numbers, whichever is the lesser number, that will become your final taxable value of RFA. Understanding? So be aware of this. You should know not only how to index, but you should also know when to index. Okay guys, when do you index? Tell me that first. Whenever the same RFA is given to me for multiple years, and also they've given me the taxable value of the last year, then only you will index. Okay, then if at all you have to index, how will you index? First you will find the taxable value as per usual calculations, your usual flow chart. Then you will see what is a taxable value that they have given to us in the question, the taxable value of 24-25 or 23-24. That number you will index and you will bring to the current year. So these two numbers, the number which you calculated as per the flow chart and the indexed number, whichever is lesser, will become your taxable value. This is your fifth special point with respect to RFA. And now coming to the last special point with respect to RFA, sometimes the accommodation may be given to you in a hotel or in a motel or in a guest house or in a service apartment. Say you tell me, you're getting a place to stay in a house. You're getting a place to stay in a hotel. Where the benefit will be more for you? Hotel will be a lot more beneficial for you guys, because here you will get laundry also, you will get housekeeping service also, food will come directly to your room, so you will get a lot more benefits over here. Hence the taxable value has to be different, right guys? So if the accommodation is given to you in a hotel or in a motel, then the taxable value of perquisite will be fully different. You will calculate 24% of salary. What is salary? Same 7 components, 24% of salary, or whatever charges employer is paying. Like employer is giving you a hotel room to stay in. So for the hotel room, the employer will be paying charges, guys. So whatever charges the employer is paying, that number, or 24% of salary, whichever is lesser, will be taxable. See, here you have to be a little careful. When you're calculating 24% of salary, don't calculate salary for the entire year. Calculate salary only for the period for which the employer is giving you hotel stay. Okay, whatever is the period, like let's say he's giving you stay in hotel for 2 months, so for 2 months you will calculate salary, that salary into 24%, the 24% number, or whatever actual hotel charges employer is incurring, whichever is lesser, will be taxable. Of course, whatever money employee has paid to the employer, you will deduct, you will subtract, and that's how you will get the taxable value. But remember that if the accommodation is given for within 15 days, for not more than 15 days, because employee is getting transferred from one place to another. Simple point, guys. Employee is getting transferred from Chennai to Bangalore. Now, when he goes to Bangalore, he will need some time to settle down. So, the employer is giving him a free 10 days stay in a hotel. So, he is getting stay in a hotel which is for within 15 days, not more than 15 days. And why is he getting a stay in hotel? Because he's getting transferred from one place to another. In such case, the hotel accommodation will not be taxable for him. It will be fully exempt for him. Okay, this was our entire discussion with respect to RFA, guys. So with respect to RFA, we first discussed the whole flow chart. How do you find the taxable value? Depends on government employee, non-government employee. If government employee, you will simply take the license fee number. If non-government employee, you will check whether the employer owns a house or whether the employer himself has taken the house on lease. If the employer owns a house, then you will see the population as per 2011 census. The slabs of population are up to 15 lakhs, more than 15 lakh up to 40 lakhs, and more than 40 lakhs. Taxable value will be 5%, 7.5%, 10% as the case may be. Then if the house is taken on lease by the employer, then I don't care about the population. Always 10% of salary or rent paid by employer, whichever is lesser. Whichever is lesser is what? Taxable. Now, what is the meaning of salary? 7 components. You should know what to include. You should also know what to exclude. What are the 7 components? Tell me. Basic salary, DA forming part, all commission, bonus, fees, taxable allowances, and any other taxable monetary payments like leave salary during service, gratuity during service. But however, there are 4 exclusions. Arrears of salary, you will not include. Advance salary, you will not include. Perk visits, you will not include. Employer's contribution to RPF, you will not include. Then we learned by doing all this calculation, you will get the taxable value of unfurnished house. Now, in case employer is giving you furniture also, you will add the taxable value of furniture. How will you find the taxable value of furniture? It depends on whether the employer has taken the furniture on hire or does the employer own the furniture. If the employer owns the furniture, then 10% per annum of the cost of the furniture is what you will take. If the employer has himself taken the furniture on hire, then you will take the higher charges. So once you add the taxable value of furniture, you will get the value of furnished RFA. Now, in case it's any money which employee is paying to the employer for the house, you will subtract that, and now you will get the taxable value of accommodation at concessional rent. Here I told you, if employee is paying rent, you can't call it rent-free accommodation anymore. Hence, you will call it as accommodation at concessional rent. Then 6 special points we learnt with respect to RFA. First special point, if you're getting 2 RFAs simultaneously, okay, then for the first 90 days, we will tax any one. For the excess period after 90 days, we will tax both. Then we learnt RFA will be taxable not from the date on which it is provided to you, but from the date on which you actually start occupying it. Then if a guest house is given to you purely for official visit, then in that case, it will be fully exempt. Then salaries or IFOS, which head of income will you tax RFA? See, till employer-employee relationship is there, till that period it will be taxed in salaries head. But once employer-employee relationship comes to an end, then after that the RFA will be taxable in the IFOS head. Then we learned when will you index RFA? If 2 conditions are fulfilled. Condition number 1, the same RFA is being given to the employee for multiple years, and second condition, they must give you the taxable value of RFA for some earlier year. Only if, and that earlier year cannot be earlier than 23-24. Either they should give you taxable value of 23-24 previous year or 24-25 previous year. If both these conditions are fulfilled, then only you will index the RFA. So first you will compute normal manner only you will compute RFA. Then you will see what is a taxable value that they have given to you for the earlier year. You will index that number. So out of these 2 numbers, whichever is lesser will become the taxable value of RFA. Okay. And lastly, we learned in case accommodation is being given in a hotel or in a motel and all, then you're getting more benefit. So therefore, the taxable value will change. 24% of the salary or whatever hotel charges employer is paying, whichever is lesser will be taxable. Here we learned a few extra points as well. We learned when you're calculating salary, don't calculate salary for the entire year. Calculate salary only for the period for which the employer has given you the stay in hotel. This is one extra point. Another extra point I told you over here, any money which employee is paying to the employer, you will subtract, because we always tax the net benefit, guys. And one more point, the third point I told you, if the stay in hotel is for not more than 15 days, and what is the reason? Why is stay in hotel being given? Because of transfer of employee from one place to another. So if the reason is transfer and the period is not more than 15 days, then in that case, the taxable value of this perquisite will be nil. This perquisite will be not taxable. Got it? Reason is transfer from one place to another. The period is not more than 15 days. If both these conditions are fulfilled, accommodation in hotel, motel and all will be fully exempt. Okay, this was our discussion on the first perquisite, RFA. Now see guys, in the examination sometimes they might ask you to compare HRA and RFA and to suggest which is better. RFA is better or HRA is better. Which is better, they might ask you. They might make a question like that. Same question we have worked out in class as well. And in case you've not attended my classes, then in your total income chapter, you will find a question on this point, that HRA or RFA, which is better on the basis of net take home cash benefits. So just wanted to give you a reminder of this question that we have solved in class. If the question is asking you something like this, that which is better on the basis of net take home cash benefits, then it does not mean HRA or RFA wherever tax is lesser, wherever taxable value is lesser, that is better. No. The criteria is on the basis of net take home cash benefits, which means the criteria is net cash in hand. What you will do is, in HRA option, you will first take the HRA option. You will see what are the cash inflows and what are the cash outflows. You will find the net cash in hand. Then you will come to the RFA option. In RFA option, what are the cash inflows? What are the cash outflows? You'll find the net cash in hand. So out of HRA or RFA, wherever more cash you are left in your hands, that option will be better. Like in HRA guys, HRA money is going to be an inflow. Then rent expense will be an outflow. Tax will be an outflow. So after all this, you will find the net cash in hands. The net cash in hands, that number you will keep you'll keep that in the side. Then similarly, you'll come to RFA. Now in RFA, your cash inflows will be what? Basic salary, DA, all that will be your cash inflow. Then with respect to RFA as such, you're getting a house to stay in. Employer is not giving you money. So you will not have any inflow exactly from the point of view of RFA, and tax will of course be your outflow. So you will see your net cash in hands in RFA option. So you'll have this number now. So if assessee chooses HRA, how much net cash are you left with in your hands? If assessee chooses RFA, then how much net cash are you left with in your hands? In the two options, wherever the cash in hand for you is higher, that will be better. Okay, just wanted to give you a reminder that that's a unique question. So unless I give you this reminder, you may not remember this. Just reminding you through this discussion that please have a look at that question once. Okay, then coming to our next discussion, gifts from employer. See, if the employee is getting a gift from employer, no doubt guys, gifts generally go into the IFOS head. But when you get a gift from employer, it comes under the salaries head, because any benefit you get from the employer will come under the salaries head. So if the gift happens to be in cash, I won't even check anything guys. I will straight away say it is fully taxable. But if the gift happens to be in kind or a gift voucher, then it depends on what is the value of the gift. If the value of the gift is less than 5,000, then it is exempt. If the value of the gift is more than or equal to 5,000, then either you can say it is fully taxable or you can say excess is taxable. 2 points of view, two alternative answers we have. Both the answers will be correct. Of course, both the answers will be different, but both the answers will be correct. So if employer is giving a gift to the employee, if it's a gift in cash, fully taxable. If it's a gift in kind or a gift voucher, you will see what's the value of the gift. If the value of the gift is less than 5,000, then it will be exempt. If the value of the gift is equal to 5,000 or if it is more than 5,000, then it will be taxable. Like for example, if the value of the gift is, let's say, 6,000 rupees, then in that case you have two options. Either you can tax the excess 1,000 or you can say that we will tax the whole 6,000 fully. Okay, so either you can tax it fully if it is more than 5,000, either you can tax it fully or you can tax just the excess. Okay, now moving on to our next discussion guys, reimbursements. See, generally reimbursements are fully taxable. Remember we had spoken about facilities and reimbursements earlier. Even that time I told you reimbursements are generally fully taxable for all employees, fully taxable. But however, there are two exceptions guys: telephone bill reimbursement, mobile phone bill reimbursement, also internet bill reimbursement and medical bills reimbursement. Now these two, there are some exemptions here. See, when it comes to telephone bill reimbursement or mobile phone bill reimbursement or internet bill reimbursement, for all employees it will be fully exempt. Now, even if you're using the phone at home, doesn't matter. Telephone bill reimbursement, mobile phone bill reimbursement will always be fully exempt for every employee. Okay. Now comes medical bill reimbursement. Now, medical bill reimbursement is also generally taxable only, but only if the medical bills reimbursement is in a specified hospital for a specified patient, only then it will be exempt. So, general answer, if the question doesn't say anything, general answer will be what? General answer will be medical bill reimbursement taxable. Only if the medical bills reimbursement is in a specified hospital and the patient is a specified patient, only then medical bill reimbursement will be exempt. Okay. Now, what is this specified hospital? Three specified hospitals we have, guys. Number one, government hospitals. Number two, hospitals which are approved by the government. And number three, hospitals which are approved by the Commissioner of Income Tax. So, if the medical bill reimbursement is happening in a specified hospital, then that medical bill reimbursement will be exempt. How many specified hospitals we have? Three. What are the three specified hospitals? Very simple. Government hospital, hospitals approved by the government, and hospitals approved by the Commissioner of Income Tax. Okay, guys, now comes the next question, that who is a specified patient? And the hint to help you remember the specified patient is 3D plus spouse. Now, what does this mean? First, you will draw a plus. Then you will write the letter D in three places. And then you will write the word spouse. This is 3D plus spouse. See once again. 3D plus spouse. First, I will do a plus. Then I will write the letter D in three places. So, D, D, D. And then spouse. Which means, if I am the assessee, either I myself am the patient, or my dependent brother, or my dependent sister, or my dependent parents, or my children. Children can be dependent or independent, doesn't matter. My spouse. So, any of these can be the patient. Okay, guys, so once again, reimbursements very important. Nicely you understood, right? General answer, reimbursements are fully taxable. But if there are two reimbursements which are exempt, one is one is telephone bill reimbursement, mobile phone bill reimbursement, internet bill reimbursement. Here there are no conditions, no if, no but, nothing. Always fully exempt for every employee, fully exempt. That's it. Second is medical bill reimbursement. This is also generally taxable only, but medical bill reimbursement will be exempt only if it is in specified hospital and patient is specified patient. Three specified hospitals we have: government hospital, hospital approved by the government, hospital approved by the Commissioner of Income Tax. Then how many specified patients we have? 3D plus spouse, which means assessee, dependent brother, dependent sister, dependent parents, children and spouse. Simple. Yes, guys, in the memory, right? I've given you a revision of the revision as well. I hope it's nicely registered in your memory. Now, come on, let's go to the next point. Now, use of movable assets. This is my next perquisite. Use of movable assets. See, here what happens is, the employer has given a movable asset to the employee. But employee only has a possession of the movable asset. The employer is not transferring the movable asset. He's only giving the possession to the employee. Okay, so that's why use, not transfer. Transfer is a next perquisite. This is use, where the employer is only giving the movable asset to the employee just for use. Okay. Now here it depends. The taxable value depends upon what is a movable asset. If the movable asset happens to be a telephone or a mobile phone or a laptop or a computer, then fully exempt, guys. Even if the employee is using it for personal purposes, doesn't matter, guys. Fully exempt. Simple. So if the movable asset happens to be laptop, computer, telephone, mobile phone, life is simple. Always fully exempt. But however, if this movable asset happens to be any other movable asset, like let's say television, or let's say washing machine, or let's say refrigerator, any other movable asset, then in that case you will have to see whether the employer owns the asset or whether the employer has himself taken the asset on hire. If the employer owns the asset, then 10% per annum of the cost of the asset will be taxable. If the employer has himself taken that movable asset on hire, then you will take the hire charges paid by the employer. That will be the taxable value. Does this sound familiar to you? Exact same thing somewhere we have seen, guys. Where? Exact same thing somewhere we have seen in our furniture point. Remember RFA, if it is furnished RFA, you add the value of furniture. There also exact same thing we discussed. If the employer owns the furniture, then 10% per annum of the cost of the furniture. Otherwise, if the employer has himself taken the furniture on hire, then the hire charge is paid by the employer. Same thing, guys. Same thing, right? So if it is telephone, mobile phone, laptop or computer, then doesn't matter what is the employee using the asset for. Whether he is using it for official purpose, whether he is using it for personal purpose, whether he is using it, whether his children is using it, doesn't matter. Laptop, telephone, mobile phone, computer given for use, fully exempt, always for all assessees. But if it is any other movable asset, then it depends upon whether the employer owns the asset or whether the employer himself has taken the asset on hire. Okay. Then comes the next perquisite, which is transfer of movable asset. asset. So here what happens is the employer is transferring the movable asset to the employee, which means after this the employee will become the owner of the asset, right guys? In the last situation, employee only had possession, but now employee will become owner of the asset. Okay, so when this happens, I always give you one format to do this calculation. Always follow this format quickly, easily, without too much thinking. You will get the answer. You will start with the cost to the employer. See, employer is transferring it to the employee. So long back, employer would have purchased the asset. For how much did he purchase? The cost to the employer. Then all these years, employer was using this asset for his business or profession. So all these years, that asset would have gone through wear and tear, right? So you will subtract the normal wear and tear. Then employee might have paid some amount to the employer for this asset. So what has employee paid to the employer? We will subtract that. That's all guys. 3 simple steps. You will get the taxable value of the perquisite. You will start with the cost to the employer. Long back when the employer purchased the asset, for how much he purchased the asset, you will start with that. Then all these years employer has used the asset for his business or profession. So for that you will subtract the normal wear and tear. So once you subtract the normal wear and tear, you will get the value of the asset guys. But of course we always subtract whatever money employee has paid to the employer, right? Because we always find the net benefit. So this is a benefit which my employee got. He got the asset, but I want the net benefit, which means whatever he has paid, I will subtract that. The net number will be the taxable value of my perquisite. Okay guys, now in this entire calculation, the most important step is the normal wear and tear step. Now when it comes to normal wear and tear, 3 things you have to remember. Thing number 1, the rate and the method. See, the rate and the method depends upon what kind of a movable asset is it. If it's a computer, laptop, phone, or any electronic gadget, then 50% WDV basis. You will calculate normal wear and tear at 50% on WDV basis for computer, laptop, phone, electronic gadget. If it is motor car, not all vehicles, only motor car, 20% WDV basis. All other assets 10% SLM basis. Okay, so how will you compute normal wear and tear? The first thing you have to keep in mind the rate and the method. Then number 2, remember normal wear and tear will be computed only for those years for which the employer had used the asset for his business or profession. Which means guys, if the employer has used the asset for his personal purposes at his home, then I will not subtract normal wear and tear. I will subtract normal wear and tear only if the employer has used the asset for his business or profession. And then third point, if the number of years for which the employer has used the asset for his business or profession, if it is like for example 7 years 2 months or 7 years 9 months, if there's a fraction, you will always ignore the fraction. You will always take the completed years only. So even if it is 7 years and 11 months, you will still take 7 years only. Any fraction, whether less than 6 months, more than 6 months, I don't care. Any fraction I will ignore. Easy guys. Yes, so normal wear and tear, 3 points remember. Number 1, the rate and the method. If it is computer, laptop, phone, electronic gadget, 50% WDV basis. Motor car, 20% WDV basis. All other assets 10% SLM basis. Then remember, you will compute normal wear and tear only for those years for which the employer has used the asset for his business or profession. And if third point, remember, if those number of years happen to have a fraction, you will ignore the fraction. You will take only completed years. Got it guys? This was your discussion about transfer of movable asset. Now here one more small point, remember. Okay, I'll give you the same example which I've given in class as well. Let's say my assessee, let's say the employer has used the asset for 10 years, and now after 10 years he's transferring it to the employee. Now out of 10 years, for 2 years he had used the asset at his home. Okay, for 3 years he used the asset at his office, and for another 5 years, let's say the employer had given the same asset to the employee for use. Okay, so total 10 years, employer bought the asset 10 years back. 2 years he used it at his home. For this, of course, we will not calculate wear and tear, guys. Then 3 years he used at his office. So these 3 years, employer has used the asset for his business or profession. So you will calculate normal wear and tear, guys. And lastly, for the last 5 years, the employer has given the asset to the employee for use. Okay. Now the whole question is, for these 5 years, should I get wear and tear or not? See, the provision that we learned just now was you will calculate wear and tear for those years for which the employer has used the asset for his business or profession. So my whole focus is on the employer. Tell me guys, these 5 years, has the employer used the asset at his home? Has he used it for personal purposes? No. He has given it to the employee for use. Always remember, whenever the employer does anything for the employees, from the employer's point of view, it is for the purpose of business or profession. Therefore, for these 5 years also, you will get normal wear and tear. Right, guys? This is the most interesting part of this discussion, that even the years for which employer is giving the asset to the employee for use, okay, from employer's point of view, the asset is being used for business or profession, because he's not using it at his home. He is not using for personal purposes. He's not giving it to his friends or relatives. He's giving it to the employee. So anything you do for the employee, from employer's point of view, it's as if he's using it for business or profession. So therefore, the employer will get normal wear and tear. Okay, guys, so this was our discussion of a transfer of movable asset. Now come on, let's move on to the star perquisite, the most important perquisite, your motor car perquisite. The motor car perquisite I always discuss in 3 parts, guys, in 3 buckets. Okay, in the first bucket, the car is owned by the employer. Even expenses are incurred by the employer. So employee is getting how many benefits now? Here the employee is getting 2 benefits. Number 1, the employee is getting the car benefit, and number 2, the employee is getting the expenses benefit. Two benefits employee is getting. Okay, now this perquisite will be taxable for specified employees only. Remember, guys, we had learned 5 perquisites taxable for specified employees only. Motor car was one of them. So this is taxable only for specified employees. Now, how much is taxable depends upon what is the employee doing with the car. That is, for what purpose is the employee using the car. So we have 3 purposes that are possible. Okay, either only official purpose, or only personal purpose, or both official and personal purpose. So inside my first bucket, there are 3 possible situations. Now in these 3 possible situations, these 2 we can learn with logic. This one we'll have to mug up. Okay, if the employee is using the car for only official purpose, employee did not enjoy any benefit, guys, so therefore nothing will be taxable. If the employee is using the car for personal purpose, employee is enjoying benefit. How many benefits? 2 benefits. What are the 2 benefits? What's the first one? Car benefit. For car benefit, you will take 10% per annum of the cost of the car. You know why per annum is given over here? Because if the car is given to the employee only for few months, then you will do only proportionate calculation. That you know, guys. Then, so what's the second benefit which the employee got? Expenses are also met by the employer. So we'll see how much expense is met by the employer. This will become the total benefit which employee got from the employer. But we always tax the net benefit. So whatever money employee has paid to the employer, we will subtract, and that's how we will get the net benefit, the taxable value. Easy, guys. Noticing these 2 purposes, these 2 parts, we don't even have to mug up, pure logic. Then comes the third part. In the third part, employee is using this car for both official and personal purposes. Here there is no logic, guys. Here we'll have to mug up, guys. So if the employee is using the car for both official and personal purposes, then what's the taxable value? It will depend upon the cubic capacity of the car. If the car's cubic capacity is within 1600 cc, then 1800 per month is what you will take. If the car's cubic capacity is more than 1600 cc, then 2400 per month is what you will take. Now 1800 per month, 2400 per month, what is it? Exempt or taxable? Guys, come on, basic tip. This is a perquisite. In perquisite, we directly calculate the taxable value. Right, guys? In case along with the car, a driver, a chauffeur or a driver is also given by the employer, then to these numbers you will add another 900 rupees per month. Okay. Now listen, a very unique point. Listen to me. Until now, in every perquisite I've told you, in case employee is paying any money to the employer, we subtract. I've always told you this, guys. But in this third situation, where the car is being used for official and personal purpose, 1800 per month, 2400 per month, that's all. This will be taxable. Here, no adjustments, nothing. Even if employee has paid any money to the employer, we will not subtract. We will ignore. Understanding? In 1B, you do subtract amount recovered from employee. But in 1C, straight away 1800 per month and 2400 per month will be taxable. In case any money has been recovered from the employee, we will not subtract it, we will simply ignore it. Okay, and one more point, guys. In this third point, you can have maximum 1 car only. If in this third point you have more than 1 car, then the balance number of cars will be deemed to be personal purpose only. Like how in IFHP head, self-occupied property, you can have maximum 2 only. If you have more than 2, then deemed to be let out. Same way. Here also in 1C, you can have only 1 car. If you have more than 1 car, other cars will be deemed to be personal purpose only. Crystal clear, guys? This was my first bucket. Total 3 buckets. Can we see this once again? Can we do a revision of the revision, guys? This one bucket alone, if you're thorough, then everything else will be a cakewalk for you. So in the first bucket, the car is owned by the employer. Even expenses are incurred by the employer. So my employee is enjoying two benefits, the car benefit and the expenses. Now if the employee is using the car only for official purpose, employee did not get any benefit, so nothing is taxable. If the employee is using the car only for personal purposes, then employee got a benefit. What benefit? Two benefits, car benefit and expense benefit. For car benefit, 10% per annum of the cost of the car is taxable. For expense benefit, the expenses are taxable. Now, both of these put together will become the benefit which employee enjoyed, and this will be taxable. But we always tax the net benefit, which means whatever money employee has paid to the employer, we will subtract, and that's how we will get the net benefit, that is a taxable value. Okay. Then comes the important part. What if the employee is using the car for both the purposes? Then in that case, the taxable value will fully depend upon the cubic capacity of the car. If the cubic capacity of the car is within 1600cc, then 1800 per month will be taxable. If the cubic capacity of the car is more than 1600cc, then 2400 per month will be taxable. Then relating to this last point, remember two extra points I told you. Extra point number 1. In this category, you can have maximum how many cars? Maximum only one car you can have. If you have more than one, the others will be deemed to be personal purpose only. Point number 1. Then extra point number 2. In case along with the car, in this situation, if the employer is giving a driver or a chauffeur also, then in that case, to the taxable value, you will add another 900 per month. And one more special point I had told you, and that is generally whatever money employee has paid to the employer, in all perquisites, we subtract this number generally. But in this third situation, this 1800 per month, 2400 per month straight away will be taxable. So even if the employee has paid any money to the employer, we will not subtract, we will ignore. Hello guys, first bucket. Now keep this knowledge of the first bucket with you and come to my second bucket. In the second bucket, also the car is owned by the employer, but this time the expenses are incurred by the employee himself, which means the employee is getting how many benefits now? Here employee is getting only one benefit, guys. Employee is getting the car benefit. Because expenses he himself is bearing. So only one benefit he is getting from the employer. Employer is giving him a car. Okay guys, now even over here, same three possibilities guys. The employee may use the car for only official purposes or only for personal purposes, or employee may use the car for both the purposes. Accordingly, the taxable value will change. If the employee is using the car for only official purposes, then he did not even get any benefit guys, so nothing will be taxable. If the employee is using the car for only personal purposes, he enjoyed benefit guys, so something we should tax for him. Now what benefit, how many benefits he enjoyed? Only one benefit he enjoyed. Come on guys, no mugging up. These two places and all, no mugging up. Only one benefit he enjoyed, car benefit. For car benefit, what you will take, what taxable value will you take? 10% per annum of the cost of the car. This will become the value of the benefit which my employee got. But in case employee has paid any money to the employer, we always subtract it. Why? Because we don't tax the benefit, we tax the net benefit. So we will see whatever benefit we got from the employer, then we will subtract whatever we paid to the employer. That's how I will get the net benefit number, the taxable value number. Okay, and of course, even over here, if it is taxable for specified employees only. Even in my first bucket, even in my second bucket, it is taxable for specified employee only. Guys. So if the car is used for only official purposes, it is fully exempt. If the car is used for only personal purposes, then 10% per annum of the cost of the car minus whatever money employee has paid to the employer, balance will be taxable. Then what if the employee is using the car for both the purposes? What if the employee is using the car for official and personal purposes? Then the taxable value will depend upon the cubic capacity of the car. If the cubic capacity of the car is within 1600cc, then 600 per month will be taxable. If it is more than 1600cc, then 900 per month will be taxable. In my first bucket, it was 1800 per month and 2400 per month, right guys? In my second bucket, it is 600 per month and 900 per month. Getting it guys? Again, same thing over here. These are going to be the taxable numbers. Okay, now see, listen carefully. Even over here, of course, we will have some special points. In this third situation, we will have some special points. Special point number 1. Even over here, in case along with the car, a driver or a chauffeur is also provided by the employer, then to the taxable value, you will add another 900 per month. See, all these special points are for the third situation only. So in the third situation, if by chance driver is also provided along with the car by the employer, you will add another 900 per month to the taxable value. Then comes special point number 2. See, here you can have any number of cars. There is no restriction. That restriction on the number of cars was only in my first bucket. Okay. Then third special point, generally whatever money employee pays to the employer, you always subtract. But in my third situation over here, if third situation is applicable, then 600 per month, 900 per month will be straight away taxable guys. So in this third situation, even if employee has paid any money to the employer, I will not subtract, I will ignore. Getting it? Same point you had even in the first bucket. In the third situation, same even here we have. Got it, guys? Can I take you to the third bucket now? Yes, in the first bucket also car was owned by employer. In the second bucket also the car is owned by the employer. The only difference is in the first bucket the expenses were also incurred by the employer, but in the second bucket the expenses are incurred by employee. Okay, guys, and both of these buckets were taxable for specified employees only. In both the buckets, if it is for official purpose, then it was exempt. If it is personal purpose, we did not have to mug up on the basis of the benefits. We arrived at the taxable value. In both the buckets, in the third situation, if driver is also given, we add another 900 per month to the taxable value. In both the buckets, in the third situation, in case any money employee has paid to the employer, we ignore. Okay, guys, now come on, let's go to the third situation. This one's going to be slightly different. Here the employee himself owns a car. Are you noticing the difference? In my first two buckets there was a common point. The car was owned by employer only, but in my third bucket employee himself is owning the car. Only expenses are being met by the employer. So therefore my employee is getting how many benefits now? Here my employee is getting only one benefit, guys, the expense benefit. Car he himself owns. Okay, now listen to me. Surprise number one. Surprise number one, this particular bucket will be taxable for all employees, not just for specified employees. Which means in my first two buckets, when the car is owned by the employer, that is only for specified employees. But in my third bucket, where the car is owned by employee himself, only expenses are met by employer, this perquisite will be taxable for all employees. Only expense benefit will be taxed for all employees. Okay, guys, now listen. This was a surprise number one, that it is taxable for all employees. Now comes surprise number two. In this third bucket, there is nothing to mug up. Full pure logic, I will tell you. I've made it a little different. The presentation is a little different. It will help you understand very nicely. Listen to me. The second surprise is that doesn't matter what purpose, doesn't matter what the employee is using the car for. We will do one single calculation, all the three will get covered. So we don't have to learn three different tax implications over here. One tax calculation we will learn, all the three purposes will get covered over here. So first of all, what is the benefit which my employee got over here? Expense benefit. So we will start with that, guys. That is a benefit which my employee got. Now from this we will subtract the official expenses met by the employer. Why? Because if the employer is meeting official expenses, is it a benefit for the employee? No, right? So that's why we'll subtract the official expenses. We'll get the personal expenses met by the employer. This only is the benefit for the employee, right? My personal expenses employer is bearing, that's only a benefit for me. Then from this, so this becomes a benefit, but we always tax a net benefit. So whatever money employee has paid to the employer, we'll subtract that, and that's how I'll get the taxable value. Understanding, guys? So we'll start with the benefit. What benefit employee is getting? Expense benefit. So from that expense benefit we will subtract whatever official expenses employer is meeting. Now we'll get the personal expenses. From that personal expense we will subtract whatever money employee has paid to the employer. We'll get the net benefit, that will become your taxable value. Okay, now see, if the employee is using the car only for official purposes, let's say expense met by the employer is 1 lakh rupees. In that case, if the car is being used only for official purposes, then all the expenses will become official expenses, guys. So personal expense will be 0, guys. So taxable value will be 0. But however, what if the employee is using the car only for personal purposes? Then in that case, official expenses will be 0. The entire expenses will become personal expenses. So entire 1 lakh will become taxable. You're understanding now why I'm telling you that the same calculation, the same steps itself will handle every situation for you. The whole trick will apply in the situation where the employee is using the car for both the purposes. What if the employee is using the car for official purposes and personal purposes? Then how will you find how much is official expense and how much is personal expense? How will you find that? For that, we have a small provision. The law says that, listen, assessee, to find the official expenses, we will first check whether the employee is maintaining one logbook or not. If logbook is being maintained, on the basis of the logbook, we will get to know how many kilometers car was driven for official purposes, how many kilometers a car was driven for personal purposes. Like for example, let's say my assessee has driven for 1000 kilometers for official purposes, and for 2000 kilometers he has driven for personal purposes. Okay, which means he is using the car for official purposes and personal purposes in the ratio 1:2. Now let's say my assessee has incurred 12,000 rupees expense for the car, which was met by the employer. That's the benefit over here, right? Expense is being met by the employer. 12,000 rupees expense was met by the employer. This 12,000 rupees I will split into official and personal in the same ratio 1:2, guys. So 12,000 into 1 by 3, which is 4,000, will become your official purpose. Then 12,000 into 2 by 3, that is 8,000, will become your personal purpose. Getting it? So if a logbook is maintained by the employee, then on the basis of the logbook, the expenses will be split between official purposes and personal purposes. But the problem is that it is not so simple to maintain a logbook. So if a logbook employee is not able to maintain, then in that case, the official expense will depend upon the cubic capacity of the car. Is it within 1600cc or is it more than 1600cc? If it is within 1600cc, then 1800 per month. If it is more than 1600cc, then 2400 per month. Now comes $1,000,000 question. This 1800 per month, this 2400 per month, what is this taxable value? No chance, guys. What are we trying to understand right now? We are trying to understand right now how much will our official expense be. That's what we're trying to find. So for that only we are coming to the logbook. Oh, logbook is not maintained. Now we will come to the cubic capacity. So these numbers, 1800 per month, 2400 per month, what will these become? These will become your official expense. Okay, so and of course if a driver is being if driver expenses are also being met by the employer, then you will add another 900 per month to the official expense. You're understanding? From the logbook, from these numbers and all, you're calculating the official expense. Got it, guys? So this is only the mistake possible, that you should not start thinking that these are the taxable numbers. These are the official expenses. Okay. So if the car is owned by the employee himself, only expenses are met by the employer, then this perquisite will be taxable for all employees, not only for specified employees. Instead, it will be taxable for all employees. Doesn't matter what is the employee using the car for. The main steps to compute the answer will be the same only. You will start with the expense met by employer. You will subtract the official expenses. You will get the personal expenses. You will subtract whatever money employee has paid to the employer, and you will get the taxable value of the perquisite. Okay, guys. Then how to find the official expense? For that only we will see is employee maintaining logbook or not. If he's maintaining logbook, great. We'll take the numbers from there. If he's not maintaining logbook, then 1800 per month, 2400 per month will become the official expenses. Okay, guys. Now see one small summary chart I've made for you over here. Total 3 buckets we have, guys. First 2 buckets I've shaded in one color because first 2 buckets are taxable only for specified employees, whereas the last bucket is taxable for all employees. Then in the first bucket, the employee is getting 2 benefits. He's getting the car benefit also and the expenses benefit also. Both are met by the employer. And here, if you remember, we had a unique point in the first bucket, and that is in the third situation, we can have maximum 1 car only in the third situation. If you have more than 1 car, then deemed to be personal. Okay. Then in the second bucket, my employee is getting only 1 benefit, and that is he's getting the car benefit. Here, the expenses are being met by the employee himself, so only the car benefit he's getting. So here there was no limit on the number of cars, guys. Employee can have any number of cars in this category. There was no limit. Then in my third bucket, the employee got only 1 benefit again, and that was the expenses benefit. Expense was met by employer. But here the car was owned by employee himself. So only 1 benefit he got, and that is the expense benefit. Here there was no limit on the number of cars. So basically we have limit on the number of cars. Only only 1 car you can have. Only in the third bucket, only in the third situation of my first bucket. Car owned by employer, expense incurred by employer. In this situation, in the third situation where the car is used for both purposes, here only you have this one limit that you can have only 1 car. You don't have any limit on the number of cars anywhere else. Okay. And one more thing, remember, guys, every time whenever you calculate the taxable value of perquisites, you always subtract whatever money we're recovering from the employee, but only in the first bucket in the last situation, and in the second bucket in the last situation. Only in these 2 situations we don't subtract any money which employee has paid to the employer. Okay, this was a discussion about motor car perquisite, guys. This was a very, very important discussion. Now come on, let's move on to leave travel concession, LTC. Now first understand what exactly happens over here. Let's say employee along with his family is going on a vacation. Now if he goes on a vacation, there will be so many expenses, guys. There will be travel expense, there will be stay expense, there will be food expense. So many expenses will be there. Now the employer is helping the employee meet the travel expense. That is called as leave travel concession. So here in leave travel concession, employer is helping you meet your travel expenses. Now this is definitely a benefit for the employee, guys. Come on, I along with my family, we are going on a vacation. It's a totally a personal expense, and whatever is my travel expense for this entire travel, the whole travel expense is being met by the employer. It's a big huge benefit for me, but this benefit is a fully exempt perquisite. Yes, it's a benefit, but it's a fully exempt perquisite. But however, some conditions have to be fulfilled, obviously. Condition number 1, who is traveling? Employee is traveling along with his family members. Employee is traveling. Then where are they traveling? They're traveling anywhere in India, guys. Now comes the next question, where are they traveling to? They're not traveling to New Zealand. No, they're traveling to Shimla, guys. So they're traveling anywhere in India. Then comes the third question, can they travel 10 times in the year also? Will every time travel expense met by employer be exempt? No, that's a limit. The limit is very unique limit over here. Listen carefully. In every block of 4 calendar years, in 4 calendar years put together, only 2 vacations the travel expense met by employer will be exempt. You're understanding? Like, let's say the employee is going on a vacation every year, or let's say employee is going for 2 vacations every year, and every vacation the travel expense is being met by employer. Okay. Now, out of all those travel expenses being met by employer, only twice employee can get exemption, which means the other occasions when the employer is meeting the travel expense, that will become a taxable perquisite. Getting my point, guys? So we have totally 3 conditions. Okay, all the 3 conditions have to be fulfilled, only then the LTC will be exempt. The first condition is that who is traveling? Employee is traveling along with his family members. Then comes the second question, where are they traveling to? They're traveling anywhere in India. Domestic vacation, not international vacation. Which means if international vacation, if the employer is sponsoring your travel ticket and all, it will become a taxable perquisite. Only if the vacation is in India, only then in that case a domestic vacation travel ticket, if the employer is meeting the expense, it will be an exempt perquisite. Okay. Third condition, the exemption you can enjoy only 2 times, only twice in a block of 4 calendar years. Getting my point, guys? So in 4 calendar years, you can take 10 vacations, 20 vacations, take how many ever vacations, but only 2 times you can get exemption. Okay, guys, now listen, one unique situation might arise. In that situation, let's say my employee has not taken even 1 vacation over here. 0 vacations he has taken, guys. So which means he has not enjoyed any exemption at all in these 4 calendar years. Now comes the next block of 4 calendar years. Now in these next 4 calendar years, he can take 2 vacations and he can enjoy exemption for 2 vacations. Now the thing is, because in this first block over here, he has not even taken even 1 vacation, we will let him carry forward, guys. He can carry forward 1 vacation, which means in the second block of 4 years, he can now take exemption for 1 plus 2, 3 vacations. Okay, but there's a small catch. The catch is this carried forwarded vacation, he has to enjoy this exemption in the first year of this next block. Okay, same way, guys, same way. What if in this block, in this first block, the employee took only 1 vacation? Only 1 time he enjoyed exemption. 1 more time he can take. Even now we will let him carry forward that 1 balance vacation. Same thing, he can take this 1 balance vacation in the next block. So in the next block, 1 plus 2, total 3 times he can enjoy exemption. But the carried forwarded exemption you can take in the first year only. Okay, guys, so remember, in any case, okay, you can carry forward maximum how many exemptions? Only 1 exemption you can carry forward. That too, that carried forward exemption you have to enjoy in the first year of the next block. Crystal clear, guys? So simple points in LTC. First of all, the employer is meeting a travel expense, not hotel expense and all. He's meeting a travel expense. It's a benefit for you. Your personal family vacation, employer is meeting travel expense. It's a benefit for you. So therefore, the perquisite has to be taxable for you. But there are conditions, 3 conditions. If all the 3 conditions are fulfilled, the travel expense of yours being met by the employer, this leave travel concession perquisite will be exempt for you. Condition number, the 3 conditions. Condition number 1, you must be traveling along with your family. Condition number 2, anywhere in India. Condition number 3, exemption you will get only for 2 vacations in a year. Got it, guys? Then listen to my next part. Now when I say family, what does family mean over here? Interesting point, important point. Until now we saw family only in one place, guys, in a medical reimbursement discussion. There we said medical bill reimbursement will be exempt if the treatment is for a specified patient. Who was specified patient over there? 3D plus spouse. Same thing even over here, guys. Even over here family refers to 3D plus spouse, but there is one small catch over here. First of all, 3D plus spouse means what? First help me draw the diagram. First I will draw a plus. Then I will write the letter D in 3 places, and then I will write the word spouse. Okay, now children are covered over here, guys, in this definition of family. There's a limit over here that we can get exemption for maximum 2 children only, which means if the employee is having 3 children, and for all the 3 children the travel expense if the employer is meeting, then for the travel expense proportionate to 2 children only will be exempt. The travel expense proportionate to the 3rd child which is being met by the employer, that proportionate travel expense relating to the 3rd child will become taxable for the employee. Got it, guys? So here we have the 2 children limit. I'll repeat once again, in our entire syllabus, 2 children limit we have in 4 places. Children education allowance, children hostel allowance, LTC, and later tuition fees in ATC. Okay guys, so till here everybody's crystal clear. Now listen, let's go a little deeper. See, what if the employer is meeting my hotel expense also? Then no exempt, all that will be fully taxable. This entire exemption, these conditions and all are only for travel expense guys. So if the employer is meeting my hotel expense and all, that will be fully taxable in all cases, nothing to think itself. Alright, now there's one more point, okay. See, if children are born before 1st October 1998, then I will not even apply the limit of 2 children. Which means, if the children are born before 1st October 1998, 2 children, 3 children, 4 children, 5 children, how many ever children I have, for all the children the travel expense met by the employer will be exempt. So when will I apply the 2 children limit? I will apply the 2 children limit only and only if the children are born after 1st October 1998. That's all guys. This is it about my entire LTC discussion. 2-3 last few points. See, in LTC the employer is meeting my travel tickets guys. What if those travel tickets are business class air tickets? Then in that case only up to economy class airfare only it will be exempt. Like for example, let's say I'm going from Chennai to Delhi. Chennai to Delhi, economy class airfare is let's say 5,000 rupees. But I took business class ticket guys, and my business class ticket was let's say 12,000 rupees. This full 12,000 rupees was met by the employer. Now in this case, I will get exemption only up to 5,000. So the balance 7,000 which the employer is meeting, which is over and above the economy class airfare, that excess above economy class airfare will become taxable for me. Okay guys, then what if the employee doesn't even go on the vacation? He simply tells the employer, what if I had gone on the vacation, then you would have met my travel expenses. But see, good for you, I did not go on the vacation, I worked extra for you. Now had I gone on the vacation, you would have paid 10,000 for my travel tickets. Those 10,000, the 10,000 you give me in money. Which means employee is not going on the vacation, but he's encashing the LTC. Without going on the vacation, he's getting money from the employer. This and all will be fully taxable guys. Okay, and lastly, there's no monetary limit of LTC exemption. There's no limit on the amount that how much exemption you can enjoy. The limit is only on the number of vacations that you can enjoy exemption for maximum 2 vacations in every block of 4 calendar years. Simple guys. So 7 to 8 points only. I'll quickly revise them for you. Listen to me guys, let's nicely revise all the 7 to 8 points. Point number 1, in LTC the employer is meeting your travel expense. You along with your family are going on a vacation in India. So for that vacation, whatever are the travel expenses, those travel expenses are being met by the employer. So this LTC perquisite for you, it's of course a benefit for you. So therefore this benefit will be taxable for you. Then comes second point, this benefit will be exempt for you if 3 conditions are fulfilled. Condition number 1, employee along with his family is going on a vacation. Condition number 2, anywhere in India. Condition number 3, exemption is only 2 times in every block of 4 calendar years. Then comes my third point, that in case you're not able to enjoy exemption, then in that case we will carry forward maximum 1 vacation only. And that carried forward vacation also you have to enjoy in the first year of the next block. Okay. Fourth point, family means what? 3D plus spouse. But in children, you have a limit over here, maximum 2 children only you can enjoy exemption. So if you are getting LTC for more than 2 children, then whatever is the excess number of children, proportionate to that, your LTC will become taxable. Then comes the fifth point, if the children are born before 1st October 1998, I won't even apply the limit of 2 children. Only the children born on or after 1st October 1998, for those children only, the 2 children limit will apply. Then comes my sixth point, if it is business class ticket, then in that case, up to economy class airfare, LTC will be exempt. The excess above economy class airfare will become taxable. Seventh point, if the SSE doesn't even go on the vacation, simply encashes the LTC, then in that case, that encashed LTC will be fully taxable. And the last point, the 8th point, there is no monetary limit of LTC exemption over here. There's only a limit on the number of vacations. There's no limit on the amount of exemption. Okay. Now I know you might be thinking, ma'am, what about default regime? What about optional regime? In my entire discussion, I haven't even spoken to you about optional regime and default regime in the salaries chapter, guys. Wait for it. In every head of income, at the end of the head of income, I will tell you what will change because of the change in regime. Okay, first my entire discussion will be as per the optional regime only, as per the old regime only. Only towards the end of the chapter, I'll give you that comparison. Okay, that way you will not have any confusion during my main discussion. Okay, so this was our entire discussion about LTC. Now listen, let's move on to our next perquisite, which is interest-free loan or loan at concessional rate of interest. So here what happens is that the employer is giving a loan to the employee. Now in return, employee has to give interest, guys. Either this interest will be no interest, which means either the employee will give no interest or this interest will be low interest, which means lesser than the market rate. Now you will ask me, ma'am, what is the market rate? The market rate over here will always be the SBI lending rate. SBI lending rate. Now SBI lending rate will change from date to date. You will see the SBI lending rate not on the date of the loan. No, SBI lending rate you will see on the 1st April of the previous year. That will be considered to be the market rate of interest. Like for example, let's say SBI lending rate on the 1st April of the previous year is 8%. But my employer is giving a loan to the employee at only 5%. So don't you think, guys, my employee is getting 3% benefit, 3% interest, he doesn't even have to pay. It's a big, huge benefit for him. He's having such a huge savings in interest. That 3% interest which he's saving, no, that will become the taxable perquisite. Always remember, guys, in this perquisite, the loan is not the benefit. The benefit is the lesser interest. The benefit is a savings in interest. So in my example, employee has to pay 3% less interest. That 3% less interest, that becomes a taxable perquisite. Crystal clear till here? So point number 1, the employer is giving a loan to the employee. Point number 2, either zero interest or less interest. Point number 3, less interest means what? It is lesser than the market rate. Point number 4, what is the market rate? Market rate will be the SBI lending rate. SBI lending rate on which date? Not on the date of loan. SBI lending rate on the 1st April of the previous year. Simple, guys, very easy point. Now listen, there are 2 situations where this perquisite will be exempt. There are 2 situations where this perquisite will not be taxable. Situation number 1, amount of loan. Situation number 2, purpose of loan. Nothing complicated. Without any tension, listen to me with a calm mind. So exemption number 1, the purpose of the loan. If the loan has been borrowed by the employee for medical treatment of Rule 3A disease, either the employee or his family members are suffering from Rule 3A disease, for medical treatment of the disease if he's borrowing the loan, then I don't care about the amount of the loan. I don't care about the extent of the benefit. The perquisite will be fully exempt. Okay. Then comes the second exemption. In the second exemption, the amount is a criteria. If the amount of the loan is within 20,000, it is not more than 20,000, then in that case, the perquisite will be fully exempt. So the first exemption cares about the purpose, the second exemption cares about the amount. If the purpose of the loan is medical treatment of Rule 3A disease, perquisite is fully exempt. In that case, I don't care about the amount. In the second exemption, if the amount of the loan is not more than 20,000, it is fully exempt. Then in that case, I don't care about the purpose of the loan. Okay, they are not cumulative conditions, guys. We have the word or, which means out of the 2 situations, if even one situation is existing, then the perquisite will be an exempt perquisite. Okay, now this 20,000 point, you have to be careful. What has to be within 20,000? The outstanding amount? No, the original amount, guys. The original amount has to be within 20,000. Okay, and will the 20,000 limit apply for each loan separately? No, it will apply to the aggregate loan. Okay, you'll understand a little better with the help of these situations. I have 4 situations for you. You'll get perfect clarity. Okay, listen to me. In the first situation, the employer gave a loan to the employee 2 lakh rupees. So this is the original amount, guys, at 2% interest long back in 2021. The outstanding amount on 1st April 25 is 15,000 only. So this is the original amount 2 lakhs. Outstanding amount is 15,000 only, which means balance employee has repaid. SBI lending rate on 1st April 25 is 5%. Question number 1, has employee enjoyed a benefit? Definitely yes, guys. Market rate is 5%. Employee is paying only 2%. So first of all, he did get a benefit. 3% benefit he got. Question number 1. Then comes my question number 2. Tell me, is any of the exemption applicable over here? Is a loan for medical treatment of Rule 3A disease? No. But is the aggregate original amount within 20,000? Will you say 15,000 within 20,000? Hence, second exemption is applicable. Be careful, guys. You will not look at the outstanding amount. You're supposed to look at the original amount. Now, do you understand the significance of this word? You will look at the original amount. The original amount is 2 lakhs. Is it within 20,000? No, guys. It is more than 20,000. Therefore, neither is this exemption applicable nor is the second exemption applicable. Hence, this is going to be a taxable perquisite. Understanding. So the lesson that you have learned from my first situation is the outstanding amount, whether it is within 20,000 or more than 20,000, I don't care. The original loan has to be more than 20,000. Here original loan is 2 lakhs. It is more than 20,000. Therefore, it will be a taxable perquisite. Okay. Then comes my second situation. In my second situation, employer gave 2 loans to the employee, guys, at 2%. Loan 1 is 15,000 and loan 1 is 15,000 and loan 2 is 10,000. Okay. The SBI lending rate on 1st April 25 is 5%. Question number 1. Did the employee enjoy a benefit? Of course, he got a benefit, guys. Market rate is 5%. He's going to pay only 2%. So definitely he got a benefit. He got a benefit of 3%. Then before you calculate the taxable amount, you will ask me, is any exemption possible or not? Two exemptions we have. Tell me, is a loan borrowed for medical treatment of Rule 3A disease? No, guys. Then tell me, is the loan amount within 20,000? Loan 1 is also within 20,000. Loan 2 is also within 20,000. Terrible. That's not how you think. You're always supposed to look at the aggregate loan, not separate loan. You're supposed to look at the aggregate loan. So aggregate will be 15,000 plus 10,000. Aggregate will be 25,000, which is more than 20,000. Hence, even this will become a taxable perquisite. Now, are you properly understanding the significance of both of these words, guys? The aggregate original loan has to be within 20,000. Aggregate indicates you will not look at each loan separately. You will look at all the loans put together. Original indicates you will not look at the outstanding amount, whether it is within 20,000 or more than 20,000. You will look at the original amount, whether that is within 20,000 or not. Okay. Then comes my third situation. This I think easily you will be able to handle. Employer gave a loan to the employee, 2 lakh rupees at 2% on 1st June 2025. Okay. Now, 3 SBI lending rates are given to you on 1st April 25. That is in the beginning of the year. Then date of loan is 1st June 25. So on the date of loan, SBI lending rate is given to you. Then end of the year also SBI lending rate is given to you. This I've already told you, guys. You're always supposed to look at the SBI lending rate in the beginning of the year. That is on 1st April 25. The SBI lending rate on the date of loan is irrelevant for me. Only one SBI lending rate is relevant for me, and that is SBI lending rate in the beginning of the year. Okay. Then comes my fourth situation. This is going to be a good morning moment for you. Listen carefully. Employer gave a loan to the employee, 2 lakh rupees at 8% on 1st June 25. SBI lending rate in the beginning of the year is 5%. So can I say, oh, there's a difference of 3% now? So 3% benefit. Guys, no. You have to be careful. See, your employee will get a benefit only if he is paying lesser interest, which means the interest which he is paying has to be less than SBI lending rate. Just because these two numbers are different, don't straight away subtract. First of all, employee must be enjoying a benefit. So here if you see, he is paying 8%. Market rate is only 5%. Guys, he is paying even more than market rate. Are you listening to me? Yes, have you woken up? He is paying 8%, guys. Market rate is only 5%. He is paying even more than market rate. Has he enjoyed any benefit? He hasn't even enjoyed any benefit. So therefore, nothing will be taxable over here. Okay, so this situation teaches you a lesson that just because the rates are different, don't blindly subtract them and call it as taxable perquisite. No. First, check whether employee is enjoying a benefit or not, which means the rate which he is paying has to be less than the market rate. Only then you can see that he has enjoyed a benefit. Only if he is enjoying a benefit, only then the perquisite will be taxable. Got it, guys? So till here, are you perfectly clear? So here, the employee, in this entire discussion, my employee is enjoying a perquisite which is saving in interest. He's paying lesser interest than the market rate. Market rate will be SBI lending rate in the beginning of the year. Two exemptions we have: if the purpose of the loan is medical treatment of Rule 3A disease, or if the aggregate original loan is within 20,000, then the perquisite will be exempt. Aggregate loan, not separate loan. Original loan, not outstanding loan. Okay. Now listen, okay, something very interesting. Let us say long back, in 2021, long back, the employer gave a loan to the employee, a loan of rupees 2 lakhs. Okay. And this loan was to buy a vehicle. Okay. Current year, 25-26, in the beginning of the year, if you see, only 15,000 loan is outstanding. Okay, and my employer is charging interest at the rate of 2%, and let us say SBI lending rate on 1st April of the previous year is, let's say, 5%. Point number 1. First of all, is the employee enjoying a benefit? Of course, he's enjoying a benefit, guys. Market rate is 5%. Employee is paying only 2%. So first of all, clearly 3% benefit my employee is getting. Okay, guys. Then before you calculate the taxable value, you first check whether any exemption is possible at all. First tell me, is a loan for medical treatment of Rule 3A disease? No, the purpose of the loan is to buy a vehicle. It's a vehicle loan, it's not a medical treatment loan. That exception is not applicable. Then tell me, is the aggregate original loan within 20,000? Original loan, guys. Original loan is 2 lakhs. Is it within 20,000? No. I don't care. See, 15,000 is the outstanding amount. Whether the outstanding amount is within 20 or more than 20 doesn't matter. What matters is the original loan has to be within 20,000. No, guys. Original loan is more than 20,000. So, which means, first of all, do you agree that none of the two exemptions are applicable? Hence, first of all, do you agree it's a taxable perquisite, guys? Yes. And if it's a taxable perquisite, we tax a benefit. What's the benefit? 3% interest my employee is saving. Now my $1 million question for you is, this 3% will be 3% of what? Will it be 3% of the outstanding amount, or will it be 3% of the original amount? This is where you have to be ready for one eye opener. Listen to me, guys. When you're checking the 20,000 number, for the 20,000 number you will look at the aggregate original loan. 20,000 number you will look at the original loan. But when you're calculating the taxable value of the perquisite, when you're calculating the interest which is being saved, come on everybody, common sense, basic math, basic accounting, basic financial point. Interest is always a percentage of the outstanding amount. Right, guys? So what is outstanding? 15,000 is outstanding. So 3% into 15,000, this will become a taxable value. So this is a place where a lot of times silly mistake happens. I hope it's nice and clear in your memory. No need to mug up. It's very logical. The 20,000 limit I will apply on the aggregate original amount. But when I am calculating the taxable perquisite, I am calculating interest as a percentage of something. Interest is always a percentage of the outstanding amount only. So therefore, when I am calculating the taxable value, that time I will take the outstanding amount. Okay, guys, then see, there's one more possibility. Okay, don't you think I might repay the loan in between the year? In simple words, the outstanding amount may change in between the year. So in that case, how will you calculate the taxable value of the perquisite? Okay, fine, we have to take the outstanding amount. When we calculate the taxable value, we have to take the outstanding amount. Fine, understood. But what if that outstanding amount changes in between the year? Then what will you do? That is why the provision says we have to take the outstanding amount at the end of every month. So in case there are repayments during the year, you will calculate the taxable value for every month. At the end of every month, you will see what is the outstanding amount. On that outstanding amount, you will calculate the taxable value. Nothing to get confused. Listen to me as carefully as you can. Amazingly, you will understand. Let us say in the beginning of the year, okay, on 1st April 2025, 15,000 rupees was outstanding in our example, guys. Then let's say on the 6th of June 2025, my assessee repaid 1,000 rupees. So now only 14,000 is outstanding, guys. Then on the 18th of December 2025, my assessee repaid 2,000. So now only 12,000 is outstanding, guys. So now in this situation, how will you calculate the taxable value? See, this much we know by now, that when we're checking the 20,000 number, for that we will take the original amount. But when you're doing the calculation of the taxable value, you will take the outstanding amount. But which outstanding number you will take? The outstanding number is changing again and again. In such cases, you will start doing monthly calculation. Very easy, nothing to worry. Stay calm and listen. April and May, no change, guys. These 2 months, how much is the outstanding amount? 15,000. 15,000 into 3%. Remember, in our example, benefit was 3%. So 15,000 into 3% into 2 by 12. Whatever you get over here, this will be the taxable value for April and May month. Okay. Then in June month, you are repaying. So see, you're repaying on 6th of June. Whether you repay on the 1st of June, whether you repay on the 10th of June, whether you repay on the 30th of June, I don't care. End of June, what is the outstanding amount? That's why I've mentioned over here outstanding balance at the end of the month. Okay, end of June, what is the outstanding amount? 14,000. So 14,000 into 3% into how many months? See, this repayment happened in June. So June, July, August, September, October, November. So June to November, these 6 months, the outstanding amount at the end of each of these 6 months will be 14,000. So 14,000 into 3% into 6 by 12, this will be a taxable value. Okay, then December month, we are repaying another 2,000. So December month, only 12,000 is outstanding. Again, same thing I'll tell you. Whether repayment is happening on 1st of December or 15th of December or end of December, it doesn't matter. Because we have to see how much is outstanding at the end of the month. At the end of December, how much is outstanding? 12,000. That is the number I will take. So December to March, in this entire period of 4 months, 12,000 is outstanding. 12,000 into 3% into 4 by 12. So whatever numbers you get over here, when you add these up, this will become the taxable value of your perquisite. Understanding? It's very interesting. That is why three things you have to remember now. Thing number 1, when you're checking the 20,000 criteria, you will check the original amount. Then thing number 2, when you're calculating the taxable value, you will calculate on the outstanding amount. Then thing number 3, in case the outstanding amount changes in between the year, then you will see what is the amount outstanding at the end of that particular month. Got it, guys? So this was your discussion about the outstanding balance point. Now coming to one last point in our interest discussion, in this interest perquisite discussion, I'll straight away give you an example to help you understand, okay? Very simple point, listen to me carefully. See, until now we have learned the two exceptions where the perquisite will not be taxable. Then we have learned that whenever you're calculating the 20,000 number, you will look at the original loan. Then when you're calculating the taxable value of the perquisite, you will look at the outstanding amount and outstanding amount at the end of the month. Okay, now one final point in this entire discussion. See, what if the loan is given by the employer for medical treatment of Rule 3A disease? Let us say employer has given a loan of 25,000 rupees at, let's say, 5% interest, okay? And the SBI lending rate is, let us say, 8%, alright? And the loan is given for medical treatment of Rule 3A disease. Immediately, what will you conclude, guys? Immediately, you will conclude that the perquisite is going to be fully exempt. Doesn't even care, I don't even care what the amount of the loan is, because the purpose of the loan is medical treatment of Rule 3A disease. You will straight away say that the perquisite is exempt. Okay, guys. Now, but however, I'm not stopping my story over here. I'm saying that, let us say this loan was given to the employee on the 1st of June 2025, and later, let's say, because it's a medical treatment, by chance, luckily, my employee also had a medical insurance policy. So let us say on the 1st of Jan 2026, for the same medical treatment, my employee also got medical insurance compensation of, let's say, 8,000 rupees. Now see, don't you think it is unfair? Don't you think for the same medical treatment, assessee is getting two benefits, guys? Assessee is getting a loan at concessional rate of interest from the employer. Assessee is also getting medical insurance compensation from the insurance company. For the same medical treatment, assessee is getting two benefits now. This is becoming unfair. Because this is becoming unfair, this exemption which you had given earlier, gone, this exemption will go off. But however, be careful. You got double benefit to what extent? Only to the extent of 8,000 you got the double benefit, guys. So you got a loan of 25,000, right? This 25,000 loan I will split into two parts. I will split this 25,000, number one, into 8,000, basically the extent to which I got the double benefit, and then the balance 17,000. Here there is nothing unfair, guys. For the 17,000, I got only one benefit, which is a loan benefit. So therefore, this will continue to stay exempt, no problem. The whole unfair thing is for this 8,000 only. To this extent only, I got double benefit. So on this 8,000, whatever interest I'm saving, 8,000 into, what's the interest I'm saving? SBI lending rate is 8%. I have to pay to the employer only 5%. So 3% is the interest I'm saving. This will be taxable for how many months? When did I get the double benefit? Only on 1st Jan. So Jan, Feb, March, only for 3 months. You're understanding? This is what will be taxable. Getting it, guys? I want you to all open your eyes and see very clearly. Because assessee is getting two benefits, are we taxing the medical insurance compensation? No, we are not taxing the medical insurance compensation, guys. Medical insurance compensation is never taxable. We are not taxing the medical insurance compensation. Instead, what we're doing is, because the assessee is getting medical insurance compensation, because of that, the exemption which assessee had enjoyed earlier, we're taking away that exemption with respect to this loan perquisite. Getting it? But then we are also not taking away the exemption on the entire loan perquisite. We are not taking away. Only on the double benefit amount, only on this 8,000 amount, whatever interest my assessee is saving, to that extent only it's going to be taxable. The balance 17,000 loan, on that whatever interest is the saving, that will continue to stay exempt only. Got it, everybody? And once again, I'm telling you the point. Don't think that we're taxing the medical insurance compensation. We're not taxing that. To that extent, whatever loan we got from the employer, on that loan, whatever interest we are saving, that alone is becoming taxable. Okay, so don't mug up, understand it very logically. Got it, guys? So this was a big, huge discussion we had on this interest-free loan. I spent a lot of time over here. I really hope it was beneficial. I hope this discussion was like one eye-opener for you. Very, very important perquisite, guys. I hope you're nice and confident. Moving on to our next discussion. Now, this is going to be all about sweat equity shares and ESOPs. See, when it comes to ESOPs, basic points you know very well already. You know that ESOPs are options which employer is giving to the employee. An option that if the employee wants, the employee can buy shares of the employer company. And these shares employee will not get for free. Employee has to pay for the shares. And the price which the employee pays for the shares is called as the exercise price. And generally the exercise price is lesser than the fair market value. right guys? That's a benefit which the employee gets, right? Like for example, their shares worth 500 rupees, but my employee has to pay exercise price of only 100 rupees. So now my employee is enjoying a benefit of 400 rupees per share, and this is what is taxable under the salaries head. Simple guys. So in salaries head, what do we tax? The difference between the fair market value and the exercise price, the difference is what we tax under the salaries head. But life is not so simple also. You have to remember two important points when it comes to the salaries head. Important point number 1, the fair market value they will give you on various dates in the examination. You're supposed to take which fair market value? You are supposed to take fair market value on the date of exercise of option. Okay guys, first important point. Second important point is, what's a taxable value? Taxable value is 400 rupees in our example, but when will you tax this 400 rupees? When will you tax this difference? You will tax this difference only in the year of allotment. Okay, so two dates will be relevant for you. Number 1, the date of exercise of option. Why is that date relevant? Because FMV you will take on the date of exercise of option. Then whatever taxable value you have, when will this 400 be taxable for you? Only upon allotment. Okay guys, this is in the salaries head. Now see, let's say the employee has exercised the option, employee has purchased the shares. Now later, when the same employee sells away the same shares, that time there will be capital gains in the picture guys. Now this capital gains, for this only our next special point is, see, when you're computing capital gains, what will be the cost of acquisition? See, the employee actually has paid how much for the shares? Actually, he has paid 100 rupees only, but this will not be the cost of acquisition. Instead, the same FMV number 500 rupees, that is the same FMV on the date of exercise of option, that same FMV number will be deemed to be your cost of acquisition. That's it guys. Small, simple, sweet little discussion. Sweat equity shares, ESOPs will have an implication under two heads of income. It will have an implication under the salaries head of income also, in the capital gains head of income also. Salaries head of income, when will this come into the picture? When the employer gives ESOPs to the employee. So here, whatever is this difference between FMV and exercise price, this difference will be taxable for the employee under the salaries head. When? Only upon allotment. Okay, and don't forget, FMV you will take on which date? FMV you will take on the date of exercise of option. Then same shares, when the employee is selling away later, that is when capital gains will come into the picture. Now when you're computing capital gains, your cost of acquisition actually is this 100 rupees which you have paid, but I will ignore this. Instead, the same FMV of 500 will become your deemed cost of acquisition for the purpose of calculation of capital gains. Simple guys. Now come on, let's move on to our next discussion. I just made one small table over here with all transport related adjustments. See, transport allowance 3,200 per month is exempt. Remember, we had learnt this in our allowance discussion. 3,200 per month is exempt only for blind, deaf, dumb and orthopedically handicapped employees. Other employees, transport allowance fully taxable. Then travelling allowance and conveyance allowance, remember guys, this comes under those 7 allowances. So in those 7 allowances, whatever I am actually incurring for official purposes, that only is exempt. Then we had learned one more allowance relating to transport. We had learned if the employee is working in the transport sector, like for example pilot, air hostess, conductor, driver and all. So these employees might get an allowance to help them meet the day-to-day expenses. So this allowance, how much will be exempt? Two numbers you will calculate, 10,000 per month or 70% of the allowance received, whichever is lesser will be exempt, then received minus exempt, balance is taxable. So the first one, transport allowance, and the last one, this allowance given to employees in transport sector, both of these allowances we had seen in our 5 allowances. In these 5 allowances, how much is exempt is given in the act itself guys. So there we had the first one and the last one, and travelling allowance and conveyance allowance, this we had in 7 allowances where whatever we have actually incurred for official purposes exempt. Okay, this was just like a revision of the revision. We had already seen this in our allowances, just giving you a reminder once again. Now everything about food, lunch allowance fully taxable guys. Then this point you already know. These 3 are your new points now. See, any refreshments if you get like tea, coffee, snacks or any non-alcoholic beverage during service, any refreshments if you get, this is going to be fully exempt. Then proper food, lunch or dinner, proper food given to you in remote area or in an offshore location, even this will be fully exempt. Like for example, let us say the employer is sending you in the middle of the Indian Ocean for some oil mining work. Okay, so he's sending you to an offshore location. He's sending you in the middle of the ocean, or let's say he's sending you in some remote corner of Andaman and Nicobar Islands for some assignment. So he's sending you to a remote area. So when he's sending you to a remote area or to an offshore location, and there if he's providing you food, that benefit is going to be fully exempt. Crystal clear guys. So lunch allowance fully taxable always. Refreshments like tea, coffee, snacks and all fully exempt. Proper food in remote area, offshore location fully exempt. But however, in office, you're getting food. Let's say you're getting lunch or you're getting dinner. In office, you're getting food provided in all other cases. It is not offshore location. It is not remote location. It is in office, in proper office. Then in that case, it will be taxable. But how much will be taxable? You will see first of all what is the cost to the employer. Then you will subtract 50 rupees per meal exemption. You will subtract whatever amount the employee is paying to the employer. The balance amount will be the taxable value. Okay. If you remember, I've always given you the PwC example for this, guys. I'll give you the same example once again. When I was working in PwC, they had an option where they used to give us lunch in office itself. And the cost for that lunch for PwC was 150 rupees per employee per lunch. Okay. And they used to charge from us half. They used to charge from us 75 rupees. Okay. So 150 rupees is cost to the employer minus 50 rupees per meal exemption minus whatever amount employee has paid to the employer. So you will now get a balance number of 25 rupees. This is going to become the taxable value of the per visit per meal. So 25 rupees into how many ever meals I took in office. Like let's say I took 300 meals in office. So 25 into 300 will become your taxable value. Easy, guys, simple point, yes. So we'll see what is the cost to the employer. You will subtract 50 rupees per meal exemption. You will subtract whatever amount employee has paid to the employer. The balance will become the taxable value. Alright, guys, this was one discussion about everything relating to food. Now everything relating to telephone allowance, you know very well, it is fully taxable. Telephone bills reimbursement, this also you know it is fully exempt. Remember we learnt reimbursements are generally fully taxable, but telephone bill reimbursement, mobile phone bill reimbursement, internet bill reimbursement always exempt. Medical bill reimbursement generally taxable, but medical bill reimbursement, if it is in a specified hospital for a specified patient, then it will be exempt. You're able to recall, guys. So telephone bill reimbursement fully exempt always. Then comes one more point. This also we've already discussed just some time back. You remember we had spoken about use of movable assets. We had learned where employer is giving a movable asset to the employee. Employee is not becoming the owner. No, employee is only having the possession of the asset, guys, right? If this movable asset happens to be a laptop or a mobile phone or a computer or a telephone, then it will be fully exempt. Now whether the employee is using that for the personal purpose or whether he is using it for official purpose, whether he is using it, whether his family is using it, doesn't matter. Laptop, mobile phone, telephone, computer, employer is giving to the employee for use. Employee is not getting ownership, employee is getting possession. This will always be fully exempt. Crystal clear, everybody? I hope you're getting nice and confident with this discussion. Telephone allowance, fully taxable. Telephone bill reimbursement, fully exempt. Telephone, laptop, computer, mobile phone given to the employee just for use, always fully exempt. Okay, guys. Now come on, let's discuss everything about medical concepts. See, medical allowance, fully taxable. Medical bills reimbursement, this we know generally it is taxable, but if it is in a specified hospital for a specified patient, then it is going to be exempt. Then, so till here you know already, guys. This remaining part is new discussion. By the way, what do you mean by specified patient? Remember, guys, 3D plus spouse. First I will draw a plus, then I will write the word spouse, then I will write the letter D in 3 places. 3D plus spouse, don't forget that. Okay, now listen, come on, let's come to the new points. If you're given medical facility in a hospital which is owned or maintained by employer and the patient is a specified patient, then that medical facility will be fully exempt. First understand, medical bills reimbursement is different, medical facility is different. See, in medical bills reimbursement, you're going to one hospital, you're getting medical treatment. Now whatever is a medical bill, whatever is a hospital bill, you are first paying to the hospital. Then you're coming to the employer, you're showing him the bill and the employer is reimbursing the bill to you. That is medical bill reimbursement. In medical facility, you're directly going for medical treatment to a hospital which is owned or maintained by employer. You don't even have to pay the medical bill. The employer is directly taking care of the hospital bill. That is medical facility. Understanding? There's no reimbursement happening over here. The employer is directly taking care of the medical bill. That is medical facility. So if this medical facility is in a hospital which is owned or maintained by the employer and the patient has to be same specified patient, guys, 3D plus spouse, then that medical facility will be fully exempt. So medical reimbursement also, medical facility also. If it is for specified patient, then it is exempt. Only thing is, medical bill reimbursement has to be in specified hospital. Medical facility has to be in a hospital which is owned or maintained by employer. If the patient is a specified patient, then fully exempt. Okay, then listen to medical insurance premium. If the employer is paying medical insurance premium for the employee or for his family members, that is, if the employer is paying medical insurance premium for 3D plus spouse, it's a huge benefit for the employee. Obviously, guys, come on, employee's medical insurance premium, employer is paying. Employee's spouse's medical insurance premium, employer is paying. It's of course one big benefit for me, but still it's going to be an exempt perquisite. Okay, guys, so medical allowance is going to be taxable, but medical bills reimbursement in a specified hospital for a specified patient will be exempt. Medical facility in a hospital owned or maintained by employer for specified patient will be exempt. Medical insurance premium for a specified patient will be exempt. Okay, guys, then coming to my next point, what if the medical treatment happens to be outside India? Like, for example, let's say the employee fell sick. Now the employee has to get medical treatment in Singapore. There will be 3 expenses, guys, relating to this. Number 1, we will have the treatment expense in Singapore. Number 2, we have to travel to Singapore, so we'll have travel expense also. Now the patient alone will not travel alone. Patient will go along with minimum 1 attendant. So patient plus 1 attendant, travel expense will be there. Now after going to Singapore, you will need some stay, right, temporarily, till that medical treatment is going on. So there will be stay expense for the patient along with 1 attendant. So there will be totally 3 expenses if the treatment is outside India. There will be medical treatment expense, there will be stay expense, and there will be travel expense. There will be totally 3 expenses. Now if these 3 expenses are met by the employer, of course it's a benefit for the employee, guys, because employee's personal expenses employer is meeting. Now because it's a benefit for the employee, there will be something taxable under the salaries head. Very simple, guys. When it comes to medical treatment and stay, up to whatever is permitted by RBI, up to that it will be exempt. Nothing but connect with your FEMA LRS point, guys. So if the employer is meeting medical treatment expense or stay expense which is more than the RBI limit, then whatever is the excess above RBI limit, it is taxable. Simple. So up to RBI limit it will be exempt, more than the RBI limit it will be taxable. Easy point. Then if the foreign travel expense for the purpose of this medical treatment, foreign travel expense if the employer is meeting, then in that case either this perquisite will be fully exempt or it will be fully taxable. Whether it is exempt or taxable, that will depend upon the GTI of your employee. If the GTI of the employee is within 8 lakh rupees, then this perquisite will be fully exempt. If the GTI of the employee is more than 8 lakh rupees, then this perquisite will be fully taxable. Okay, so very different, guys. Medical treatment and stay abroad up to the RBI limit if borne by the employer will be exempt. If it is more than the RBI limit, then the excess above RBI limit alone will be taxable. The travel portion, if it is met by the employer, either it will be fully exempt or it will be fully taxable. Whether it is exempt or taxable is depending upon the GTI of the employee. Your understanding? If GTI of the employee is within 8 lakhs, the travel expense which the employer is meeting will be fully exempt. If the GTI of the employee is more than 8 lakhs, then the travel expense which the employer is meeting will be fully taxable. You're understanding now? So whether the travel expense is going to be exempt or taxable for the employee, that is going to depend upon the GTI of the employee. Simple, guys. So this was our entire discussion about the medical point. So medical allowance fully taxable always, medical bill reimbursement in a specified hospital for a specified patient exempt, medical facility in a hospital owned by employer for specified patient exempt, medical insurance premium paid by the employer will be fully exempt. All of these 3 things, the medical bill reimbursement, the medical facility, the medical insurance premium, in all of these the patient has to be 3D plus spouse. Okay, then what if the medical treatment is outside India for the same specified patient, same 3D plus spouse? If the medical treatment is outside India, there will be 3 expenses: medical treatment expense, stay expense, and travel expense. If all these 3 are met by the employer, then medical treatment and stay up to the RBI limit it will be exempt. Beyond that, excess will be taxable. Travel expense borne by the employer, either it will be fully exempt or it will be fully taxable. That depends upon the GTI of the employee. If GTI is within 8 lakhs, then the travel expense will be fully exempt. If GTI is more than 8 lakhs, then the travel expense met by the employer will be fully taxable. Easy, guys. Now coming to our next discussion, which is all about premiums. Okay, just now we saw, right, that the employer has paid the employee's health insurance premium. We said it is fully exempt. Like this, employer may pay other premiums also for the employee, like employee's life insurance premium employer may be paying, or employee's personal accident insurance policy premium employer may be paying. First of all, do you agree it's a benefit for the employee, guys? Come on, of course it is. No, because life insurance policy is an employee's name, but employer is paying premium. Definitely employee is enjoying a benefit. So any premium premium which employer is paying for the employee, yes, it's a benefit for the employee, but the perquisite is an exempt perquisite except life insurance premium. Are you listening to me? Life insurance premium, if the employer is paying for the employee, it's going to be fully taxable. Apart from life insurance premium, any other premium if employer is paying for the employee, like health insurance premium, just now we spoke about it, or personal accident insurance policy premium, or staff group insurance policy premium, basically except life insurance policy premium, any other premium if the employer is paying for the employee, you will say it's fully an exempt perquisite. Only one premium which the employer is paying for the employee will be taxable, and that is life insurance premium. All other premiums, if the employer is paying for the employee, it will be fully exempt. I'm repeating multiple times, registered in your memory, right? Only life insurance premium paid by the employer for the employee will be taxable. Okay guys, now listen, coming to our next discussion about education. So everything about education I've put in one place. Now over here, one point you're already aware of. Education allowance, 100 rupees per month per child will be exempt, maximum 2 children. This you are already aware of. This was education allowance, guys. Now with respect to education, there can be a perquisite also. So I hope you've understood what exactly I'm trying to do, in the last 3-4 concepts. Like everything about transport, we spoke about it in one place. Everything about food, we spoke about it in one place. Like in this food discussion, this lunch allowance part you were already aware of, but we had 3 extra discussions to do with respect to perquisites. So this way, everything about lunch, everything is about food is for you in one place. Similarly about telephone, everything about telephone we spoke about in one place. Then similarly we spoke about medical, and now we're going to be talking about education. See, education allowance you are well aware of. Now comes our discussion about education perquisite. Education perquisite can be of various categories, okay? Now my very first point, I'm talking about the education of the employee himself. Like the employer is training the employee himself. The employer is educating the employee himself. So in that case, it's definitely a benefit for the employee, guys. Employee is getting more education, getting more training, but it's going to be an exempt perquisite. But this particular point, I'm not going to leave it so easily. Listen to my example, only then you will recall in the examination. Like for example, when GST was brought in, okay, when earlier we had VAT, excise duty, service tax, right? Then later the government removed that and brought in GST. Now imagine in the Big Four, there are chartered accountant employees in the Big Four. Those employees have very good knowledge in VAT, service tax and excise duty. They have no knowledge about GST. Tell me, will that Big Four be able to service the clients? No, right? If the employees itself are not having knowledge about GST, how will they be able to render the service, guys? So that is why what the Big Four did is, when GST was introduced by the government, the Big Four, each of the Big Four had spent a lot of money training the employees on GST. Getting my point, guys? They spent a lot of money in training sessions for the employees, making them aware of the nitty-gritties of GST. This way, what happened? See, according to me, both benefited. The employee also benefited, the employer also benefited. Employer benefited because now the employer is having skilled employees. Employee benefited because employees' skill base has increased. So both have benefited. Has my employee benefited? Definitely employee has benefited. But still it is going to be an exempt perquisite. It will not be taxable. It will be an exempt perquisite. Understanding, guys? This is about the education of employee. Now you will remember, right? This is nothing but staff training. So staff training, no doubt employee will benefit, but it will be an exempt perquisite. Then comes my next point, education expense met by the employer. Education expense reimbursement. See, it is a reimbursement. Any reimbursement, what do we know already? Reimbursements are always fully taxable. Remember, guys, reimbursements are always fully taxable. Only telephone, mobile phone, internet bill reimbursement is always fully exempt. Medical bill reimbursement generally taxable, but only if it is in a specified hospital for a specified patient, even that will be exempt. Apart from that, all other reimbursements are fully taxable. So even this was a perquisite that we were well aware of, nothing majorly new for us. Now comes our main discussion about education facility in a school which is owned or maintained by the employer. Listen to me very carefully. Let's straight away take one example. Okay, let's say we have this school called Tata Memorial School. Okay, for example, and let's say there's a company, let's say a Tata Motors Limited. Alright, guys, now Tata Motors Limited has built the school. They are the ones who own the school. They are the ones who have constructed the school in the memory of Ratan Tata. Okay, guys, now Tata Motors Limited has a lot of employees. Now these employees have children. So these children of these employees and the other family members of the employees, all of these children get free education in the school, for example. See, other outsiders children also come to the school, but even the employees of Tata Motors Limited, they have an option that if they want, their children, children, their family members and all can study in the school free of cost. Big benefit for the employee, guys. His children, his family members can get education without even paying any fee. It's definitely a perquisite, definitely a benefit for the employee. Now listen, because it's a benefit, because it's a perquisite, something will be taxable. How much will be taxable? It all depends upon, first of all, who is the student. Is the student the employee's children, or is the student any other family member? So your first starting point, keep the sequence of thinking ready in your mind. Keep the method of thinking ready in your mind. Your first point in your method of thinking will be, first check who is the student. Is employee's children studying, or is any other family member of the employee studying? If it is employees' children, okay, then in that case you will see what is the cost of education per month. If the cost of education per month happens to be within 1,000 per month, then in that case that perquisite will be fully exempt perquisite. But if the cost of education is more than 1,000 per month, then it will be fully taxable. See, here a lot of silly mistakes are possible, okay. I'm not saying this to scare you. I'm saying this so that you can willingly sit up straight and prepare properly with me. Listen to me with a calm mind, no tension, no hurry. Is it education allowance? No. Had it been education allowance, straight away 100 rupees per month per child will be exempt for maximum 2 children. Balance will be taxable. We know it very well. Then is it education of the employee himself? Is it staff training? No. Had it been that way, then it will be fully exempt. Then is it education expense reimbursement? In my perquisite which I am discussing right now over here, there is no reimbursement happening. It's a facility. And by now you know very well the difference between reimbursement and facility. Had it been education fees reimbursement, that will be fully taxable. Nothing to discuss over there. Now listen, our discussion right now is education facility. Where is this education facility? In a school which is owned or maintained by the employer. When this perquisite comes into the picture, in your method of thinking, what's your first step? What will you check? The first step you will check is, who is the student? Is it employee's children or any other family member? If it is employee's children, then what will you see? You will see what is the cost of education per month. What's the number that comes to your mind? 1,000 rupees. If the cost of education per month per child is within 1,000 rupees, then in that case it will be an exempt perquisite. But if the cost of education per month per child is more than 1,000, then in that case it will be fully taxable. Like for example, let's say the cost of education per month per child is 200 rupees. Now 200 less than 1,000, guys, it will be fully exempt. What if it is exactly 1,000? Even if it is exactly 1,000, it is up to 1,000 per month per child. So even this will be fully exempt. But what if it is 1,100? It is more than 1,000. If it is more than 1,000, guys, we will not tax just the excess. No, if it is more than 1,000, we will tax this 1,100 fully. It will be fully taxable. Getting my point, everybody? Now, another question comes into the picture. This 1,000 per month per child exemption, is it for maximum 2 children? No, guys. Children education allowance here, 100 rupees per month exemption is for maximum 2 children. But here this 1,000 per month exemption, no. Here there is no limit on the number of children. It can be any number of children, just that they must be employees' own children, not any other family member. It should be employees' own children. So if employees' children are getting educated, then if the cost of education is within 1,000 per month, then it will be an exempt perquisite. No limit on the number of children. If the cost of education is more than 1,000 per month, then whatever is the cost of education, it will become fully taxable. Okay, guys, now the first point in your method of thinking was checking who is the student. This entire discussion will apply if the student is employee's children. But what if the student is any other family member of the employee? If the student happens to be any other family member of the employee, like let's say employee's younger sister, or let's say employee's younger brother, or let's say employee's niece or nephew, any other family member, guys, then in that case, I don't care about the 1,000 number. Whatever is the cost of education, no, it will be fully taxable. Got it, guys? So if it is education facility in a school owned or maintained by the employer, you will see who is the student. If the student is employee's children, then you will see what is the cost of education. If it is within 1,000 rupees per month per child, then it will be exempt. If it is more than 1,000 rupees per month per child, it will be fully taxable. And if the student happens to be any other family member, then whatever is the cost of education, it will be fully taxable. And of course, whatever is the taxable number, from that don't forget to subtract whatever money employee has paid to the employer. In every perquisite we do this, guys. Only in motor car perquisite we had 2 situations where we don't subtract this number. Apart from that, in every perquisite, whatever money employee has paid to the employer, we subtract from the taxable number. Okay, guys. Then coming to my next discussion, everything about interest. See, interest from SPF, fully exempt under salaries, guys. Statutory provident fund, any interest you get from statutory provident fund, always fully exempt. Under which head? Under the salaries head. Then interest from RPF, up to 9.5% per annum interest will be exempt. Beyond 9.5%, whatever is the excess interest will be taxable. If taxable under which head? Under the salaries head. Then PPF interest will also be fully exempt always, but that is under the IFOS head. Okay. When it comes to interest from URPF, remember, guys, URPF year on year, month on month, no tax implications. Tax implications will come into the picture only when we withdraw the money later. So when we withdraw the money later, we split that money into 4 parts. Remember, we had discussed this sometime back only. So whatever is the interest on employees' contribution, that will be taxable under the IFOS head. Whatever is the interest on the employer's contribution, that will be taxable under the salaries head. Okay, so SPF interest exempt under salaries, RPF interest up to 9.5% exempt. Beyond that, excess will be taxable under salaries head. Then PPF interest always fully exempt under IFOS head. URPF interest on employer's contribution, taxable under salaries head. Interest on employees' contribution, taxable under IFOS head. That's all, guys, simple. Now moving on to our next discussion, we're going to take up the retirement benefits one by one. Leave salary, gratuity, pension, we'll discuss them all. Now in each of the retirement benefits, I will show you one flowchart, and it is this flowchart which will really help you in recalling the provision later. So listen to me carefully. When it comes to leave salary, first of all, what is leave salary? See, the employer will give you a certain number of days of leave which you can take every year, paid leave, guys. Let's say employer is saying you can take 20 days of paid leave every year. Basically, if you take these many days off, he will not deduct salary. Okay, but however, you took leave of only 12 days, guys, which means, don't you think you worked for extra 8 days? These 8 days you worked extra. So because you worked extra for these 8 days, you deserve some extra compensation, and that is leave salary. Simple, guys. So you will first see how many days of leave you're allowed to take in a year. Then you will see how many days of leave did you actually take. So whatever is the difference becomes the extra number of days that you have worked for the employer, and because you have worked extra, you deserve extra compensation, which is called as leave salary. Okay, guys. Now listen, so leave salary, if you're receiving during service, it doesn't matter which kind of employee, government employee, non-government employee, I don't care. Any employee receiving leave salary during service, that leave salary will be fully taxable always for all employees, if it is received during service. But if the same leave salary is received upon retirement, and if you're a government employee, whether central government employee, whether state government employee, doesn't matter, it will be fully exempt. Okay, guys. Now the whole drama is over here. What if leave salary is received upon retirement by a non-government employee? Then in that case, you will calculate 4 things. Out of the 4 things, whichever is the least will be exempt, and received minus exempt balance will be taxable. Now what are the 4 things? Earned leave into average salary. Earned leave is nothing but, in our example, the extra number of days that you worked, guys, that is your earned leave. That 8 days in our example is our earned leave. So earned leave into average salary, then 10 into average salary, then maximum exemption which you can enjoy in your entire lifetime is 25 lakhs, and actual leave salary received. Out of these 4 numbers, whichever is the least number will become your exemption. Received minus exempt balance will be taxable. Okay, we'll come back to this. Let's talk about these words first of all. Earned leave, average salary, maximum exemption in lifetime. Let's try to understand each of these one by one first. Let's talk about earned leave. Earned leave, I already told you, it's nothing but this extra days that you have worked for the employer. This earned leave, this extra days that you have worked for the employer, it is also called as accumulated leave. It's also called as leave balance. It is also called as leave to the credit of the employee. So be aware, any of these terminologies they can use in the examination, guys. Earned leave, accumulated leave, leave balance, or leave to the credit of the employee. All of this means the same thing. It's nothing but the extra number of days that the employee has worked for the employer. Okay, guys, it is for these number of days only that the employee deserves extra compensation in the form of leave salary. Now, how to find this earned leave? You will first see how many years has the employee worked for the employer, and in that number of years, if there's any fraction, you will simply ignore the fraction, guys. Like for example, let's say employee has worked for the employer for 15 years and 8 months. Okay, 15 years and 8 months. Now whatever is a fraction, whether it is less than 6 months, whether it is more than 6 months, I don't care. Always ignore the fraction. Okay, take only completed years. Then you will see what is the rate of earned leave entitlement. Rate of earned leave entitlement, super fancy term, nothing to get scared. Rate of earned leave entitlement is nothing but how many days of leave the employer is allowing you to take every year. Like in my example, I told you employer is letting me take 20 days of paid leave every year, guys. That is your rate of earned leave entitlement. In my example, it is 20 days in each year. Now this number, be careful, it should not be more than 30. If it is more than 30, then in that case you will restrict it to 30. It can't be more than 30. Okay, what? The rate of earned leave entitlement. Then comes your third point, leave actually taken plus leave encashed during service. 2 things, okay. Leave taken is nothing but how many days leave the employee actually took during service, guys. Let's say total put together the employee has taken around 150 days leave. Okay, let's say he's taken 150 days leave. Actually he's taken. And leave encashed during service is nothing but for how many days you got leave salary already during service. See, I just told you, right, it is possible to get leave salary during service also. So for how many days you already got leave salary during service, that is nothing but leave encashed during service. Understanding? This is a place where generally students get confused. You got it right. Leave encashed during service is nothing but for how many days you already got leave salary during service. Because you already got leave salary during service, for those many days you will again not get leave salary, right? So leave encashed during service is nothing but for how many days you already got leave salary during service itself. Let's say I already got leave salary during service for 50 days. I already got. Okay, so now what will my earned leave be? A into B minus C. 15 into 20, this is A, this is B, so A into B, 15 into 20 minus C. C is nothing but here 150 plus 50, which is 200. Okay, so if you calculate, how much will you get? 15 into 20 minus 200, you will get 100 days. This 100 days will be your earned leave. Now earned leave always has to be converted into months, guys. So 100 divided by 30, 100 divided by 30 will be 3.33 months. Always remember to convert your earned leave into months. Simple. So earned leave is nothing but the extra number of days that you have worked. It's nothing but a number of completed years of service. In case there's any fraction, you will ignore the fraction. Then rate of earned leave entitlement is nothing but how many number of days of leave you're allowed to take every year. It should not be more than 30. If it is more than 30, you will restrict it to 30. And C is two things: leave taken plus leave encashed during service. Leave encashed during service is nothing but how many days you have already taken leave salary during service. Okay, so A into B minus C, that's how you will get your earned leave. This earned leave has to be converted into months. Alright guys, so with this you know what is earned leave. Let's talk about average salary now. See, average salary is nothing but 10 months salary. Okay, 10 months before what? 10 months before the date of retirement. Now salary will have three components: basic plus DA forming part plus employee's turnover based commission. Like for example, let's say my employee retired on the 31st of Jan 2026. He retired. This is his date of retirement, let us say. So before the date of retirement, 10 months. 10 months would be, in my example, 1st April 2025 to 31st Jan 2026, guys. This will become your 10 months before the date of retirement. So for these 10 months, you will find the salary, which will be basic salary plus DA forming part plus employees turnover based commission. Now be careful, sometimes in questions and all, in this period there might be a change in salary. So if there's a change in salary, like for example basic salary may change or DA may change. So in this period, if there's a change in salary, remember to make columns. Like let's say salary changed in August. So till August you will do one calculation. After August you will do one calculation. So you will draw columns and accordingly you will split this period if there's a change in salary and all. Okay guys, now comes the next point. Sometimes what happens is the earned leave is given to us in the question itself. Like basically this number might be given to us in the question itself, which means this A into B minus C, all this drama I don't even have to do. They've already given this to me in the question. But if they've given this to me in the question, can I take it as it is? That question arises. See, it depends. It depends upon what is the rate of earned leave entitlement. If the rate of earned leave entitlement that is given to us in the question is within 30 days, then whatever earned leave they have given to us in the question, we can take it as it is. It's a big favor on us. It's a big shortcut for us. We don't even have to do the earned leave calculation. We can straight away take whatever is given to us if the rate of earned leave entitlement is within 30 days. But if the rate of earned leave entitlement is more than 30 days, guys, then we cannot take the earned leave number which is given to us in the question. We will have to redo these steps A into B minus C. We'll have to recalculate the earned leave because rate of earned leave entitlement cannot be more than 30 days. So we'll have to restrict it to 30 days and we'll have to recalculate the earned leave. Got it guys? Very, very important point from the examination point of view. Just that's why I'm telling you, just knowing the provision is not enough. You also should know what are the different kinds of questions which come in the examination. So keep that also in your mind when you're revising the provisions. So I've put all this in the checkmate book itself. And when you're calculating leave salary, in case earned leave is given to you in the question itself, if the rate of ELE, if the rate of earned leave entitlement is within 30 days in the question, then you can take the earned leave number as it is. No need of doing this extra hard work. But if the rate of earned leave entitlement is more than 30 days, then the earned leave number which is given to us in the question is useless. We have to recalculate earned leave correctly with A into B minus C. Okay guys, so now coming back to my discussion, how do you calculate the exempt amount? 4 things you calculate: earned leave into average salary, 10 into average salary, then maximum exemption which you can enjoy in your lifetime is 25 lakhs, and actual leave salary. Now let's talk a little bit about this. What is this maximum exemption which you can enjoy in your lifetime? What does this mean? Why have I mentioned the word lifetime over here? Very, very important. Again, see, let's say in the past I I worked with some other employer, okay, there I got leave salary upon retirement, and there let's say 1 lakh rupees was exempt for me. Alright, so I have in my entire lifetime for leave salary 25 lakhs exemption I can enjoy. I have already enjoyed 1 lakh exemption for leave salary in my previous employer. So now I joined another employer and now I'm retiring from my present employer. Again, he is also giving me leave salary. So when you're calculating the exempt amount, now when I'm getting leave salary again, the maximum exemption will not be 25 lakhs guys. It will be only 24 lakhs. You're understanding? Because out of 25 lakhs, I have already enjoyed 1 lakh exemption in the past. So maximum exemption in my entire lifetime is nothing, but in my entire life I can enjoy 25 lakhs exemption. So if I have already enjoyed 1 lakh exemption, now I am allowed to enjoy only the balance 24 lakhs exemption. So as you keep changing employers, as you keep getting leave salary again and again, the maximum exemption will keep getting lesser and lesser for you. In your lifetime, all the employers put together, maximum you can enjoy 25 lakhs exemption. Getting it guys? So this is our entire discussion about leave salary. Now coming to our next discussion about gratuity. See, if you receive gratuity during service, okay, then doesn't matter what kind of an employee you are, it will always be fully taxable for you. Then if you receive gratuity upon retirement, if you're a government employee, central government employee or a state government employee, if you're receiving gratuity upon retirement and if you're a government employee, then it will be fully exempt for you. Then where is the whole drama? The whole drama arises only when you receive gratuity upon retirement and you're a non-government employee. Okay, this is what our entire focus will be now. So if you're receiving gratuity upon retirement and you're a non-government employee, the first thing I will check is, are you covered by Payment of Gratuity Act or are you not covered by Payment of Gratuity Act? Accordingly, my answer will change. Whether you're covered by Payment of Gratuity Act, whether you're not covered by Payment of Gratuity Act, in both, I will do 3 calculations, okay, in both. Like if you're covered by POGA, here also I will do 3 calculations. If you're not covered by POGA, here also I will do 3 calculations. Now out of these 3 calculations, whichever is the least, that least number will become exempt, and received minus exempt balance will be taxable. So the only thing that we have to learn now is what are these 3 numbers if employee is covered by POGA, and what are these 3 numbers if employee is not covered by POGA. Easy guys. Now listen to me. Let's focus just on covered by POGA. Let's focus on just this part. So if your employee is a non-government employee and if your employee is receiving gratuity upon retirement and if he is covered by POGA, first you will calculate 3 things. The first thing, 15 by 26 into last drawn salary into number of completed years. 15 by 26 fine. This last drawn salary, listen to me carefully. In leave salary, there we had calculated 4 things guys. Out of the 4 things, whichever is least was exempt. Now in these 4 things, we had calculated average salary. So in leave salary, we did not take last drawn salary. We took average salary. We took last 10 months average and all. Here in gratuity covered by POGA, I'm not talking about average salary. I'm talking about last drawn salary, which means just before retirement, whatever is the last salary, we will take only that. Okay. Then in leave salary, we had 3 components in salary calculation: basic, DA forming part, and employees turnover based commission. Here we will have only 2 components guys: basic salary and DA, full stop. I'm not saying DA forming part, I'm just saying DA, which means I'm talking about all DA. Whether the DA is forming part, not forming part, doesn't matter. Okay, so 15 by 26 into last drawn salary. Last drawn salary is not average salary, it is only last drawn salary. Only 2 components, basic plus DA. Okay, then into number of completed years. Now number of completed years, the same point we saw somewhere in leave salary also. There I told you any fraction you will ignore. But here guys, if employee is covered by POGA, we consider the fraction. See, if the fraction happens to be up to 6 months, okay, less than or equal to 6 months, then we ignore the fraction. But if it happens to be more than 6 months, then we consider the fraction guys, we round off the fraction. I'll give you an example. Like for example, let's say the number of years of service is 15 years and 4 months. So here if you see the fraction is less than 6 months, I'll ignore the fraction. I'll take only 15 years. But let's say it is 15 years and 6 months. It is exactly 6 months. Even if it is exactly 6 months, I will ignore the fraction guys. I'll take only 15 years. But if the fraction is more than 6 months, like for example, if it is 15 years, 6 months and 1 day, or if it is 15 years and 7 months, then if the fraction is more than 6 months, I will round off to the next number. That is, here I will make it as 16 years. Okay, so if your employee is covered by POGA, then in number of completed years, I will consider the fraction. So what's the first line item? 15 by 26 into last drawn salary into number of completed years. Then the maximum exemption which you can enjoy in your entire lifetime is 20 lakhs. In leave salary, it was 25 lakhs. Here it is 20 lakhs and actual gratuity. So out of these 3, whichever is the least will be exempt. Received minus exempt, balance will be taxable. Easy guys. Now what if my employee is not covered by POGA? If he is not covered by POGA, again 3 things you will calculate. Number 1, 1/2 into average salary into number of completed years. Be careful if it's covered by POG, 15/26. If it's not covered by POG, 1/2. So 1/2 into average salary. Here it was last on salary, but if employee is not covered by POG, average salary. Let's talk about average salary, guys. We had average salary in leave salary also, but there it was 10 months before the date of retirement. Here also average salary means same 10 months average, but here it will be 10 months before the month of retirement. Small point, but big difference it will take. Listen to me, I'll help you understand. I had given you one example even earlier. What if the date of retirement is 31st Jan 2026? Okay. Now in that case, when for the purpose of leave salary, when you're calculating average salary, 10 months average, leave salary, it is 10 months before, the date of retirement. Okay, so the date of retirement is 31st Jan 2026. 10 months before the date of retirement will be 1st April 2025 to 31st Jan 2026, guys. This will be your 10 months period for the purpose of leave salary. But if you're doing the calculation for gratuity, and if employee is not covered by POGA, here also you need average salary. Here also it will be 10 months average, but here this 10 months average will be before the month of retirement. Here, what's the month of retirement? See, the employee is retiring on 31st Jan. So the month of retirement is Jan. Ignore Jan. 10 months before that. 10 months before that will be 1st March 25 to 31st December 2026. Are you noticing there's a difference? Small point, guys, but big impact. So in leave salary also you calculate average salary. In gratuity not covered by POJ, here also you calculate average salary. In leave salary it is 10 months average before the date of retirement. In gratuity it is 10 months average before the month of retirement. So leave the month of retirement and take 10 months before that. And same 3 components, guys. Salary will have basic salary plus DA forming part plus employees turnover based commission. The same 3 components you will have even over here. Then we have number of completed years. Will you consider the fraction? No. Any fraction you will ignore. Same like leave salary, you will ignore the fraction. Where do you consider the fraction? Only in covered by POJ you consider the fraction. Here in all you will ignore the fraction. Then so your first point is clear. 1/2 into average salary into completed years. Then maximum exemption in your lifetime is 20 lakhs. Same thing. And actual gratuity, out of these 3 numbers, whichever is the least will be exempt. Received minus exempt, balance will be taxable. Easy, guys. So this was your entire gratuity discussion. Now see, I brought one small comparison. Okay, if employee is covered by POGA, not covered by POGA. See, if employee is covered by POGA, salary is last drawn salary, not average salary. It is last drawn salary, and only 2 components, basic plus DA. If employee is not covered by POGA, salary is average salary. It is 10 months average, 10 months before the month of retirement, and 3 components in salary, basic, DA forming part, and employee's turnover based commission. Then if employee is covered by POGA, in number of completed years, if the fraction is more than 6 months, we consider the fraction, we round up the fraction. But if employee is not covered by POGA, whatever is the fraction we ignore. So guys, if you notice, in covered by POGA and in not covered by POGA, okay, the second point and the third point are exactly the same. Right, guys? Where is the change? The change is in the first point only. In covered by POGA, we have 15/26 here. But in not covered by POGA, we have 1/2. First difference. Then if the employee is covered by POGA, you do last on salary. But if not covered by POGA, you take average salary. Second difference. Then if your employee is covered by POGA, in the number of completed years, you consider the fraction if it is more than 6 months. But if employee is not covered by POGA, you never consider the fraction. So if employee is covered by POGA or not covered by POGA, because of that, the second and third point remain the same. Only in the first point, there are 3 differences which you have to be careful about, and that is what I tried mentioning over here. Okay, guys, now see, then after this is something which I just told you about. In leave salary, you take 10 months before the date of retirement. In gratuity not covered by POJ, you take 10 months before the month of retirement. This you're already aware of. Okay, now let's focus on our third retirement benefit, which is pension. See, the first tension in pension is which head of income will this pension be taxed under, because sometimes it is taxed under salaries and sometimes it is taxed under IFOs, guys. That's the first confusion. Very, very simple. Listen to me, guys, no rocket science over here. If the employee retires, okay, and after his retirement, if he himself is receiving pension, come to the salaries head. But if the employee dies and after that if his family gets pension, then IFOS head. So no confusion. If employee retires and after his retirement, if he himself is getting the pension, then it will come under the salaries head. But if the employee dies and after that if his family is getting pension, that will go under the IFOS head. Okay guys, now let's say employee has retired. After his retirement, he himself is getting pension, therefore salaries head. We will first see whether the pension is uncommuted or whether it is commuted. Uncommuted means it is periodical, like every month or every 6 months or every year. It's periodical. If it is periodical pension, if it is uncommuted pension, then doesn't matter government employee, non-government employee, doesn't matter. It will be taxable for all employees. Okay. But if it is commuted pension, which means it is lump sum pension. Okay. See, generally pension is uncommuted. Only in extraordinary circumstances, only in emergency situations, like let's say there's a death in the family, or let's say there's a marriage function coming up, or let's say there is some medical emergency. Only in extreme cases, only in emergency cases, a commuted pension you receive. So if it is commuted pension, if it is lump sum pension, then you will see who is the employee, government employee or non-government employee. For government employee, commuted pension will be fully exempt, guys. For non-government employee, the commuted pension will be partly exempt, partly taxable. How much exempt will depend upon is the employee also getting gratuity or not. If he is getting gratuity, then 1/3 of full pension will be exempt. If he is not getting gratuity, then half of full pension will be exempt. Okay, guys, very simple. So if you're getting uncommuted pension, periodical pension, for all employees it will be fully taxable. If you're getting commuted pension, that is lump sum pension, then for government employees it will be fully exempt. For non-government employees, it depends. Are you also receiving gratuity or are you not receiving gratuity? If you are receiving gratuity, then 1/3 of full pension will be exempt. Received minus exempt, balance will be taxable. If you're not getting gratuity, then half of full pension will be exempt. Received minus exempt, balance will be taxable. Be careful. 1/3, half of what? Not of the pension received. 1/3, half of the full pension, guys. You know how this is done, right? Like for example, let's say I got 1 lakh rupees pension. Okay, commuted pension, I got 1 lakh rupees. This is 60% of the total pension. So 1 lakh rupees is basically I commuted 60% of the pension and I got 1 lakh rupees. So 1 lakh is 60%. But I want the full pension. Full pension means 100%, guys. So simple cross multiplication, that is 1 lakh into 100 by 60. So whatever number I get over here, this will become the 100% pension number, that is a full pension number. So this will work out to 1,66,667. What is this? This is a 100% pension number, that is a full pension number. Okay, let's say my employee is receiving gratuity. So 1/3 of, not pension, 1/3 of full pension. So 1/3 of 1,66,667. How much will that be? That will be 55,556. What is this 55,556? What is this 1/3 number? Exempt or taxable? Exempt, guys. Remember my basic tip in allowances, in retirement benefits, you first find the exempt number. This is your exempt number. Then you will say received minus exempt, balance is taxable. So what will your taxable number be? How much did you receive? You received 1 lakh. So 1 lakh minus 55,556. What is the balance number? The balance is going to be 44,444. This is going to be your taxable your taxable pension. Okay, now there are two silly mistakes possible over here. Silly mistake number 1, 1/3 and 1/2. Everybody will remember. But 1/3 of full pension, half of full pension, even that you will remember. Silly mistake number 1 is that 1/3 number, that half number, is it exempt or is it taxable? That's the first silly mistake possible. That you will remember, that's the exempt number. Then second silly mistake that is possible, after finding the exempt number, you will find the taxable number. Many a times what students do is, this full pension which they calculated, no, they'll do this number, that is 166,667 minus 55,556, balance is taxable, they will say. It is wrong. Again and again I'm telling you, received minus exempt is taxable. I received only 1 lakh. So 1 lakh minus 55,556, balance 44,444, this is what's going to be taxable. Okay, similarly, if I don't receive gratuity, then half of full pension is exempt, then received minus exempt, balance is taxable. Got it, guys? Very simple. This is about my discussion with respect to pension. But wait, before I go to the next point, there's one more thing about uncommuted pension that I have to tell you. Let's say my employee started getting uncommuted pension November onwards. So November, December, Jan, Feb, and March. 5 months my assessee is getting pension, uncommuted pension. Okay, how much is the uncommuted pension? Let's say 10,000 rupees per month my employee is getting uncommuted pension. Then remember I just told you my employee commuted 60% of the pension and got 1 lakh rupees, guys. Let's say this commutation of pension happened on 1st February 2026, let us say. Okay guys, now see, till January there is no drama. So November month full 10,000 rupees uncommuted pension he will get. December full 10,000 rupees he will get. January also full 10,000 rupees he will get. The change happened only on 1st February. Now 1st February he commuted how much? 60% he commuted, he got 1 lakh rupees, and he's also getting gratuity, for example, let us say. So you calculated full pension and all. 1/3 of the full pension, 55,556 was exempt. So he received 1 lakh commuted pension. 55,556 is exempt. Balance 44,444 was taxable. This is with respect to the commuted pension. Okay. Now listen, when you commute your pension, your uncommuted pension number will also change. Earlier, you had not commuted anything, guys. Listen very carefully, okay? Very logically, I'll explain to you. Earlier, you had not commuted anything. So, entire pension was uncommuted pension. Entire 100% was uncommuted pension. Earlier means before 1st February. In these 3 months, November, December, January, you had not commuted anything. So, entire pension was uncommuted pension. And how much were you getting? You were getting 10,000 rupees uncommuted pension. But on 1st February, 60% you commuted, guys. So, if you're commuting 60%, balance how much will be left in the uncommuted bucket? Only 40% will be left in the uncommuted bucket. So hereafter, February onwards, your uncommuted pension will change. Earlier, before February, full 100% was uncommuted only. You were getting 10,000. But 1st February, my employee commuted 60% and took away. So only 40% is left in the uncommuted bucket now. So how much will you get now? 10,000. Simple cross multiplication, guys. 10,000 into 40 by 100. February onwards, 4,000 only you will be getting. Are you getting the logic, guys? Yes, so whenever you commute your pension, after that, whatever uncommuted pension you get, that uncommuted pension number will change. Okay, first you started getting uncommuted pension, 10,000 every month you were getting. That time you had not commuted anything. So the whole 10,000 was uncommuted pension, whole 100% was uncommuted pension. Then on 1st February, you commuted 60% and you took 1 lakh rupees. So now in the uncommuted bucket, only the balance 40% will be left. So February and March, you will not continue to get 10,000. February and March, your uncommuted pension number will reduce, because in the uncommuted pension bucket, you have only 40% left now. What happened to the balance 60%? Balance 60, so you commuted and you took off. So therefore only 40% is left in the uncommuted pension bucket. So 10,000 into 40 by 100, 4,000. This will become your new uncommuted pension February onwards. Okay, be careful about this. So your learning is that whenever you commute pension, after that, whatever uncommuted pension you get, that uncommuted pension number will change. Okay, then comes your next situation, retrenchment compensation. Retrenchment compensation and voluntary retirement compensation. Listen to me. When it comes to retrenchment compensation and compensation under voluntary retirement scheme, even these are retirement benefits. Okay, so talking about retrenchment compensation first, you will do 3 calculations. Out of the 3 calculations, whichever is the least will be exempt. So maximum exemption you will get is 5 lakh rupees. Actual compensation received, then 15 by 26 into salary into number of completed years of service. So here salary will be 3 months average, okay, and the salary will have 5 components: basic, all DA, whether forming part, not forming part, doesn't matter. Then all your perquisites, LTC, and employees turnover based commission. Okay, so salary will be last 3 months average, and that salary will have 5 components: basic, DA, all DA, whether forming part, not forming part, doesn't matter, all DA, perquisites, LTC, and employees turnover based commission. Okay, then number of completed years of service. If you have any fraction, if the fraction is up to 6 months, you will ignore. More than 6 months, you will round up to the next number. Basically, the number of completed years of service you will treat just like gratuity covered by POGA. Even there you consider the fraction, or even here you will consider the fraction. Okay, so 3 numbers you will calculate: maximum exemption 5 lakh rupees, then actual retrenchment compensation that you received, then 15 by 26 into salary into number of completed years. Out of these, whichever is the least will be exempt, and same thing, received minus exempt, balance will be taxable. Salary will be how many months average? 3 months average. Salary will have how many components? 5 components. What are the 5 components? Basic salary plus all DA plus perquisites plus LTC plus employees turnover based commission. Number of completed years of service, will you consider the fraction? Yes. Same like what? Same like gratuity covered by POGA. Thorough, guys, easy. Then comes a VRS discussion, voluntary retirement compensation. Now listen to me very carefully. When the employer gives VRS compensation to the employee, from the employer's point of view, it's an expense. It's an expense relating to his business or profession. You will go into the PGBP head. Under the PGBP head, this expense will be allowed, but you will be learning in the PGBP head that it will be allowed on payment basis, which means the employer actually has to make the payment, then only it will be allowed, and it will be allowed across 5 years. Okay, this is from the employer's point of view. From the employee's point of view, it's an income, guys. It's a benefit, and benefit from employer, and therefore for the employee, definitely it will come under the salaries head. Under the salaries head, you will do 4 calculations. Out of the 4 calculations, whichever is the least will be exempt, and then received minus exempt balance is taxable. Now what are the 4 numbers? Maximum exemption 5 lakhs, same like retrenchment compensation. Then actual compensation received. Then last on salary into 3 into completed years. Last on salary into balance months. Out of these 4, whichever is the least will be exempt, then received minus exempt balance will be taxable. Now I want you to listen very, very carefully. What is this balance months? What is this completed years? See, in voluntary retirement scheme, what happens is, even though the employee has not reached the retirement age, before the retirement age itself, he is voluntarily taking up retirement. That is voluntary retirement scheme, guys. Let us say in a particular organization, 55 years is a retirement age. Okay, and right now let's say my employee is 53 years, which means if he wants to continue to work, he can work for 2 more years, guys. He can work for 2 more years. But now when he's 53 years old, now itself he's taking voluntary retirement. So this balance months will be nothing but, if he wants to, if he decided to continue to work, he could have worked for 2 more years. 2 more years means 24 more months he could have worked for. So that will be balance months. Understanding, balance months is nothing but if your employee had not taken voluntary retirement, for how many more months employee could have worked for, that is balance months. Very simple, guys. So maximum exemption 5 lakhs, actual compensation, actual VRS compensation, then last on salary into 3 into completed years, then last on salary into balance number of months, whichever is the least will be exempt, received minus exempt, balance will be taxable. Simple. Now some faculties say that out of these 2 numbers you will pick whichever is higher, then out of these 3 numbers you will pick whichever is lesser. I'm not doing all that okay over here. I'm strictly following what is written in your ICAI study material. As per the ICAI study material, I will do 4 calculations, whichever is the least is exempt. I am sticking to the study material over here. Okay, guys. Now what do you mean by salary? Salary will be same 3 components: basic, DA forming part, employees turnover based commission, and any in the completed years, any fraction if it is there, you will ignore the fraction. Okay, guys. Remember here the most interesting part is balance months. So balance months is nothing but how many more months you could have worked for had you not taken voluntary retirement. No. Okay, guys, so this is it with your retirement benefits. So we had 5 retirement benefits: leave salary, gratuity, pension, retrenchment compensation, and VRS. Okay, now small little points only are left in our salaries head. Let's do this nicely. Until here, I can say with a lot of contentment that I've put in my best. I've covered each and every point in detail without even skipping one small point. I hope even you can say with contentment that yes ma'am, till here I have grasped everything properly. No compromise at all. Okay, so with this energy, let's go into our last few points, guys, and let's close this head of income amazingly well. So club facility, health club facility or sports club facility. If the employer is providing any health club facility or a sports club facility to the employee, it's a perquisite for the employee. Now this perquisite is generally taxable, but however, if it is health club facility or sports club facility, condition number 1, and if this facility is being given to all employees, condition number 2, and this facility is at the employer's premises, condition number 3. If all these 3 conditions are fulfilled, then it will be an exempt perquisite. So employer is giving club facility to employee. First of all, it's a benefit for the employee. It's a perquisite for the employee. It's a taxable perquisite. But if 3 conditions are fulfilled, that perquisite will be exempt. Condition number 1, it has to be a health club or a sports club facility. Condition number 2, that facility is for whom? It's for all employees, not for only top level employees or bottom employees. No, it's for all employees. And where is the facility? Employee doesn't have to go to the gym for this facility. The facility is in the office itself. It is in the employer's premises itself. If all these conditions are fulfilled, then that perquisite will be exempt. Okay. Then sometimes question uses the word ex gratia. Don't get confused. Ex gratia is nothing but bonus. Okay. Then cost of living allowance. Sometimes the question uses the word cost of living allowance. It is nothing but your dearness allowance, guys. Okay. They're just different words. Then free or concessional tickets. Free or concessional tickets given by a transport undertaking to its employees. Like for example, let's say The employer is Indigo Airlines, okay, and it's this Indigo Airlines, the employer is giving free air tickets to its employees. So for the employees, definitely it's a benefit, guys. They're getting free air tickets from the employer. So like this, if a transport undertaking gives free tickets to its employees, if it is airlines or railways, it's definitely a benefit, but it will be exempt. In all other cases, it will be taxable. So if it is airlines and railways, free tickets given by airline company to employees will be exempt. Free tickets given by railway to railway employees will be exempt. All other transport undertakings, free tickets given will be taxable. Okay. Then comes this next point, salary in NRE account. Listen very, very carefully, okay. About this, there was one adjustment in the ICAI MCQ booklet. Okay. So from there, I've taken this adjustment. If you look at your study material, you will find it in residential status chapter. Okay. So I just put it over here in the salaries head because it is connected to the salaries concept. So there are 5 conditions over here. If all the 5 conditions are fulfilled, the salary income will be exempt. What are the 5 conditions? Condition number 1, the assessee has to be a non-resident. Okay. Condition number 2, this assessee has to be crew member of a ship. Condition number 3, what kind of a ship? The ship has to be a foreign going ship, which means it should be going to a foreign country. It should be a foreign bound ship. So who is the assessee? Who is your employee? Your employee is a non-resident. He is working in a ship. He is a crew member of a ship. What kind of a ship? A foreign going ship. Now because he is an employee, he will be getting salary. His salary income will be credited in some bank account. In which bank account is his salary income credited? In some Indian bank, he has an NRE account, non-resident external account. In that non-resident external account, the salary account is being credited. That's a 4th condition, that salary account is credited in an NRE account. And condition number 5, where is he rendering services? He's rendering services outside India. So if all these 5 conditions are fulfilled, then the salary income will not be taxable for him. Okay, he should be a non-resident employee, then he's working in a ship, he's a crew member of a ship, a foreign going ship, then he's receiving his salary income in an NRE account in an Indian bank, and he's rendering service outside India. If all these conditions are fulfilled, his salary income will not be taxable. Okay guys, then comes my section 16 deductions. See, all your basic salary, your allowances, perquisites, everything put together will become gross salary. Okay, from gross salary you will subtract section 16 deductions, and that's how you will get your taxable salary. Now what are the section 16 deductions? You have totally 3 section 16 deductions. Number 1, standard deduction of 50,000 rupees. Number 2, professional tax. See, let me discuss everything about professional tax with you first. Now, professional tax is actually employee's obligation, okay? Employee's obligation. So, who is supposed to pay? Employee is supposed to pay. Now, let's say total professional tax to be paid by the employee is 2,000 rupees, let us say. Out of this 2,000 rupees, the employer paid 1,500 rupees and the employee has paid, let's say, 300 rupees. The balance 200 rupees is outstanding, let us say. Alright, total professional tax for the year is 2,000. Employer has paid 1,500. Employee has paid 300. Balance 200 is still outstanding. Okay, one example, everything will get clarified for you. First of all, whose obligation is it? Who is supposed to pay? Employee is supposed to pay. But employer has paid 1,500. Don't you think it is a benefit for the employee? Because his obligation, his tax, employer is paying. It's definitely a benefit for the employee. So therefore, this 1,500 which the employer is paying will first be taxable. Doesn't matter which regime, doesn't matter what kind of employee, any professional tax paid by employer will first be fully taxable. Okay guys, then you will come to section 16. Under section 16, the total professional tax paid, whether paid by employer, whether paid by employee, I don't care. The total professional tax paid, which over here is 1,800 rupees, this is what you will allow as section 16 deduction. Which means, are you listening to me? The total professional tax paid, I'm saying paid, which means payment basis. Total 2,000 I will not allow in under section 16. Only how much ever is totally paid. Here in our example, 1,800 only is paid, right? The balance 200 is still outstanding. So only the amount which is paid I will allow under section 16. Okay, so with respect to professional tax, there are 2 adjustments. Number 1, whatever professional tax is paid by employer, it will be taxed for the employee. Then second adjustment, the total professional tax paid, whether paid by employer, whether paid by employee, the total amount paid. So on payment basis, that will be allowed under section 16. Okay, then comes a third point, your entertainment allowance. This I hope you recall, we had covered this in our allowance discussion itself. Entertainment allowance will first be fully taxable for all employees. Then for central government and state government employees alone, you will get section 16 deduction. 3 things you will calculate. Out of the 3 things, whichever is least will be your deduction. We had already spoken about this, 5,000 rupees, then 20% of basic salary and actual entertainment allowance received. So whichever is least will be your section 16 deduction, but only for government employees. Okay guys, so how many section 16 deductions you have? 3. Standard deduction 50,000. Then total professional tax paid, whether paid by employer, whether paid by employee. And number 3, entertainment allowance only for central government and state government employees. Okay, so 3 section 16 deductions you have under the normal regime, but under the default regime only 1 deduction you have under section 16, which is your standard deduction, that too not 50,000, instead 75,000. Okay guys, now listen to me. In so many places in our salaries head, we have learned about the meaning of the word salary. Like in HRA, we had a different meaning of salary. In RFA, we had a different meaning of salary. In leave salary, we had a different meaning. Retrenchment compensation, we had a different meaning. So what I've done over here is, in one place, all the different definitions of salary I've brought together for you in one place. It will be really, really helpful for you. Basic salary plus DA forming part plus employees turnover based commission. This is the most common meaning of salary guys. 3 components: basic, DA forming part, employees turnover based commission. This you have in 5 places: HRA, then employer's contribution to RPF, then leave salary, then gratuity not covered by POGA, and VRS. In these 5 places, salary has these 3 components. Okay, then RFA, remember we had 7 components: basic, DA forming part, all commission, bonus, fees, taxable allowances, and any other taxable monetary payments. 7 components we have in RFA. Then gratuity covered by POGA, 2 components you have: basic plus all DA, whether forming part, not forming part, doesn't matter. Then retrenchment compensation, you have 5 components. Just now we learned basic, DA, your perquisites, LTC, and employees turnover based commission. Then specified employee, remember we had spoken about 3 conditions. If any employee fulfills even one out of the 3 conditions, then that employee becomes specified employee. So in that, the first point was that the employee is a director of the employer company at any point of time in the year. Then second condition was employees having substantial interest at any point of time in the year. The third point was taxable salary minus non-monetary perquisites. The balance has to be more than rupees 4 lakhs. So there we had said taxable salary minus non-monetary perquisites, just giving you a reminder. Okay guys, so this is a different meaning of salary in different places in your salary set. Alright, I hope this chart is helpful for you. Now comes my last concept in a salary set. My last concept, but a very important concept. In my entire chapter, I did not focus too much on the default regime, normal regime. Remember guys, my entire chapter I taught you from the point of view of the normal regime. Now what if my SSE is following 115 BSE? What if my SSE is following default regime? Then I will take away some benefits from you. That is what I'm going to be talking to you about now. In the entire chapter, in every place, I did not talk to you about 115 BSE, what will happen. If 115 BSE, what will happen? I did not even talk to you about it. My whole chapter was from the point of view of the normal regime, guys. Now listen, what if my employee follows default regime? If my employee follows default regime, then there will be totally 4 changes only, guys. Everything else will remain the same, only 4 changes in the default regime. Change number 1, LTC, you will not get exemption under the default regime. Generally, we learned, right, LTC, if the vacation is in India, if employee is going along with his family twice in a block of 4 calendar years, the entire travel expense met by the employer will be exempt for the employee, we learned. But if assessee is following the default regime, the entire travel expense which the employer is meeting, the entire LTC will be fully taxable. There will be no exemption. The first thing. Second point, in allowances, you get so much exemption, guys. HRA, you get exemption. Children education allowance, you get 100 per month per child exemption. You get so many exemptions under each allowance. So those allowances exemptions you will not get. But, so see, listen. First point, LTC exemption, you will not get. Second, allowances exemption, you will not get. But there are 5 allowances where you will still get exemption. Even under the default regime, you will still get exemption under 5 allowances. What are the 5 allowances? Number 1, transport allowance, 3,200 per month exemption for blind, deaf, dumb, handicapped employees. That exemption you will get under the default regime also. Then traveling allowance, conveyance allowance, daily allowance. Guys, these 3 come under those 7 allowances. So in the 7 allowances, whatever you have incurred for official purposes exempt, that exemption you will get under the default regime also. Then coming to the 5th point, this is connected to your residential status chapter, guys. I'll remind you about the provision, okay. We had learned that salary salary generally accrues in the place where you render services. But however, there's an exception. If assessee is an Indian citizen, employer is Government of India, even though assessee is rendering services outside India, still salary, allowances, perquisites, everything will accrue in India. After accruing in India, salary alone will be taxable, allowances and perquisites will be exempt. Remember guys, that allowances and perquisites, you can continue to enjoy the exemption. So LTC exemption you will not get under the default regime. Allowances exemption you will not get under the default regime, but 5 allowances you will still get exemption. Transport allowance, traveling allowance, conveyance allowance, daily allowance, and this foreign allowances and perquisites. Okay, then comes my third point. In lunch perquisite, if you remember my PwC example, I had told you 50 rupees per meal exemption you will get guys. That exemption you will not get under the default regime. So lunch perquisite 50 rupees per meal exemption you will not get under the default regime. Then comes your fourth change. Under section 16, 3 deductions you have: standard deduction, then professional tax paid, and entertainment allowance. 3 deductions you have, right? But under the default regime, no professional tax deduction, no entertainment allowance deduction. You will have only one deduction under the default regime, and that is standard deduction, and that too not 50,000. You will get extra benefit over here, 75,000. Okay guys, so 4 changes, that's all. Your entire chapter remains the same, whether normal regime, whether default regime, entire chapter remains the same. Only in these 4 places alone you have 4 changes. Number 1, in your LTC exemption you will not get under the default regime. Number 2, allowances exemption you will not get under the default regime. Number 3, your lunch perquisite 50 rupees per meal exemption you will not get under the default regime. And under section 16, only one deduction you will get, that is standard deduction, that too not 50,000, instead 75,000. Got it guys? Thorough? Yes. So this is it with our entire discussion on our first head of income. So we've completed basics, residential status, agricultural income, and our very first head of income, one of the important and the biggest heads of income, salaries head, we are done with. I always believe in this, that the best motivation is performance. Did you understand what I said? The best motivation is performance. When I perform, that motivates me to perform even better. Then I perform even better. That motivates me to perform even more better. That's how I keep getting better and better. So performance is best motivation. So till here, whatever we've done, till here, whatever confidence you have gained, that will act as your motivation for the next upcoming chapters one by one. Alright guys.